Good morning, everyone. Welcome to the Ally Invest Digital Conference, our second conference, and we're glad you could join us. And from the comfort of your home, your office, or wherever you are, keeping safe. I'm Lule Demmissie, president of Ally Invest, and your co-host, along with our chief strategist, Lindsey, who you might have seen on different places. There have been significant forms of influx in the number of people interested in taking control of their financial future. And this environment we live in has really sort of accelerated that and made that more possible. Hi, Lindsey, we just saw you again. And one of the things we're learning about working from home is the informality that it's introduced for our lives. So you're going to try to keep it real at this conference for you today. The interest has come from all sorts of people, from all sorts of backgrounds, and we're really proud of the broadening of investing that we are trying to drive here at Ally Invest, and the empowerment that comes from investing, and the wealth that can come from it as well over time. So there's a few things that really have dominated some of the topics we'll cover and really have influenced our view around investing. Obviously, what COVID-19 has done to our habits, our investing habits, our consumption habits have influenced this. In terms of the increased level of the market volatility has also been something that has really driven, interestingly enough, in this environment, less more investors, self-directed investors, everyday investors, have felt a little bit more empowered in this cycle than we saw in '08. So a lot of folks leaning in to try to see if this is a wealth accumulation opportunity for them over the long run. And we welcome, of course, the much welcomed and needed conversation around equality and broadening the tent in so many parts of our society that have inequities in them, and investing is no less, especially because we feel here at Ally Invest that investing is a means of creating wealth over the long run for people who don't have all sorts of other means of inheritance or anything else. And so we think knowing how to invest prudently and suiting your objectives and your outlook is something that is really part of the tool set of creating independence, financial independence. We're looking forward to those conversations. Knowledge is power. And our goal in this conference is to help demystify, dejargonize some of the ways that you can better enter into the investing landscape and not make it feel so scary to engage. And we want to make sure we are taking advantage of the many ways of building wealth. And so you'll hear that. This conference is different. We're not doing the traditional conversations about how to use a particular product so much as it is about teaching you tactics and insights on how to take control of your investments and take advantage of some of the ways that you can do that. The focus will be on several speakers. We have a ton of speakers. Lindsey Bell obviously will be speaking, and her team will be speaking. But we also have some guest speakers like Anna Gigonte, who's a financial advisor, and she's a woman of color, and we'll be talking about what she's doing to broaden investing and the investing landscape for folks. We have some really interesting conversations about wealth management with Ben Carlson and others. And then we'll also be talking about tactics on employing different means of taking command of your investing. We also focused on two things that we learned from last time, which is we have the first half of the day, which is about focusing on investment techniques for people who might be newer to investing, not so much new, but newer to investing. And then for folks who are a little bit more advanced, we've got some really high-charged sessions for you in the afternoon for us to be covering. So there will be a lot to cover, but first, let me introduce you to my co-host Lindsey Bell and her partner in crime, Callie Koch, who will be taking over and walking you through the next section. So thank you again, and best of luck, ladies.
Sorry, I had my speaker off. Thank you, Lule, for the kind introduction. I am Lindsey Bell. I'm Ally Invest Chief Investment Strategist, and I too want to welcome you to our second digital conference. This is part of our new educational series that focuses on helping you get smarter about investing. And talk about a great timing. I mean, volatility really has returned in the last couple weeks with larger than normal daily swings in stocks. But don't worry about that. My colleague, Callie Cox, a senior investment strategist on the team here, and we're here to help you learn to embrace uncertainty with our presentation this morning.
That's right. We're here to be your financial ally, and we're so excited to be here.
All right, let's get right into it. This slide here is kind of our agenda. It's going to serve as our roadmap with you all for the next 40 minutes of our presentation. We're going to start by assessing the market landscape. What does it currently look like? It sure has been a wild ride over the last couple months, which can be nerve-wracking, especially if you're new to investing. But smart investors don't let that get to them. They figure out how to invest in the environment that they're given. And we're going to try to help you do that. We're going to do that by giving you tips for investing in uncertain times. And then we're going to help you get started because, my friends, getting started is sometimes the hardest part of the process. Before we dig into all these topics and more, I just want to remind our viewers, you've been super active in chat this morning, and we love that so far. Keep up the good work. But Callie and I are going to answer your questions at the end of this presentation right here live. So make sure you stick around for the whole presentation. Get your questions over there in the chat box on the right, and we'll do our best to get to all of them by the end. So let's talk about the market landscape. Where are we? Well, let's start with pros and cons. Just like life, the market has pros and cons. or as I might say, there's some current concerns and then there's some mitigating factors. And since I'm a glass half full type of gal, let's start with the pros or mitigating factors. When I think about the market landscape, where we've gone and where we've been over the last few months, what has really driven the fantastic rebound that we've seen since that March 23rd low? Well, a big part of that really was related to the significant fiscal and monetary stimulus that was put into place by the government and the Federal Reserve. And we're going to dig more into that later in this presentation. But the CBO estimates that the amount of stimulus in the market right now, it equates to about 25% of GDP. That's no small number. So our policymakers are doing the best that they can to help stabilize the economy and ultimately the stock market too. So what that has done is point two under pros. That's helped ease financial conditions. And this is important because what this means, it sounds like fancy terminology, right? What it means is when you ease financial conditions, you're increasing the ability for people to access and companies to access loans and credits. We need money to be flowing to individuals and corporations to keep our economy going. And because the Fed has done that and financial conditions have eased, we've seen improving economic data. Heck, the City Economic Surprise Index is one indicator that we look at often. It measures basically how economic data is coming in versus what the pros think it's going to come in at. And the surprise has been to the upside, which is a good thing. Look, this week, new home sales, they were blockbuster numbers. Retail sales, much better than expected. Consumer confidence is on the rise, and we're even seeing some improvement in manufacturing. So this is all very good. And that's because the economy, the last point here, is reopening, which I make a note in parentheses that can be a pro and a con. And the con really lies in the top con on our list here is that reopening of the economy we've seen has led to an increased number of coronavirus cases. Isn't that right, Callie?
Yeah, that's definitely right, Lindsey. And if Lindsey is the glass half full type of gal, I guess I'm the glass half empty type of gal. And I'll walk you through the cons. So as Lindsey mentioned, coronavirus is one of the biggest cons out there right now. It's a terrible and devastating situation. And we've done a lot to flatten the curve over the past few months. But there are still hotspots popping up every day, especially around where we're based in Charlotte. So coronavirus is something to consider. It's a great health risk, but it's also a huge market risk as well. Investors are trying to gauge demand and where the economy is going to go over the next, 3 to 6, 9 months, even a year. And it's hard to really guess because it's all dependent on the pandemic. So kind of going off of that, most of our cons kind of wrap into that. I mean, right now, companies aren't making a lot of money. S&P 500 earnings estimates have plummeted this year as companies have come out and said, we think this might be a tough year. We're not seeing the demand that we thought we'd see at the beginning of the year. And stocks tend to follow earnings estimates long term. So, earnings are something to consider. It is one of the fundamentals we like to consider. And as Lindsey mentioned, we're seeing a fierce recovery in economic data, but the economy is still fragile. I'll get into this later in the presentation, but the job market, the May jobs report was a gangbusters report. You probably saw it on the news, but we're still looking at about 20 million people unemployed right now. That's a huge number. And there's still obvious nervousness in the market. The 10-year Treasury yield is near a record low at 70 basis points. That's 0.7%. And as bond prices go up, yields go down. So obviously, we're seeing a lot of investors hide out in treasuries. Gold also reached a 7-year high this week, showing that investors are flocking into gold for safety as well. Lots of nervousness in the markets. And there's also geopolitical and trade tensions. That's always a risk out there. We like to call those more black swan events, events you don't really see coming. But, trade tensions are simmering. We have seen them pop up in the past few weeks, and that's another thing investors are watching. So that's a lot to think about. Where do we go from here, Lindsey?
I wish I could tell you for certain, but what I think what we can look at to figure out where we're going to go is some of the drivers that we have historically seen drive the market. There seems to be some disconnects really all over the place with regards to the market and the economy and other things. You read about it all the time, the disconnect between Wall Street and Main Street. So what's going on? Well, this slide right here, we're going to talk about the disconnect between earnings and the stock market. The reason we're looking at earnings is the way I like to think about the stock market. It's not that much different in a way. Work with me here. It's not that much different in a way from if you or I decided to go on a long road trip, say from New York City, where I'm at right now, to Texas or to Detroit or maybe to Florida. Maybe I want to go to a beach, right? That's a long road trip, right? Well, what will we do? We would pull out our Waze, our GPS. Maybe if you're old school, you pull out a map, and you would use that to find your direction to where you're going. Well, the market very similarly uses different indicators to figure out where it's going. And earnings has historically been one of the best indicators of where stocks are going to go in the future. Let me break it down for you like this. Quarterly earnings growth on average since 2005 has averaged 8%. If you look at the long-term history of the stock market, the returns that we've seen in the S&P 500 has averaged about 8% annually. So 8% earnings growth, 8% annual lift in or return in stocks. That means there's they're highly correlated, or there's a big connection between the two. So that's why we oftentimes look at and start at earnings when we're thinking about not only individual stocks, but also the stock market overall. You can look at S&P 500 consensus estimate earnings, which is what we're looking at here. And now the market can, in some cases, lead earnings, but usually they work pretty closely together. And what you're seeing here, we don't have to go through all the numbers, but this is earnings growth expectations as determined by a group of analysts across Wall Street, where they think earnings growth is going to go in different quarters and in the years ahead. So on the left-hand side of the chart, you'll see quarterly earnings growth rate expectations. And on the right-hand side in the box, I'm going to focus on this black box here. You see full year 2020 and full year 2021 earnings growth estimates. The purple bar is where estimates were on March 1st before the coronavirus pandemic hit. And the pink bar represents where earnings estimates were as of June 16th. So the most recent data that we have. So what you see is going into the pandemic, earnings growth this year was supposed to be, pretty decent, 5.4%, below that historical average I mentioned. But then the pandemic hit, the economy shut down, companies shut down, and estimates had to be revised sharply downward. Callie went over some of the economic data points, and that has led to this reduction in earnings estimates for a decline of 24%. That's a pretty big decline by historical standards, but not that far off from what we've seen in other deep recessions. Now you look at 2021 and you're seeing a huge rebound. Originally, we were thinking 11.3% growth for 2021. Now that's looking to be closer to 30%. Wow. Well, in reality, when you look at the actual dollar values of where earnings have been and where they're going, in 2019, we earned about $162 per share in S&P 500 earnings. That's exactly what analysts are expecting the market to earn in 2021. So basically, netting those over 2 years, you're going to get zero growth. But the market is already off to the races. That's a pretty big disconnect, if you ask me. So it's something that we're going to definitely keep our eyes on. The good news is, it's not all bad news. The good news is that in the past 3 to 4 weeks, these estimates have really stabilized at these levels. And usually, historically, what we have seen is that when estimates stop declining, the market usually bottoms right around that point. So what's going to be key is watching what happens in the second quarter earnings period, which starts in July. We're going to hear from all sorts of companies about how their businesses are doing, and we're going to see if they're going to provide us any guidance. And then we're going to see where these numbers go. If they go down further, the stock market might, react negatively to that. If they move higher, the stock market could potentially react positively, or maybe it remains neutral given how far it's run. We're not entirely sure, but it's something that we're going to watch given that high correlation that I talked about. But Callie, this isn't the only way or indicator for direction for the stock market. Talk to us about something else that you've been looking at.
Sure. Well, let's talk about the economy, the second disconnect you need to watch in markets these days. So stocks follow two things over the long term. I know I said earnings. Lindsey talked to you about that. Stocks also follow the economy long term, although stocks are a leading indicator. So sometimes they do lead the economy. So right now, as I mentioned earlier, we're seeing lots of big surprises in economic data right now. So we're in a fierce recovery. There's no doubt about that. But there are still mixed signals. I mean, manufacturing hasn't picked up that quickly, and manufacturing is considered a bellwether for the economy and economic growth long term. And as we mentioned earlier, the economy is only partially reopened right now. So at least in Charlotte, I mean, restaurants can only take about 50% capacity at the moment, and it remains to be seen when everything will be fully reopened. So we could see some limited GDP growth from there. And when I say GDP, I mean gross domestic product. Just think of that as a general term for economic activity. So speaking of GDP, we do look at GDP estimates. And right now, economists are estimating that the second quarter, the quarter we're in right now, could be the biggest quarterly GDP drop on record. Look at the chart. They're expecting GDP to drop 35% on an annualized basis in the second quarter. That's a huge drop. And even if we see a V recovery in the economy, there still will be some long-term economic damage there. And investors are considering that right now. It's hard to know what the economy is going to look like a year from now. As I mentioned earlier, 20 million people are still out of work and collecting unemployment benefits. The unemployment rate is at 13.3%. That's a record high, and that's even after the economy started reopening. That was from May. So there are lots of things to consider out there, and I hate to be a big bummer, but they are things you should keep in mind when you're looking at the markets and where they're trading right now. Luckily, I do have one pro for you. As Lindsey mentioned, policymakers have taken notice of this. You know, the Fed has issued historic stimulus, and lawmakers have issued a historic stimulus package as well. That's the enhanced unemployment benefits and the stimulus checks you saw sent out over the past few months. So Lindsey can tell you more about that.
Yeah, so policy has been so important in this and every other recession, really, too. And, you know, I'll get into the next slide after this one about the swift response that we have seen from policymakers, which has been really impressive, like you said. But policy can be another clue to where the market is going to go from here. It's not as strong as an indicator for the future prospects for the stock market as, say, actual economic data and earnings data. But it can provide information into the direction of economic data. It's kind of like an input into the economic data. So what we're looking at here is a chart of economic policy uncertainty. And I know what you're thinking, like, whoa, Lindsey, you're getting a little too deep in the weeds for me here. But stick with me for a second, because I think you're going to find this really interesting. And you can find this data on the internet for free. It's a Baker, Bloom, and Davis data set. And so the Economic Policy Uncertainty Index takes things into consideration like newspaper articles about economic uncertainty, different tax policies that are upcoming for potential change, because let's be real, like tax policies impact everybody's bottom line, not just corporations, yours too. And it also takes into consideration economic forecasts by the pros, because if there's a wide range of forecasts by the pros and they don't know where the economy is going, that means that there's not a clear policy set to determine the direction of the economy. And you could see, that uncertainty flow through to economic data. So look at this chart. The Economic Policy Uncertainty Index, you see it's interesting because you see it start to increase going into those gray bars right here. These indicate recessions. And you see it increasing going into each one of these recessions, and then usually peaking within the recession. This was kind of a little outlier here. And obviously the we saw a humongous uptick recently in this index after the recession started in February. We got that news recently. And, policymakers were swift to react to the situation and stabilize not only the economy, the market. Callie talked about some of the things they did, but now the uncertainty lies in their fixes were kind of short term. They were, in most cases, lasted about 3 months. Things are currently evolving and changing, and some of these different policies are being extended for at least a period of time. But like Callie mentioned, we've got unemployment, the enhanced unemployment benefits. If you're receiving that extra $600 a week, that expires at the end of July. Additionally, there were temporary bans on evictions and foreclosures. In some cities, those will be expiring in July. So there's a couple of different things that are expiring. Most of the checks that people have received have gone out and have been spent at this point in time. There's a lot of talk about a phase 4 stimulus as the economy still works through this reopening, and we determine how quickly the reopening phase is going to be. But Congress, guess what? They go on vacation. They go on recess, I should say, at the beginning of July for 2 weeks. And so the likelihood of a phase 4 stimulus package getting through Congress sooner rather than later isn't looking great. There's a lot of disagreements on how big the package is going to be, what it's going to include, what it won't include. So hence a lot of uncertainty, right? So that's why it'll be interesting to watch this index. The latest data point we have is for May, when we did, I think it came down a little bit there, a tiny little bit, in response to, the actions that had been taken. But the question now is, what does the future hold? But to be sure, I'll just quickly go through this chart. This shows what policymakers have done so far. And as you can see, this talks about monetary policy, that's the Federal Reserve, what they do, and fiscal policy, that's what the government does and is responsible for. So I highlighted a couple of key points on this chart, right? About, the Fed was really the quickest to react. In early February, they cut interest rates. Then again, in mid-February, they just cut them all the way to zero ahead of their scheduled meeting to really signify how serious the situation was and how serious they were about working to combat the downturn that we were entering. And so between the Fed and Congress, there's been over $8 trillion in stimulus put into the system. And as you can see, it has helped stabilize financial markets. This is a chart of the S&P 500. And so with that swift decline, we saw a fast rebound as well. The Fed has interestingly even ventured into unusual territories. You see on May 11th, they announced their plans to buy corporate bond ETFs. That's something they haven't done in the past. And then on June 15th, just recently, they announced plans to begin buying corporate debt outright. So they're very committed to the cause here. And they're doing what they can to help corporations and the financial markets remain open. So we applaud them for what they've done, for lack of a better word. It's been unprecedented in what they have been able to achieve. The question is, where do we go from here? But we wanted to show that this has played a significant role in stabilizing the stock market near term. So Callie, we see the rebound, the fall and the rebound. What do we do from here?
That's a great question, Lindsey, and I don't quite have the answer for you, although we have some tips coming up. But as you guys may have noticed, it's been a pretty rough year for the stock market. The S&P 500 fell 34% from February 19th to March 23rd. That's a month. That is a crazy fast decline, one of the fastest in history for a bear market. By the way, when we say bear, we mean a decline of 20% or more from record highs. I'll be saying bear and bull a lot in the next few slides, so I'll prompt you with that one. But it's been a crazy fast decline. It was a scary time, and it still is, a scary and uncertain time. Uncertainty is the buzzword these days. But we've seen an even quicker recovery on the other side. Stocks since March 23rd have recovered more than 40%, while the S&P 500 has. So, did we miss the opportunity of a lifetime? I'm not sure. Do you think so, Lindsey?
It's a good question. I'm not sure either. I mean, sure, if you could time the market, maybe we did, but not too many people, even the pros, will admit they're not very good at timing the market. So I think the important thing is to be invested in the market and to be continuously investing over time. But we understand that it can be. We went through a bunch of slides, Callie, to talk about how uncertain the environment we are operating in is. But that doesn't mean you should be afraid of investing in the market this time, right? I mean, I think right now it's time for us to give our viewers some tips on how to invest in this type of environment, don't you think?
Yeah, for sure. We've given you lots of questions, and now hopefully we'll give you some answers. By answers, I mean tips on investing in uncertain times, finding that uncertainty in uncertainty. All right, everybody, tip number 1, embrace the uncertainty. I know that's a tough thing to do. I mean, Lindsey and I struggle with it every single day. We have to write about these markets and watch them every day. But you need to embrace the uncertainty. Why? Because nobody has a crystal ball these days. Nobody has ever, and especially these days, they don't. Wall Street can make educated guesses on what's going to happen in the near term. We do it too, but that's what they are. They're educated guesses. But, life goes on, and you can't wait for certainty to wait for the best time to invest. So accept that your investing journey is going to have ups and downs. If you're going to kick off your investing journey now, you will go through rough patches, but don't worry. Don't lose hope. So rough patches, we've had a lot of them. Since 1950, we've seen 10 bear markets. Remember, that's a 20% or at least a 20% decline in the S&P 500 from record highs. We've seen 10 bear markets since 1950 and 11 economic recessions. That includes the recession we're in right now, the great financial crisis, which felt like the world was ending, frankly, the tech bubble, and the inflation panic of the 1980s. Those are just 4 of the 11 recessions we've seen since 1980. But guess what the S&P 500 has done over time? It's averaged 8% annual returns since 1950, despite all of those setbacks. That's the long-term power of investing in stocks, and that's why you don't lose hope when you see a stock market decline. All right, well, I know the obvious thing here. You're like, come on, Callie, I'm not going to invest for 70 years. And I get it. I'm not going to invest for 70 years either. Maybe I will. Maybe I'll live that long. Who knows? That'd be great. But let's look at shorter term returns on stocks, because I think you'll be surprised by this. So the S&P 500 over the past 5 years has averaged 8% annual returns. That's right, the same percent annual returns as we've seen since 1950. 8% annual returns, average annual returns over the past 5 years. All right, let's take it back 5 more years. I can't do my math. Let's take it back 5 more years. The 10-year average annual return of the S&P 500 has been 11%. And if you invested 10 years ago, it was kind of a lucky roll for you, because that was at the beginning of the S&P 500's 11-year bull market. Now, when I say bull market, I mean a 20% rise from the lows. So bull market is the opposite of a bear market. So yeah, at the beginning of, the last bull market started in March 2009. So if you invested 10 years ago, that's June 2010, you caught the beginning of the bull market, or what was essentially the beginning of the bull market. All right, let's walk it back 10 more years. The 20-year average annual return on the S&P 500 is 4%. And that was possibly the most unlucky time you could have invested in the stock market. That was near the height of the tech bubble in the early 2000s, when we saw excessive investor confidence in tech stocks. And then the bubble burst and the NASDAQ basically cut itself in half. So, you could throw your money in the market at any time during history, but chances are, if you stick in it for the long term, you could see positive annual returns. And that's why we say, don't lose hope and don't panic when you see the market go through a rough patch. Remember your goals. Don't make decisions based on where the market is going. Make decisions based on your goals. And hopefully, Lindsey can tell you a little bit more about that in the next slide. Tell us how to get started, Lindsey.
Right. Tip number 2 for how to get started is get started early. I know that sounds simple, right? And maybe somewhat annoying. How many times have you heard that, right? Do I sound like your mom reminding you to do the dishes? Anyway, it is though so important, and it's simple, but it's one of the most important things you can do for your investing and financial future. And look, if you're older and you haven't started now, no time like the present to start, right? But the earlier and the younger you are, the better it is for you to start. And that's because of this little thing called compounding. I'm sure you've heard of that term before, but I understand that it can oftentimes seem and feel like a little black box at times, but it is a mathematical concept that Albert Einstein once called the eighth wonder of the world. Albert Einstein, guys, that's a big deal. But it's also, as we say here, it's the exponential snowball effect of earning on top of your returns. And that can happen over a long period of time. So if you can invest as little as $20 a month or less. Is my slide showing now? It looks
Eric
like
said yes.
Okay, sorry, little technical. We're all remote here, but working from home. So this is an impressive feat that we're taking on with this digital conference. But anyway, so you can start with a very small amount of money. And look, we show this hypothetical example here with investing $20 a month over 20 years, over 10 years, over 5 years. And you could see the difference here. And look, we're assuming there's no fees. In the S&P, it's an S&P 500 fund. We're assuming there's no fees. We're assuming you earn that 8% annual return that Callie talked about. And look at what happens if you do that for 20 years consistently. This purple line here, you can end up with almost $12,000 20 years from now. You know how much money you actually put into the market? $4,800. So you're making 3 times of what you put in with just $20. Think about that. That's, Callie will probably kill me, but if I say, that's four coffees, and over the course of a month, or maybe a couple cocktails, whatever your vice is, I guess. But anyway, the point is that starting early makes a huge difference, because look, if I started doing that only 5 years ago, I only have $1,470. So it's a wide difference, and it's really your money is doing the work for you, right? Nothing better than that. So don't miss out on starting early. The other 2 things I would note that this slide doesn't say: starting early is the most important, but you don't have to start with a lot of money. You don't have to have $500 a month to put in the market. If you have $20, $5, just get started. That is the most important thing. The second most important thing is consistently putting money in the market, because like we already talked about, you're never going to be able to time the bottom of the market. So if you're consistently putting money over time, sure, you might end up buying some securities a little bit higher and at other times a little bit lower. But being consistent over time can make a huge difference. But with that, Callie, we already know, don't be afraid of uncertainty. And get started early. What's the next tip you've got for us?
Well, Lindsey, the next tip is a big one, and Wall Street loves to preach about it. So Lindsey actually mentioned one of the biggest pieces of advice that I hate to hear in her last slide. So Wall Street will tell you, forego your daily coffee and you'll become a millionaire. That is the biggest hogwash I have ever heard. First of all, I am a coffee nerd, and I drink multiple cups of coffee a day. So I don't want to give up my coffee. But let me tell you, that is not the way to getting to your financial future or hitting your goals. We're telling you the tips that you need to know in order to hit those goals, and compounding is a big one. The third one, diversify. Diversify. I can't say it enough. Wall Street will tell you to diversify, but let me unpack it for you for a second. Diversification is essentially the investing equivalent of not putting all your eggs in one basket. It's spreading your money out between more aggressive assets, think stocks, and safer assets, like bonds. Safer, conservative, they all kind of mean the same. Aggressive and conservative assets. Spread your money out across several assets. Because look, market swings are not easy to stomach, and everybody has a different risk tolerance. When I say risk tolerance, I mean your ability to take the market ups and downs on the to your goals. Diversification can help so much for this. It can ease any investing anxiety you have. And I think this year is a great example of how the diversified investor can come out at the top. Diversification is also an important thing to remember if you have a shorter time horizon to your goals. Let's say in 5 years you want to, take some money out and maybe buy a house in Hawaii. First of all, if you're doing that, let me know. I want to be your best friend, use that beach house. But, if you have a shorter time horizon, bear markets like the one we've seen this year can, hit the money that you have in the market pretty hard. So maybe diversification helps you sleep a little bit better at night. All right, so let's look at what happened this year to the investor in a hypothetical 60-40 stocks and bonds portfolio. I say it's hypothetical because it is. I mean, this probably doesn't model out exactly like the same portfolio that everybody, like any investor has out there. It's just a hypothetical on our end, but it does demonstrate the power of diversification. So let's go back to that hypothetical S&P 500 fund example that Lindsey was telling you about in the compounding slide. If you were invested in that fund this year, you would have lost a maximum of 31% at the height of the sell-off. That's huge. But if you decided to diversify and you stuck 60% of your money in that hypothetical S&P 500 fund, but 40% of your money in a diversified portfolio of bonds, hypothetically again, you would have lost a max of 19%. And you would actually be up on the year right now. That's the power of diversification. And, there's always cons with pros. So I have to mention the con here. If you diversify, you might miss out on some returns on the upper end. You're taking less risk in your portfolio. So you might make less return. But that might be a good trade to make if it helps you sleep at night. So remember, diversify, especially if you have a lower risk tolerance. And if you do, that's okay. We're all different. And I'm so excited to tell you about the last one. It's personally my favorite. So we'll flip on to that.
Well, before I flip on, Callie, I just wanted to remind our viewers, if you haven't seen the agenda, Callie did an excellent job explaining diversification 101 to you. But we've got Ben Carlson coming up after us from Ritholtz Wealth. He's going to go even deeper and make you guys pretty much a pro at this. So be sure to stick around after our presentation for his presentation. But on to the next slide.
Yeah, good call out, Lindsey. I didn't forget you, Ben. Ben will be great. So stay on for that. All right. So arguably the most important tip, and it's also great life advice, keep calm and avoid emotional investing. That's right. Try to remove your emotions from your portfolio. So what does that mean? Well, it's essentially like keep your eye on your goals. And like I mentioned earlier, don't make decisions in your portfolio or investing journey based on what the market is doing. Keep calm, keep investing. So let's talk about panic selling, because panic selling is a term that Wall Street likes to throw around and is very much a thing. Panic selling is the act of selling just because the market is falling. It's very common. And if you watch the markets on a day-to-day basis, you'll notice that when stocks start selling off and they hit certain points, the sell-off intensifies, it gets worse. And then we have a 5% down day or a 10% down day, both of which we have seen this year. It's been a rough year. But panic selling is very much a thing, but you don't have to panic sell. And the best investors learn to not panic sell or panic buy. And, it's also important to keep in mind that stocks' biggest up and down days tend to cluster together. So it is a futile exercise to try and time the market. I mean, look at March, look at the chart on the screen. We saw over the past 12 months, we've seen the 10 biggest up days and 9 of the 10 biggest down days occur between February 19th and April 10th. So, you might sell out in the market and time it well enough to kind of miss that 10% drawdown. But if you sell out, you have to get back in to enjoy the 40% rebound. All of that is a wash when you consider your goals and you kind of stay invested in the market and stick in it for the long term. So it's so important to remember your goals. And going back to diversification, if you don't like those market swings, if you find that it's hard to keep calm when you see the market going through a rough patch, diversify. That helps so much. And yeah, that's my favorite tip. By the way, this is a lot to digest. So if you have any questions, please drop them in the chat. Lindsey and I will get to them after our presentation. So with that, I'll flip it back over to Lindsey.
We will definitely get to those questions. I know there's some great ones already coming in, so keep them coming. So Callie, all right, everyone knows we've laid it out for them. We're operating in uncertain times, but I think we've given our viewers the confidence that they can do this. They're going to be great investors, long-term investors, hopefully. But let's help them get started, because I always find this is really can be one of the most difficult stages of the investing process, right? So how do we get started?
All right, I'll tell you, and I hope you're fired up, because we're about to make a plan and put it into action. Okay, so you want to invest? Where do you start? We have a 3-step plan to get your financial house in order. First step, pay down your debt. And when I say debt, I'm talking about high interest debt, because debt can be a tool for investing, but high interest debt can seriously eat into the gains that you might see in your investing portfolio. Okay, when I say high interest debt, I mean the 15 to 20% rates you see on like credit cards and personal loans that you need to pay off instantly. So before you start considering investing, we recommend that you pay off that debt. Think of it as a seesaw. So if you're making that 8% average annual return that we've mentioned so many times in this presentation, but you're paying out a 15% interest rate to credit cards, you are losing money. So take that into consideration when you have some high interest debt sitting on the side. You can start investing with high interest debt or any debt on your balance sheet, or any debt that you own, but it might not be the wisest thing to do. All right, so second step here is to build up your emergency fund. Another thing that Wall Street loves to tell you, but I'll break it down for you here. So we all know that we have rainy days. I mean, right now could be one of those rainy days for you. It is a rough economy at the moment, like we talked about, but save up some money, put 3 to 6 months worth of expenses in a savings account, just in case you hit that rainy day. Maybe you lose your job. Maybe you have a health emergency. Maybe your dog breaks his leg. You never know. By the way, I'm sorry if that happened, but it is so important to stick some money out on the side so you're prepared when life kind of goes against you. And it helps embolden you when you do finally start investing, because you have this money out to the side, so you're not stressed out when you do start putting that $20, $30, $100 per month into the market, because you have your buffer on the side. It's your cushion. It's your sanity check. I'll call it a sanity check. All right, so step 3, let's say you paid down your high interest debt, you built your emergency fund, and now you're ready. You're like, get me going here. Okay, start small. If you do all of these steps and you say, wow, I don't have any money left, we get it. It's fine. Start small. Put maybe $5 a week into the market and see how that goes, because you may notice in your budget that you'll find a way to kind of find some money to put into the market or think of your future self with. Our rule of thumb here at Ally Invest, and one that you've probably heard, is we like to say save 20% of your post-tax income for investing in your future self. That's investing, saving, retirement, anything that will benefit your future self, maybe education. So 20%, that's a big chunk of your paycheck, and we get it. You don't have to do that right off the bat. Save $20 a week, $20 a month, and then slowly ramp up to that over time. It's okay. We're all figuring this out together. So, it's fine if you have to start small. And I'll reiterate again, you don't have to go through these steps, but we highly recommend that you do. It is so important to get your financial house in order before you start investing. If you're not quite there yet, maybe start small and pay down your debt at the same time. That's fine too. Everybody is different. All right, Lindsey. So we want to get started. How do we get started?
Yeah. Well, once you have your financial house in order, it's time to get your plan, get your game plan together, right? Mm-hmm. And the first step in that process is determining what your goals are. Why are you investing? What is the purpose? And when do you need that money by? So do you need it 5, 10, 20 years from now? Is it just for retirement, or do you plan to buy a house along the way? Or are you planning to pay for a student's college education or or pay for a wedding or some other big vacation or purchase that you're really excited to do in 5 years or something like that. I think you need to come up with your different goals and then determine what the timeline is for each of those goals. And then most importantly, in bullseye number 2 under determining your goals is how much cash you need right now. What are your expenses going to be over the next 1 to 3 years? Are you planning to buy a car maybe in 2 years from now? Do you have any other big purchases on the near-term horizon? We call that 1 to 3 year period more near term. And then that's going to determine what type of account makes the most sense for your needs. Of course, you hear everyone say one of the top rules of investing is if your company offers you a 401k plan, get in it, especially if they offer you a match. And that is true. That is true. But if you have other financial goals, that may not necessarily be the best type of account for you to and invest and save for nearer term goals. For example, like a 401k and an IRA, they have tax advantages, which is why they are great types of accounts. And especially if you get that match from your employer and your 401k. But you can't have access to that money until you reach a certain age, usually closer to retirement, at least without paying a penalty and taxes on that money. So if you need something a little more near term, like a car in 2 or 3 years, maybe you want to do a CD, get a nice rate on a 2-year CD or an online savings account. Those types of accounts would go in your 1 to 3 year bucket. But an investment account or a brokerage account or a robo account might be something that you put money in for, a goal that you have 5 to 10 years out. You can also use it for retirement as well. But there is, with retirement and money you're not going to access for a long period of time, you want to take into consideration some of your tax implications. And you can find more information on that on our website as well, too. But so once you have your time horizon and your goals laid out, the next part of the plan is to figure out how you're going to pick your securities. The first bullseye under this column is consider your risk tolerance. And Callie kind of talked about what risk tolerance means. And, when I think about risk tolerance, it means how much money are you willing to lose in the near term for those longer term gains? Because, we're always, the way Callie and I think about investing is really from a longer term perspective. We're not day traders. So we're in it for the long haul because the returns are better over the long haul in most cases. So once you have your risk tolerance figured out, one thing you can take into consideration there is the risk tolerance. It can oftentimes be exactly what Callie showed in that split portfolio between stocks and bonds. And the question is the age-old history of 60-40 split, 60% in stocks, 40% in bonds. Is that the right mix for you? And there are different rules of thumbs out there to determine how much of your money should be invested in stocks, because stocks, by the way, are a more risky asset. You're more likely that the downside in stocks is a little bit higher than, say, the downside in a fixed income instrument. In some cases, depending on what you're looking at, let's say a treasury yield. But one rule of thumb that I think about when I think about risk tolerance is the 110 minus your age. So if you're 40 years old, 110 minus your age says 70% of your portfolio should be in equities and the 30% left should be in fixed income. And that changes over time. So that's just one quick rule of thumb that you could use to take into consideration your risk tolerance. Then you want to consider diversifying across multiple types of securities within those asset classes. And again, Callie talked about it. I'm not going to beat this one down because Ben Carlson is going to really get into it in the next presentation. We have even a more advanced version of diversification that looks at more interesting asset classes in the afternoon with David Peltier. So be sure to tune in for that segment of today's conference. After you diversify across asset classes and then within asset classes, then you want to, another way you can think about diversification is what is your comfort level with individual securities versus ETFs? If you're new to investing, ETFs can really be a great way to get your toes wet, to really just get started. You could buy an index fund that follows the S&P 500. That's pretty easy to do, and you get your diversification, at least from an equities market perspective, doing something like that. But ETFs too, just because they're ETF doesn't mean they're automatically diversified. If you buy a tech sector ETF, you need to understand what is in that ETF. Also, you need to understand what fees are included in that ETF, because you're going to have to, some of them you're going to have to pay fees. We do offer on our Ally Invest platform several ETFs that have no fees. So there are plenty of them out there for you to consider as well. So then after you got your diversification down, you know what if you're into individual securities or ETFs, then you can think about, am I going to be hands-on or hands-off? If doing all that process of figuring out diversification on my own sounds like a lot of work to you, maybe you're a hands-off investor, at least to get started. And that could be a good opportunity for you to consider a robo type of advisor or a managed portfolios that are already made. You just put your money in it, and the platform that you're investing in does all the work for you. They do the rebalancing, which is another topic that you're going to hear a lot about throughout the day. They do, they pick the securities for you. So you're invested across various types of asset classes and diversified within those asset classes. So it's a lot easier way, especially if you're new to investing, to dip your toes into it. But if you're a hands-on investor and you like to do your homework, we always recommend, no matter what you're investing in, even if from a robo-advisory perspective, make sure you do your homework and you understand where your money actually is at night. So after you got your hands full with that and you think you're feeling good about it, then it's time to get started. And how can Ally Invest help? Well, we've got a little bit of both, hands-on and hands-off for you. We'll start with the hands-on, or hands-off, excuse me, managed portfolios, hands-off. Our robo-advisory portfolios or managed portfolios, those terms can be used interchangeably. Robo-advisory is a more popular term. You can start investing in those with as little as $100. So it's not a big upfront commitment, and you can make plans to continuously invest, like Callie and I've been talking about all day. There's no advisory fees, no annual charges, and no rebalancing fees. We rebalance the portfolio regularly for you. So if you get overweight in a large cap index, because that index has been up the most in the quarter, we're going to rebalance that back down for you. The portfolios also include a mix of low-cost, diversified ETFs. The portfolios also serve different interests that you have or different goals that you have. We have tax-optimized portfolios if you're looking to benefit from a tax perspective. We have income generating if you're later stages in your investing cycle, and you're really all about income generating, less about growth. We also have our core, which is our basic portfolio, which does focus on growth. And then we also have ESG, which has become really popular and has been one of the better performing sectors in the quarter. Actually, we've seen a lot of funds flowing into our ESG portfolios, as well as ESG funds in general. So it's become much more popular as people have become more interested in investing in a sustainable way for companies that are doing right by their employees, right by the communities that they operate in, and right by their shareholders as well. So we offer a whole plethora of different managed portfolios that could be a good fit for you. Then also we do self-directed trading, commission-free, just like the industry. We all went to that in the fall of last year. There's no account minimum, so you can really start with a little bit of money there. We offer a significant amount of investment choices for do-it-yourself investors. We have an ETF screening tool, which is a great way to find those ETFs you might be interested in. We offer all sorts of types of different stocks. A lot of those ETFs I mentioned earlier have no fees. So there's a lot you could do here. We offer really in-depth research and market analysis tools that support various types of strategies. At the end of today, you're going to learn about options, and our options guru, Brian Overby, he's going to show you our options trading platform and really get you familiarized with that and how you can take part in or experiment with options trading. All right, I'm going to just jump into Q&A here because we have about 9 minutes left, and I love it. You guys have been super inquisitive so far. Let's see, we might not be able to get to all of your questions, but we're going to do our best to get as many as we can. Callie, maybe you have a suggestion for this, but Monica asks, what affordable educational resources do you recommend outside of this conference? Are there any good books on investing for beginners?
That is a great question. Ooh, I'll have to think about that one. So books, I'll get to that in a second. I do have to do some self-promo. We do have something called the Ally Community Hub, which our parent company, Ally, sponsors. But Lindsey and I do post a weekly note on there every week. It's called the Weekly Viewpoint. It's more of a forward-looking note on what we think can happen in the markets based on trends that we see. At a minimum, it's just, look at this trend that we're watching. Maybe it's interesting. Maybe you should keep it in mind. So definitely check out our weekly note. We also put out quarterly outlooks, just kind of previewing the quarter coming up. Our next one's coming out in July. In terms of books, so I really there's a Sally Krawcheck book. It's called, oh shoot, I can't remember. I'm sorry. I'll have to get somebody. I
know which one you're talking about. I'm dropping on the title of it too. But a book that I do like is Rich Dad, Poor Dad. I think it's a great one for just thinking about your financial life in general. And then Benjamin Graham, he's, the value investing father. He's got some good stuff out there too. And anything Warren Buffett, anything Warren Buffett is great to get started as well, because he's the true fundamental investor. And fundamental means looking at the fundamentals of corporations, sales growth, earnings growth, margin growth. And what it means for the potential stock appreciation. All right, next question. We've got a ton of questions here. Brian asks, can you have an account with both managed and self-directed trading at Ally Invest? And the answer is yes, you can absolutely have both. And we have plenty of customers that like to do both. They get started in one area and dip their toe in the other area. So yeah, we're all for you doing whatever it is the best for your investing style. And I should mention, I didn't mention before, is we have an amazing customer service team. So no matter what type of account you have, we're available most of the time 24/7 to answer your questions by phone, chat, email. So we're here for you. We are a true financial ally. Next question. Let's see. You guys are a smart bunch out there. Karina, when is a good time to be diversified? All the time. It's good to be diversified. That risk that Callie and I talked about, that's a great way to manage your risk and downside protection. And it helps you, as I know my friend David Peltier, who will speak later, will tell you, the goal of diversification is to minimize risk so that you can live another day to keep investing.
Yeah. I'll add something quick to that, Lindsey. So, sure. If your horizon is a little bit longer, say that you're in your 20s and you're like, okay, I just want to save for retirement. It does make sense. I mean, especially considering that 110 minus your age rule, it makes sense to keep, a lot of your money in the more aggressive assets because you have time to grow that money. But it is also so important to keep a little bit in safer assets or more conservative assets like bonds, and then gradually roll, throughout your life, throughout your investing journey, gradually roll more money into bonds. So by the time you want to take your money out, by the time you want to retire, or like I said, buy that house in Hawaii, you'll have your money protected, hopefully protected. Not everything is guaranteed, but bonds have proven to be a safer asset over time. So it is very important to diversify. And there are other things you can diversify in as well. There's gold, there are high dividend stocks that might provide a safer profile if you want to invest in equities, but you don't, love the swings of higher growth stocks. So, maybe you have a long time to invest, but it is still very, very important to diversify.
Yeah, it is. We'll get. It's a great topic too, because it's one that does confuse people, and so that's why we're going to focus on it today with some of our other presenters. Callie, another question from Jizzle: does it make sense to open a brokerage account to save money for a house in 5 years for a higher return than that of a CD? I know you had some 5-year returns for us earlier in the presentation.
Yeah, that's a tough one. By the way, I love your username, Jizzle. That is a tough one, and I can't give you advice, specified advice, but I would, 5 years is probably the minimum I would go to put your money in the market. Fun fact, the great financial crisis stocks took about 5 years to recover from the downturn we saw during the great financial crisis. So that is like a worst case scenario. That was a once in a lifetime type thing that happened. But it might be a good idea to stay diversified, Jizzle. I can't say that without like wanting to laugh. It may be a better idea to, stay diversified if you are looking at a shorter term horizon. Maybe look at like a 50-50 split, or maybe look at like a smaller allocation to equities and maybe like a higher allocation to safer assets, so you can make sure that your money is protected if you want to take it out in a few years.
Yeah, I mean, I would just add to that. I think 5 years, like Callie said, is the minimum. We would say you need to minimum timeline. You need to have your money in the market, and there's no certainty, but I think some of the 5-year returns that Callie highlighted have over the longer term have been pretty positive. And especially when you're in an environment like we are now with interest rates at zero and not a lot of other options out there, it could be something that you could consider. But if it's something that you're struggling with, absolutely talk to a financial advisor or professional for some advice there. There is a question from Comments 2017. What should I do with my 401k? I didn't know there were fees taken yearly, and now I want more control of that money because I am recently unemployed. Should I leave it alone or close it out? Well, I wouldn't necessarily close it out. It depends on what your personal situation is. But what I would suggest is if you have a 401k and you think the fees are too high, I'm not sure if this 401k is with an old employer or a current one, but if it's in an old employer, what you can consider doing is rolling that 401k over into an IRA account at a brokerage firm like an Ally Invest. And, we're here to help you hold your hand through that process because you can roll that 401k into an IRA that is either just like we have on the page here, a managed portfolio, or self-directed. So you're in control of it. We don't charge any advisory fees. We don't charge any commissions on most securities. There's no account minimums. So rolling that into an IRA and another brokerage house will not only give you control because you can pick the securities that you want to be invested in, but it will also reduce the number of fees. And I think we're just about at time. Maybe we can quickly do just one more. Let's see.
We'll talk super fast.
Yes. Callie, just Armin had a ton of questions, and one that I'm seeing right here is on your slide about uncertainty, the first slide with the table with the returns. Do you adjust those returns? Here, I'll go up to it for components being added or subtracted. I'm assuming he means constituents. I know you're looking at the S&P 500, but.
Yeah, so that's a great question. I think you just missed the slide. Yeah. Go for it. That is a great question. And yes, we do adjust for constituents. That's members of an index. We do adjust for members of an index being added and deleted. And over the long term, that really is a wash. If you are an investor who wants to invest in the broader market, so you're looking at an S&P 500 fund of some sort, additions and deletions to an index will be a wash over the long term. But yeah, we do consider that. And I see we never made it to the slide, but I will add that this presentation will be posted on YouTube within the next few days. So definitely, go back and watch this, check out that slide. It's Embrace the Uncertainty. And that table is a history of bear markets in the S&P 500. So
yes, that is all the time we have. I know we didn't get to all of your questions. We're going to work with our marketing teams and compliance teams and figure out if there's a way we can respond to you in a timely fashion. But you're in for a real treat with our next presentation. We have Ben Carlson. He is from Ritholtz Wealth. He is a portfolio manager there, director of institutional asset management. Sorry about that, Ben. He's going to present a tool for market volatility. Again, getting into that topic that a lot of you had questions on. Maybe he'll be able to answer some of the questions that you've already put in the chat box. He will be talking with you all about diversification. It is a can't miss. He'll be taking your live questions at the end. We're going to take a short break, and we'll be right back at 11:10 with his presentation. Welcome back, everyone. I'm pleased to introduce Ben Carlson from Ritholtz Wealth Management as our next presenter. He is going to talk about a tool for market volatility, that little thing called diversification we've been talking about all morning. At the end of his presentation, he's going to take questions from you live. So be sure you enter your questions on the right-hand side in the chat box on YouTube, and we're going to get to them as many as we can at the end of his presentation. So without further ado, Ben, I'll pass it off to you.
Thank you. Thanks, everyone, for being here. So I'm going to talk about diversification today, just from a number of perspectives, mostly from an investment perspective, but just wanted to give some quick overview for those of you who aren't really familiar with the concept. There was a great investment thinker named Peter Bernstein who once said, diversification is the only rational deployment of our ignorance. And basically the idea here is that, no one knows what's going to happen. So you figure out a way to spread your bets, just as a way to manage risk. So I'm sure like many of you, I have been binge watching TV lately. There hasn't been much to do the last few months. People are finally getting out and about. But one of the classic shows that everyone has in their top 5, top 10, unless you're a really big contrarian, is The Wire. If you're not familiar with The Wire, the guy pictured here was the character Stringer Bell. So he was the business mastermind behind the Barksdale crime organization. And he deployed diversification in the drug trade in The Wire. And how he did this was they had to make sure that the police couldn't track them, because the police were trying to track their phones. They were trying to figure out what they were doing. And the way that he did this was he had all of his drug dealers use burner phones. And it was not just burner phones, because eventually the cops could track those, but they made sure that they bought burner phones at different locations. So if the cops went to one store to see if they remembered a certain person buying a phone, they couldn't. So they had these multiple burner phones, and then they also used multiple SIM cards. And that was the way that they used diversification to manage risk in this crime organization. Not technically the way you want to use it in your portfolio, but that's just one way that they did it. And it's kind of funny because something that ended up bringing down him and his Barksdale crime organization was they didn't diversify where they rented their cars from. So one of the people in the organization rented their car from the same place every time. And that's one of the ways that the cops actually took them down. So they kind of had diversification that worked against them because they didn't use it fully. Now, of course, today I'm talking about your investments, and that, diversification kind of as a concept really extends beyond that. So we can have diversification of opportunity if you're looking for a job. You could have diversification of income as a way to really, diversify your income stream. So you can also have diversification of ideas and opinions. But today I'm just going to look at it from an investment perspective. And I think before we get into the concept of diversification, it makes sense to understand, why are you investing in the first place? So what are you putting your money to work for? Why don't you just hide it under your mattress and keep it safer under there? And really the idea here is that you're protecting your purchasing power. So one of your biggest risks that you're diversifying away from is inflation. So this is the price of goods over the past 40 years or so. You can see a movie ticket has more than doubled. The cost of college admissions obviously has gone up, more than triple. The price of a house, is up almost 4 times. So if you just bury your money under the mattress and do nothing with it, and you don't invest, even if you're saving, it really doesn't help you much, because your money is not working for you, and it's actually technically losing money because it's going under. And so if we look at this chart for how long it takes inflation to cut your money in half, you can see even a small 2% inflation, which is basically what the inflation rate has been running at for this century since the year 2000. In 35 years, your money is cut in half. So if you just do nothing with your money and don't invest it, that's actually a huge risk, even if you're saving, because those dollars will be worth less. So if you think you have a certain number in mind, you say you want $500,000 or $1 million or whatever it is for retirement, that number today is not going to be the same thing in the future if we have any meaningful inflation. And this is one way that compound interest kind of works in reverse. So if you have a credit card and you're paying 15% interest on that credit card, in a little under 5 years, you're going to have double the amount that you owe if you pay nothing on that card. So this is how inflation and interest rates work in reverse for you. And it's almost this like reverse compound interest. And that's why I always say, the number one rule in personal finance is, don't carry credit card debt. So we figured out, why you invest. You want to beat the rate of inflation. So if you want to beat the rate of inflation, what is your best bet? If you look long term, the three main asset classes: stocks, bonds, and cash. And when I talk about cash here, I'm not talking about burying money under your mattress. I'm talking about short-term government vehicles, or even like a savings account. And so you can see this is the long term over the last 90 plus years since the late 1920s. The stock market has, pretty much doubled up the bond market. For those who aren't familiar, bonds are just a simple form of letting someone else borrow money from you or loaning to them. So that could be loaning money to a government, a corporation, mortgages, car loans, anything. You can see these are the long-term returns. These aren't promised to anyone. Now you can see this is, a 92-year period. So take it for what it's worth. No one actually has, not many people I know have a 92-year time horizon to invest. But you can see the stock market has little less than doubled up the bond market. But if you look at the growth of $1,000, the stock market exponential growth has been much higher. And that's how compound interest works, in that you get this money building on top of money, building on top of money. And again, I remember, think of a cash as like your savings account. So over the long term, you've gotten a little over 3% in just keeping your money in something like the Ally online savings account, I guess, which is where you want to park your more safe accounts. And if we think about these numbers, these are nominal numbers, meaning they don't take inflation into account. You can see how inflation takes a cut of even these numbers. So this is over the long haul, the last 90 plus years, inflation has run at about 3%. Again, it's been a little lower lately, but you can see how much that takes it down just in terms of your growth, in terms of what that does to your money. Now, again, stocks are still one of your best bets. Now, if you look at something like cash, over the very long term, inflation eats up most of that, where it basically just gets you a little bit of money and doesn't earn you much. Bonds still have earned a little bit of a premium, but those rates are much lower now than they have been in the past. So that's kind of the way it works. That the stock market over the long haul is your best bet for growing your money over the rate of inflation. Now, so again, this is one of the reasons that inflation is this sworn enemy over the long haul. So the question is, why do stocks earn higher returns than bonds or cash? Well, one of the reasons is they're just riskier. So this looks at the annual returns of the stock market since 1928, and the green shows the highest return, the red shows the lowest return, and then the blue in the middle is the average that we looked at it before. So you can see you could drive a truck through the range in stocks. So the highest return ever has been 53%. The lowest return ever was 44% loss, and this is just for a single year. The gains and losses have been bigger in other longer periods. Now you go to bonds and you get a little bit of a narrow range. Bonds have had pretty good years in the past too, when they've had higher interest rates or falling interest rates, and the losses are a little lower. Now you look at cash and you see that cash, for the loss, it has never been negative. And so it's never had a down year. It has had a decent up year or two in the past, in the early 80s, when interest rates were much higher. But the whole point of this is, if you learn nothing else from this talk, it should just be that risk and return are attached to the hip. So almost every country economists and stock market historians have covered over the years, stocks have had higher returns than bonds. And the reason is because they're riskier. And further, unfortunately, if you want those higher stock returns, you're going to have to pay for them by bearing some sort of risk. So that means, this is a polite way of saying, from time to time, to earn higher returns, your portfolio is going to lose a truckload of money. And obviously, this year is no different than that. We saw that those high returns, come with a risk. Now, this is a different way of looking at these annual returns. So this shows these are every year stock market returns going back to 1928 for the U.S. stock market. You can see they're kind of all over the map. There's been some very good returns, some very bad returns. One thing you should notice here is that the average long-term return for the stock market has been, in the 9 to 10% range. But the majority of the time, the stock market from any given year gives you nothing even close to that. So your experience over the short term in the stock market is very rarely what it'll be like over the very long term. And long term, I'm thinking 10, 20, 30 years, a very long time horizon. Now, if we go to bonds, you can see, much lower highs and lower lows in the stock market. You can see that's a pretty big shift, and things have retched down. Then we get to cash, and you see, again, no down years, not many big up years. And I kept all these on the same scale for a reason. So if we scroll through here, you see stocks all over the place, bonds much closer together than cash. And now, depending on your tolerance for risk, some people will look at this and say, well, why wouldn't I only invest in stocks? Well, some other people would say, why wouldn't I just keep all of my money in cash in a short-term savings account and never lose money? Now we're going to go through some of the reasons for that. And one of the reasons that you don't just invest in stocks is because they're risky. And again, not everyone has a very long time horizon for their money. So if we look at these returns by decade, so we look at stocks and bonds and cash, you can see in the 1930s, the stock market was down for the entire decade. The same thing happened in the 2000s. I'm going to get to that a little later in terms of the lost decade. Now look at bonds and cash. In both of those decades where the stock market had an abysmal time and lost money over 10 years, bonds and cash actually did well for you. And so if you needed to spend that money for something, you have that. So let's say you're saving up for a down payment for your house, or you have a wedding. And let's use this March and February as an example. In 23 trading days, the stock market fell 30%, which was the fastest that's ever happened in history. So 2020 is kind of one for the record books. If you needed to spend that money, and even though, stock market has earned longer, higher returns over the long term, that really doesn't matter, because if you had to spend that money and you needed to pay for a down payment on your house and you went to do it and stocks fell by 30% in March, you're kind of out of luck, because that 30% loss just took away your whole down payment. So that's why we have these bonds and cash to diversify when things go wrong in the stock market in the short term. And you can see one of the things that the bond market has done really well is hedge out the risk of the stock market. So this is every down year in the stock market. And again, I'm using the S&P 500 here, which is just a broad-based index of the U.S. stock market and the biggest companies. So out of the past 92 years, the stock market has been down 25 of them. So let's round up and call it every 3 out of every 4 years, the stock market is up on average. 1 out of every 4 years, the stock market is down on average. Now, if we look what bonds have done in those times when stocks have been down in those 25 years, the bond market has actually been up every one of these times but 3. So one of them was in 1931. Bonds were down, 2 or 3%. In 1941, when stocks fell, stocks were down 2%. And then in 1969, bonds fell 5% when stocks were down 8%. So 3 times out of 25 where bonds didn't provide much diversification, even though they didn't fall near as much as the stock market. Now, this almost happened in 2018, actually. Bonds were basically flat on the year and stocks fell 4%. But you can see the average year when stocks have been down, they fall in double digits on average, and a 13.3% loss. In those years, the average return for bonds has been 5.1%. So that's your short-term hedge, and that's why you diversify in something like bonds, and that gives you, 2 things. 1, it hedges out your risk and lowers your volatility of your portfolio, depending on how much you have in bonds. And 2, it gives you some dry powder if you need to use that for spending money, or if you need to use it just to rebalance and buy more stocks in your portfolio. So bonds provide this ballast and this anchor. And so those people who can't handle having their entire portfolio of investments in stocks, you have bonds there as really this anchor to provide a little help when things are bad. And so if you have spending needs, you have a hedge. And so this is just sort of a visualization of this, where you can see the red shows every year that stocks were down. The green shows what happened to bonds in those same periods. And you can see, this is diversification in a nutshell. While bonds offer lower long-term returns, in the short term, where life is lived for a lot of people, that they provide a really nice hedge for you. So the question is, great, stocks can be great for the long term, potentially terrible for you over the short term. So what's the right way to think about diversification among these different asset classes in terms of risk? And I do like to think about it, mainly in terms of risk, because that's kind of the way that you build a portfolio, is based on your risk tolerance and your time horizon. And so, as we've all been watching a lot of TV lately, one of my wife's favorite things to watch is Shark Week on Discover. Kind of surprising that this show has actually been on for 30 years now, more than 30 years. And they've actually started to research the people who watch this show to see what some of their reactions are. And so researchers asked a huge group of people to watch the show while they study their reactions and their emotions and how they felt about sharks after watching it. And now the producers have gone to great pains over the years to show people that, yes, sharks are scary and the movies are portrayed as these nasty animals that go after people, but it's really a very low probability event that someone is actually going to get attacked by a shark and killed by each year. But what they found, even when presented with this data, the longer someone watched Shark Week, the more nervous or scared they became of sharks, regardless of what the stats were telling them in the show. So the stats would say, sharks are not that big of a risk to you, but the longer you watch, the more scared you became just because you watched them. And that's the way to think about the stock market. So if we go back to the 1920s with the stock market, if you looked at it on a daily basis, it's probably 56% of the time. It's negative the other 44%. So let's call it a coin flip. It's basically 50-50, where the stock market on any given day could be up or down, which is kind of hard to believe since over the long term the stock market is up. That just means that the daily gains really outweigh the daily losses. But anyway, if you're looking over just a single day, you're going to think this makes no sense. I'm up, I'm down, I'm up and down. The losses will weigh on you so much more than the gains. Now, if we extend our time horizon a little bit, as I said, over a year, 3 out of every 4 years is up. If we extend it to 5 years, you're getting closer to like 90% of the time the stock market has been up. Over 10 years, it's roughly 95% of the time the U.S. stock market has shown gains. And if we go over 20 years, the stock market has never had a loss over 20 years. So the longer you extend your time horizon, the less scary it's going to be. Unfortunately, sometimes it's really, really hard to look away. And so, I think especially if you're young, just not looking at your retirement balance, if you're saving for something that's 10, 20, 30, maybe 40, even 50 years off into the future, it's one of these things where the fewer times you look at your balance or your statements, the better off you're probably going to be. Now, when we think about, okay, so what is a risk in terms of animals? It's kind of interesting that the deadliest animal is actually something that you'd never even think of. It's a mosquito. And you can see shark way down the list in terms of, this is a illustration by Bill Gates, and he shows, this is from 2015. Mosquitoes killed 830,000 people. In 2015, shark attack was 6. And so this is kind of the way that risk works in the market as well, where the risks are kind of the stuff that you don't think about or you don't see. It's not the stuff that you really worry about. So a lot of people worry about the short-term volatility in the stock market. That's technically not your biggest risk. It's more the stuff you don't think about. So there was a guy, political scientist from Ohio State University named John Mueller, and he talked about, after 9/11, people became really scared of terrorists and what they're going to do. And if you look at the averages, Islamist terrorists have killed about 7 people a year within the United States since 9/11. Obviously, all those deaths are tragic. But over that same time frame, lightning kills 46 people a year. A deer running in the road causing an accident kills another 150. Drowning in the bathtub kills 300 people. Yet obviously Americans fear terror much more than they fear drowning in the bathtub. And so I think it's just one of those things where we have a hard time understanding probability, especially over the long term when these short-term fears crop up. And I'm sure from this pandemic, we're going to see a lot more of these other unintended consequences like that, where people are scared of things that they maybe shouldn't be. And that's just kind of the way that human nature works. So the way that to think about risk in terms of your portfolio, I like to use this example from Dr. William Bernstein, who was actually a former neurologist who decided to study investing because he didn't have a handle on his own finances, and he became a well-published author and investment thinker. And if you you're interested in learning more about him, his book, The 4 Pillars on Investing, is a classic. But he came up with this concept of deep risk versus shallow risk. And he said, risk comes in 2 flavors. Shallow risk is this loss of capital that recovers relatively quickly within several years. And then deep risk is a permanent loss of capital. And of course, shallow risk is what we had happened earlier this year. The stock market fell 35% over the course of 4 or 5 weeks. And then over the course of 7 or 8 weeks, it recovered most of that, and it was up 40-45%. Now, typically the stock market doesn't always recover that fast. The average bear market could take anywhere from 12 months to 36 months to recover, sometimes even longer than that. So this year has been pretty unique in terms of how fast things have been happening. But the way to think about it is shallow risk, while painful, it deprives you of sleep. It's this deep risk that is more of a permanent loss of capital. And he lists 4 main causes, and it could be something like hyperinflation or prolonged deflation or devastation, which would be like a geopolitical disaster or war or government confiscation of your assets. So the way to think about this really is, especially young investors should welcome something like shallow risk. So if you're a young investor, you have 10, 20, 30, 40 years ahead of you, shallow risk is it should be your base case, and it should be one of your best case scenarios in terms of deploying capital and savings. So if you're saving on a regular basis, you almost want to root for lower prices, because assuming you can keep your job through the hard times like we've had now, deploying your investment capital when prices are lower, that's a good thing. If stocks rise over the long term, but they fall over the short term, you're able to buy in at lower prices and higher dividend yields and lower valuations when stocks fall. I know it can be scary sometimes, but that's kind of the way to think about it. So the question is, so what is your risk? So, and the way that I like to think about this is your true risk. So, really two questions. Are you on track to achieve your financial goals, whatever they may be? And then the question for risk is, how do you minimize that risk of not achieving your goals? So, your true risk is not something a politician does, or tax policy, or market volatility, or bear markets, or recessions, or interest rate movements. It's this idea of, people are more concerned with getting rich with their money, but the really important thing is to minimize the chances of not dying poor. And I think that's one of your true risks that a lot of people don't think about. And the way I like to think about this is through the investor life cycle. So a lot of the concept of risk really depends on where you are within your investing life cycle. And so risk means different things to different investors depending on their time horizon and risk profile. And so, when you're just first starting out, time is your biggest asset. So when you're an older investor, you probably have more financial assets. So obviously baby boomers have much more financial assets than people who are millennials or Gen Z. That's just because they've had longer to save and make money. And so they have a higher financial asset. Their biggest risk is outliving their money. So they are at the point where they don't have as much income coming in. They don't have as much time to wait out a nasty bear market, and they don't have as much savings to put in when stocks fall. So they really have to take care of their financial assets. And diversification probably becomes more important for those investors than it does for younger investors, who their biggest asset is human capital. So that's not just, people worry about their investment portfolio, but you also have to, especially as a young investor, think about your job portfolio. And that's what human capital is. It's your future earnings and how you take care of your career. And so your biggest risk as a young investor is really just not saving enough, because you have your biggest asset really is time. So, Warren Buffett is one of the richest people on the planet, depending on what time you look at the Forbes list. He's in the top 3 or 5, I guess. I'm positive he would trade a lot of that money to be younger again, because all these young investors have something he never has, and that's human capital and time. And when you have time on your hand, you can allow compound interest to do a lot of the heavy lifting for you. But that's assuming you save and invest your portfolio in a prudent manner and put it away. So, I think about this as young people should really get on their hands and knees and pray for a bear market, because if they're willing and able to save more, that's actually a good thing for you, because you get to, again, put your money to work at lower valuations, higher dividend yields, lower prices. It's funny because the stock market is one of the few places where when prices go on sale and they go down, people run out of the store, which is kind of wild. Obviously, maybe that hasn't happened as much this year because things came rushing back so quick. But, and then older investors have to be a little more thoughtful about how they diversify their assets, because they don't have as much time to ride out a brutal bear market. If it lasts, 12, 24, 36 months, they have to have some other assets that can, help them with their spending needs. So the question is, how does diversification within a portfolio actually work? Now, in theory, this is one way that portfolio diversification works. Let's see if I can get this video going. So I really like this visual. Now, there's this concept developed in the 1950s by a guy named Harry Markowitz. In 1952, he published this piece called Modern Portfolio Theory for the Journal of Finance. And I like the way that this illustration works with the pool balls here, because the way that you think about modern portfolio theory within a textbook is you have all these assets and they move in different directions at different times, and you calculate their correlations and their variances and all these crazy math terms, and you get this perfect, synthesis of a portfolio that moves in different directions. Unfortunately, the real world doesn't always work like that, where you have an asset that has characteristics that stay the same over time. And Markowitz himself, actually, it's kind of funny, he developed this theory where you use these covariances in these efficient frontiers, and that's probably a little too high level for this discussion. But it's this applied mathematics. And someone asked him one time, when you created your own portfolio, did you use this modern portfolio theory to create it? And again, this was just a theory. It wasn't something that had to be put in practice, but it really changed the way individuals, and especially larger investors like pension funds, manage their assets. Because in the past, they would have them all in safe bonds, and they didn't really have these different assets that could work differently in different environments. And so someone said, did you take this mathematical framework for assembling a portfolio of assets and figure out the way that the expected return should be for a given level of risk? And Markowitz said, I should have computed the historical covariances of the asset classes and drawn an efficient frontier. But what I actually did was I visualized my grief if the stock market went way up and I wasn't in it. And then I visualized my grief if the stock market went way down and I was completely in it. What I did is I just split my contributions 50-50 between stocks and bonds. So, the essence of portfolio construction is really just a combination of different asset classes such that they move in different directions, at least some of the time. Not all the time like this video would show, but at least some of the time. And I think that, perfect is the enemy of good a lot of times when constructing a portfolio, because a perfect portfolio, only exists in hindsight. There's no such thing as a perfect portfolio now that you can put in where things are going to move in concert like this. So this is an illustration of diversification I like to use. This is an asset allocation quilt. This is a bunch of different asset classes. So this is large cap U.S. stocks, small U.S. stocks, mid cap U.S. stocks, real estate, emerging markets, foreign stocks, all these different asset classes. And you can see this is segregated out by year. So this is from 2005 to 2019. And the different colors showing each asset class. And what it does is ranks them by year. So the best performers on the top, worst performers on the bottom. You can see, you could try to draw an algorithm here and come up with a pattern, but there's really no rhyme or reason from year to year, and that's kind of what diversification is all about. You're really giving up the ability to hit home runs, but you're using that giving up on home runs to avoid striking out. So it's accepting good enough just so you can avoid terrible. So I'll use an example here. This blue line here, if you can't read that, that's emerging market stocks. So you can see in some of the years, 2005, 2007, 2009, it's one of the best performers. In other years, 2018, 2008, 2011, it's the worst performer. So if you had all of your money in emerging market stocks, you'd have the highest of highs and the lowest of lows. Now, some people can withstand that type of volatility. I don't know too many people who can. So if you have an extreme portfolio with no diversification, you could be all over the map. You could be the worst performer one year and the best the next, or the middle of the pack. Now, what if we take more of an asset allocation approach where this is just an equal weighted version of all the asset classes in here. So I took all these asset classes and put them together, and you can see, you miss out on the highest of highs, but you also miss out on the lowest of lows. And if you look at the total return over the course of it, you get kind of something in the middle here, and then you get it through a lower volatility. So you actually get a little bit of a less bumpy ride. So instead of having these extremes, diversification really allows you to have a less bumpy ride. It should give you a higher expected return for a given level of risk. And that's kind of the magic of diversification, that, you lower your volatility and have a less bumpy ride over time. Now, this is another way to look at it, because the problem with thinking extremes in your portfolio is that you could have a really bad decade. And so this is the lost decade from 2000 to 2009. And the reason it's called that is because, again, the S&P 500 finished with a negative return. So on a total basis, the S&P 500, which is the largest U.S. stock, it's kind of the proxy for the overall U.S. stock market, lost 9.1%. Now you can see some of these other asset classes. Foreign stocks did a little better. U.S. small cap stocks, bonds did a little better than that. Emerging markets had a really good decade then. REITs, which are real estate investment trusts, which is a way to invest in commercial real estate, and then U.S. small cap value, which is just smaller, lower valuation stocks. Those ones had a great decade. So if you were just in the S&P 500 for that decade, you felt awful. If you had a more diversified approach and you had a little bit of your portfolio and some of these other things, you did pretty well. Now let's look at the other side of this, where this is after the lost decade. So 2010 to 2019, you can see it's completely flipped. The S&P 500 went from a loss of 9.1% to now the biggest gainer at, over 250%. Some of the other winners came back down to earth, emerging markets. The problem with diversification, it's kind of one of these things, like it's the best way to invest, except it's one of the worst ways to invest, except for all the other ones, because there is no perfect strategy. So it really means always saying you're sorry, and the fact that there's always going to be something in your portfolio that you hate. So here, why would I ever invest in the S&P 500? Why would I have my money in small cap stocks? And then here it's, oh, this is great. The S&P 500 was the best. Small cap stocks came back. Some of these other ones did worse. So the problem is we just never know what is going to be the best performing asset class in a given year. So, or a given decade even. There's really no way, no rhyme or reason to pick it. So that's why we diversify, because we don't know. And this is also why looking at your portfolio in the rearview mirror to make your decisions is a terrible way to invest, because if you said here, why would I ever invest in the S&P 500? It did terrible. Then you look at what happened the next decade. People are probably saying the same thing. Why would I ever invest in emerging markets? and they forget that in this decade it did really well, but now it's done horribly. So that's one of the reasons why it's so hard to just pick the best performer. If obviously there would be no need to diversify if we could just pick the best performer every year or decade. But unfortunately, investing is not that easy. So for anyone who doesn't know, and I've yet to ever meet anyone who knows, what the best performer is going to be over a given period of time. That's why we diversify. One other way to think about diversification that I think makes sense, especially for people who are going to be net savers, is just this idea of diversifying across time. So if you're someone who, some people are lucky, they may have a big lump sum, they get it through an inheritance, or they get a bonus at work and they put it to work on whenever they get it January 1st and let it ride through the whole year. Then they get the whims of the stock market. But if you're like a normal person, you're probably saving every time you get paid. So what I did here, I did this a couple weeks ago. So these numbers are a couple weeks stale. They're probably a little higher now. But what I did is I decided to look, what happens if you get paid every Friday and you decide to put, a couple $100 out of your paycheck into the stock market in the form of an ETF or something. So this is the S&P 500. And this is by week. So every Friday, you put a little bit of money into the S&P 500. And this shows what your returns would have been like this year alone, just investing on the end of the week. So you can see how wild this year has been in the stock market. So if you're investing in January and February now, you're down a little bit. If you're putting your money to work in March, which is the middle of the chart here, you're pretty happy. Stocks have gone up big. So this is one of the reasons why diversifying across time can also be helpful, because, dollar cost averaging is one of the most effective ways to manage risk of a bad outcome. And the great thing is a lot of people just have to invest this way because that's how they get paid. And so the great thing about dollar cost averaging is, you're buying fewer shares when stocks are going up, but you're buying more shares when stocks are going down and prices are going down. So it's really a way to balance out your risk of having a bad outcome by just putting it in at any one point in time. So diversifying across time with your savings is also something that can be helpful. So just before I get to some questions, I just wanted to go through, some things to think about before diversifying your portfolio. I think it's always helpful to understand why you're investing in the first place. What are your financial goals? I think that really helps you define what your time horizon is, what your risk profile is. How you invest should depend a lot on what your age is and what your goals are. Are you saving for a wedding? Are you saving for a house down payment? Maybe you want to be a little safer with those assets in cash or bonds, or are you saving for retirement and you can take a little more risk in stock? When do I need this money is a great way to think about your time horizon. Do I need to spend it within 3 to 5 years? If that's the case, the stock market is a pretty risky place. If you need to spend it in 10 plus years, the stock market has tended to give you much better outcomes for something like that. What is my willingness, ability, and need to take risk? Obviously, everyone's circumstances are different. So no two people are going to have the same exact risk profile or time horizon. And I think really figuring out the balance, and of course, sometimes it's hard to really figure out what the middle ground and equilibrium is for that willingness, ability, and need to take risk, because there are no perfect answers. Sometimes these things are competing with one another, but really understanding yourself and especially your lesser self and what some of your behavioral foibles are, and where you stand financially and where you want to be, it can be helpful. How complicated your financial life is, I think that's a big thing in terms of setting the right portfolio, and then figuring out how to focus on what you can control, because there are so many things out there that we just don't control. Like we can't control tax policy and who the politicians are and the president. Sometimes it's not always up to us individually, but there's a lot of things you can control, like how much you save, what you pay in fees, these types of things, how diversified your portfolio is. So that's what I think really helps when setting up a portfolio, is just focusing on the things you can control and trying to forget everything else. Before I get to some questions, just wanted to give, if you're not familiar with me, if you want to find me, I got a weekly podcast I do with my colleague Michael Batnick called Animal Spirits. I've written a number of books. Probably the most popular one is called The Wealth of Common Sense for individual investors. And then I have a blog by the same name called The Wealth of Common Sense that I write a few times a week on, if you want to know what my thoughts are on personal finance in the market. And now I think we've left plenty of time for some questions, so I'm happy to answer if you have any questions for me.
Yeah, thanks, Ben. That was a really great conversation. I think dropped a lot of knowledge on our viewers, which is really great. We love that. We did get a bunch of questions, so I will just start throwing them at you. First up is John Shuk. What are your thoughts on alternative assets? Museum-grade cars, collectibles, art, watches?
I do think that's an area where people are going to have the opportunity to invest in the years ahead. They're making it so you can buy fractional shares in these things. I think I would tell people to make sure they have their financial house in order in other ways before, have some retirement assets and regular assets to set aside, an emergency fund and that sort of stuff before venturing out into alternatives. I think you really want to understand what you're getting into and understand how these assets work. But I think it is interesting that this stuff is becoming democratized and easier for people to invest in. I think I would make sure that you have everything else, zipped up first and then use some fun money for that stuff, though, I think, before really diving in deep.
Yeah, I agree. Jesse Rosenstock, Ben, earlier we talked about a 60-40 or 70-30 portfolio. What are your thoughts on applying that to a 401k, personal brokerage, and other retirement accounts? My 401k is already diversified in a 2050 target date fund.
Yeah, honestly, I think a target date fund is probably the easiest choice for people who just want to keep their life simple and not have to rebalance on their own or make any changes. I think it's one of the better retirement vehicles that we've had created in the last couple decades, because it just takes the behavior out of the equation and it does it for you. Because a lot of times, people think that their willpower will win out and they'll just do it on their own. But a lot of people just don't have the ability or the foresight to do that. And if you're having someone else do that for you and taking yourself out of the equation, I think makes a lot of sense.
Fair enough. Ronnie Nicky says, what are the pros and cons of investing in physical real estate versus REIT stocks in the REIT sector?
Yeah, I think it's much easier to become diversified in something like REITs. It's a lower cost. It's probably fewer headaches. If you're investing in actual real estate, it's much harder to get diversified unless you have a huge amount of money to put into place. I think you're taking bigger risks in real estate. There's probably bigger returns available because you have the leverage involved. But for anyone who's ever owned a house, you realize that there's a lot of ancillary costs involved, taxes and upkeep and maintenance. And so I think you just have to be ready and willing to be able to take care of those things, which, just as someone who owns a single home, that's a lot. So I think diversifying into something like a REIT is just much simpler and easier. It depends how complicated you want to make your life.
Connie says, how do we estimate times in the market to move between stocks and bonds for max long-term savings?
Yeah, I think a lot of it depends on, again, what your time horizon and when you need the money. But if we're talking about an asset allocation that you've set up, if you set up a 60-40, 70-30, 80-20, 90-10, whatever it is, then figuring out some sort of set rebalancing schedule. So that could be, you could set a band on it. If stocks move a certain percentage, you'll sell some stocks and buy some bonds. Or you could just set it automatically and say every year on January 15th or on my birthday, whatever it is, I'm going to get back in line with those stated weights, and that's kind of a risk thing. So I think it really depends on, again, when you need to spend the money, and then if it's retirement assets, then it's figuring out a set schedule. Now, it could be every year, it could be every 6 months, it could be every 2 or 3 years, just as long as you have it periodically set up to do it all the same and make it a rules-based framework.
Yeah, makes sense to me. JS says, Ben, gold is one of the traditional inflation hedges, but could Bitcoin have any value as a portfolio hedge as a new age gold?
I think
that's a lot.
Yeah, it's certainly, I certainly put it in something of a non-correlated asset, and that it has its own characteristics. Now, of course, there's no cash flows to deal with, there's no dividends or income payments. So much like gold, you're dealing with an asset that is going to be very trend based, and it's going to be what people think about it. So it's hard to say, put all of your assets into something like that. But as a I think having part of your portfolio and something that's fun and speculative, if it's a small amount, 5 or 10% of your portfolio, if you want to have some fun, I see no problem with that.
All right, Monica M. When should a person consider giving up on diversifying by themselves and pay for an active manager? That's a great question for you.
Yeah, I think when your financial life gets complicated, or when you just don't have the time or energy to do it yourself. So a lot of people that come to us as clients, some of them just have such complicated financial planning lives that they need some help, and they need advice on taxes and estate planning and all these things. And other people come to us because they just have more important things to do with their life, and they just don't want to do it themselves. And they say, you know what, I'm just going to outsource this. My time is more valuable doing other stuff, and I just don't really care about it. So it really depends on how complicated your life is and your finances are, and then how much you really just don't want to have this on your plate.
Yeah, for sure. All right, Andrew Cam, what are the pros and cons for investing in an ETF versus a mutual fund? And are there options for both that follow the S&P 500?
Yeah, and that's probably one of the most widely tracked indexes you could find. I'm sure you can find, and you can get it for pennies on the dollar in terms of cost. ETFs allow you to trade during the day. So if you wanted to trade at any specific time between 9:30 and 4 p.m. Eastern, you can trade an ETF. Mutual funds, you can only buy or sell at the end of the day, and they give you the net asset value at the end of the day. Over the long term, it's kind of a wash. ETFs probably have a little bit of a lower cost than mutual funds, even though the mutual fund costs are coming down. But if you found a mutual fund or an ETF that tracks the S&P 500, it's going to give you a pretty similar return, less the cost. So the biggest probably con with an ETF is that because you have the ability to trade during the day, it might be more tempting to do so. And so you could eat up any gains with, a bad buy or sell, whereas a mutual fund, you can't be trading as much.
Right. Okay, next up, Alan, with U.S. government bond yields low on a nominal basis, does it make more sense in this environment to select U.S. bonds, or in this environment, if selecting U.S. bonds, to consider TIPS, which is inflation-protected U.S. bonds?
Yeah, I certainly think diversifying within your bond portfolio makes more sense now than it ever has in the past, because in the past, you could earn much higher returns on your bond portfolio and not have to worry about it. You could actually do the old thing where you live off the interest on the beach, and now that's just not the case anymore. So as I said, inflation is one of the risks that could rear its ugly head at some point. It hasn't been around for a while, but investing in TIPS is probably one of the most unique assets there is, because it effectively gives you a one-for-one hedge with inflation. So if inflation goes up, your bond is going to go up as well. So I think it is one of the more unique real assets out there that's different from a lot of other bonds.
Yep. Eric, I'm not going to say his last name because I'll butcher it. How do you think the market will be impacted if the Fed took rates negative?
They said they're not going to. I don't know if it's a psychological thing. I don't know if it really matters at this point. The difference between 0% and -1% or whatever, I don't know if it would really matter at this point. They've got a lot of tools, and the Fed has certainly had a big psychological impact on the market. But I'm not sure the market would really care that much. It would obviously hurt your savings account a little bit, but I don't think the market would really care all that much, because I think rates are already on the floor as it is.
Yeah, I tend to agree with you. Makes stocks look more attractive too, right?
Yeah.
Cal McNeil, when should bear market stocks be considered aggressively? This is probably a lot of what we've been seeing in the marketplace with the cruise lines and the airlines.
Yeah. So it typically happens where when a bear market starts, you'll probably have the high quality stocks do really well when stocks are falling, and then the low quality junk stocks will get hit the most. And then when the bull market rallies, we see these junk stock rallies or low quality rallies, where those stocks that got hit the hardest, if it looks like they're not going to go out of business, they'll see a huge rally. And that's what we've seen in recent months and in weeks. But obviously the problem there is trying to time the bottom and pick when that's going to happen is much easier said than done. And now that we've already seen this big thrust higher, the question is, does it keep going, or do we peter out a little? And so that's what makes it tricky, is you just don't know how far these things are going to go.
Can you, Joshua Chappell, can you talk about why, in your example slide, REITs seem to perform very well in both 2000 through 2010, the last decade, and 2010 through 2020? That really stuck out to me, he says.
Yeah, good question. I mean, sometimes it's just luck of the draw, where it could be just the points you chose, because obviously during the 2006, 2007, when the real estate market blew up, REITs got hammered and they fell close to 70%. They just they had done so well before then, and after the crisis that they recovered. And REITs are an income producing asset. So the fact that interest rates have been falling has made them more attractive to investors. So it was more of what was happening in the market dynamics for that period that they did well through both decades. And obviously those two lost decade slides I showed, not always the norm where you have just a really bad decade followed by a really great decade. It could be somewhere in the middle, and REITs having, two good decades in a row has happened in other asset classes too. I guess it just depends on which decade you're looking at.
Yep. Timing is everything, I guess.
Yep.
Andrew Cam Watt, what about tax advantages and disadvantages between ETFs versus mutual funds?
Right. If you're holding your money in a taxable account, it really depends. If your ETFs give you a little bit better tax treatment as long as you're not trading in and out of them. If it is an index mutual fund, you probably don't have to worry about that too much, but that's certainly something to think about depending on if you're having this in a 401k or a brokerage account. That makes sense that ETFs have bigger tax advantages than mutual funds.
Right. Okay. And last question from Julia Asante. Please, could you explain valuation and how it's calculated?
Sure. There's a number of ways. Any sort of fundamental you can think of, earnings, book value, sales, growth rates, any of these things. So unfortunately, there's not one really fundamental you can look at. It's a bunch of them. And so not really easy, but if there was a simple way to calculate valuations, maybe the market would be easier, but there's a million different ways to do it.
All right, Ben, thank you so much for your time today. We really appreciated your presentation. We had great questions from the viewers, and keep it up, guys. Keep the chat going. You're being very conversational. We love it. You could follow Ben on Twitter at, what is your Twitter handle, Ben?
Oh, it's at A Wealth of CS, and then just awealthofcommonsense.com is my blog.
All right, and we're going to take about a 5-minute break before we have our next presentation at 12:05. It'll be a fireside chat about addressing the wealth gap head on. Welcome back, everyone. You are in for a real treat. We have our president of Ally Invest, Lule Demmissie. She is going to be interviewing Anna Giaconti from Dare to Dream. She's the founder there, and they are going to talk about combating the wealth gap head on. What a timely topic in the environment that we're operating in. Remember, before I turn the show over to them, just remember to ask questions in the chat box. Again, you guys have been wonderful, very chatty throughout the whole day. Keep it up. These two lovely ladies are going to answer your questions live at the end of their fireside chat. So without further ado, Lule, I'll hand it over to you.
Thank you so much, everybody. Thank you. I hope you've been enjoying that phenomenal job our teams have been doing to try to break down investing and the basics. This afternoon, we wanted to give it a slightly different tinge and kind of talk about what's in the now right now, which is how to broaden the investment conversation so that people who are not traditionally taking part in the markets and in the benefits of what investing can do and wealth management can do for them in helping them sort of close that gap, right? We will talk a little bit about statistics. I'm supercharged and excited to have Ananjanta Conte with us, and she's obviously going to correct my pronunciation of her name. As a person whose name is Lule Demmissie, I know how that goes. But we're excited. She's a renowned financial advisor and doing some really interesting things in specific segments of our society that really have not been as included in the wealth conversation, and how to bring those stories in, and not only looking at the statistics around it, but really also just bringing in the stories and the know-how that comes with it, so that the investing conversation broadens out for many instead of few. So I'm excited to have you with us, Anna.
Thank you. I'm so excited to be here. This is going to be really fun.
Fantastic. Now, let's start off with, and by the way, everybody, ask your questions as we go along, and I'll pepper in my own questions with anything that folks have ask us as we stream as well. Anna, tell us a little bit, get started with, who you are, what your business mission is, and what really sort of drives your ability to bring wealth and to individuals who are not included typically.
Yeah. So thanks again for having me here. So I'm the founder of Dare to Dream Financial Planning, which is a comprehensive financial planning firm that focuses on millennials of color, and specifically women, because they have a soft spot in my heart. And I founded my firm late last year with the mission of bringing an understanding and a more nuanced approach to wealth management that applied to Black and Brown communities nationwide.
Mm-hmm. And tell us a little bit about your background. Where'd you grow up? What brought you
Sure.
to this?
So I grew up in New York City. I'm first generation American. So my dad is from the Gambia and my mom is from Puerto Rico. And so, I grew up like very solidly middle class, but without a very good understanding of finances and how to manage my finances and how to create financial stability for myself. And I think part of that is, just my parents were figuring things out too. And so it was just natural that they didn't have a lot of knowledge to pass on to me. And, I always felt really lost around finances, but it wasn't until I came into the financial planning profession in 2010 that my eyes were opened and I really saw that there was so much knowledge out there and there was so much that I had to learn. And I wanted to find a way to bring that to people that were like me.
And it's no secret that our industry still doesn't have enough people that look like you, right? Tell us about what made you think to yourself, I'm going to go into financial services and advise people.
Yeah, it was very happenstance. I always joke that like I had no idea this was even a job up until like after I graduated college, and I came into it through my first job out of college, and I really, you know, I just felt like my personality, I'm a problem solver. I like to help people. I like to, look at different pieces of a puzzle and figure out how it all worked together. And all of that kind of led me to this profession. And I think it's a good fit for my personality and then my skills, that I have. I'm good at math too, so that doesn't hurt.
Mm-hmm. So let's get the obvious out of the way, right? So the question is going to be like, why only show millennials of color and women, especially? Like, why not include other people? How fair is that? Tell us a little bit about, why focus in?
Yeah. So, well, I mean, I think given that I spend so much time doing what I do, right? Working, I wanted to do something that I found interesting. And, I'm a millennial woman of color. I find it really interesting and challenging, with people are in this season of life and they're hitting their stride in their career, but they have some kids and they might have some debt and they have all of these goals and they're trying to figure out the best way to set up their finances to lead to long-term financial success. And the question about, is it fair or is it biased or, it's funny because the wealth management industry completely ignores this segment of the population. So it's like, well, if everybody else is not talking to these people, I don't think it's unfair for me to be the one talking to them.
Touche.
Yeah. So,
Yeah.
I mean, we know that they focus generally on people with large portfolios, and that's not necessarily, I mean, most 30 and 40-year-olds don't have very large portfolios, period. But
Yeah.
that's even more exacerbated for communities of color.
Yeah. Get a little closer to your mic because your mic is going in and out. But so let's get some of the stats sort of out of the way. So these are real gaps, and no doubt whether you cut it by assets in terms of wealth gap between rich individuals versus people who are more economically challenged, or whether you're looking at it through the gender gap, it still remains an 80-100 sort of like equation in terms of, how the gap exists. And that is further exacerbated, back to your point about populations that are either Black or Hispanic and women. And then when you look at leadership, right, the representation in leadership is also, it thins out as it gets higher. And then, even if you look at it through other lenses, and we have some stats here on sort of wealth gaps through other ways, tell us how you turn this, like what seems like an insurmountable societal structural block, if you will, because one person arguably can feel overwhelmed by that, right? It's somebody else's large policy problem to fix, right? How do you make it smaller so you can widen the tent of financial wealth building for individuals who belong in this group?
Yeah, I always say like those issues are, while I'm aware of them, they're above my pay grade, right? So I am focusing on making the concrete changes person by person that can lead to a more solid financial foundation and building wealth. And I know, based on my personal experience, but also just dealing with my clients, that when women, and particularly women of color, like we are so often so very family oriented that like when I help one woman get her finances together, that's a ripple effect, right? And so, if I can create as much impact on the individual level, my hope is that that spreads out and touches way more lives than I'm personally speaking to.
Not everybody appreciates that narrative that you just said. When you help the woman in the financial situation, it helps a village, right? It helps the broader. Give us a concrete example of how you have advised and helped people in your client base that you've seen sort of this echo effect on either their immediate family or their community.
Yeah. In particular, I think I have one client who she's just like a beautiful person, but she has adopted some extended relatives, and she's a single woman, and by helping her, and she's lifting those people up, she is really like the matriarch of a family, even though she's relatively young. And so by helping her, I see I'm helping her adopted family and then also their children in a way that is very I can see the impact there, right? Like as she is able to say, I'm financially stable and I feel comfortable in my finances and I've established that foundation, now I'm able to better help these other people as well.
Yeah. Let's dig into that, because I think that this is a challenge that happens a lot for people who come either from economically challenged families when they're the first, right? They could be like 17th generation American, but they could be the first that went to college or to get their degree in higher education, or it could be because they're first generation, right? The first, let's just call them the firsts. The firsts have unique challenges, both real ones and psychological ones. Let's dig into that a little bit. Like, what have you found about your customers who are the first, which I assume are many among them, in terms of, for instance, how they choose between building wealth for themselves versus giving away to family?
Yeah, I would say that they often defer to giving it all away and helping to their own detriment. I see that time and time again, and I think a lot of the ways that pressure manifests is in guilt, guilt in keeping something back for themselves. And I can say that leads to them putting themselves in a compromised financial position oftentimes. They give it all, and then when they need help, there's nobody there to help them. And so it's like the house of cards come crumbling. And a lot of the work I do is talking to clients about making sure that they are set. It's not selfish to make sure that they are set, because the reality is if something happens to them, then later on down the line, nobody's there to help them or everybody else once they're not around. It's
true. So
mindset shift.
Yeah, it's true. And it's sort of like people focus on leaning on the strongest, and when the strongest falls, then it's really hard for the rest, right? We've got here some of your life hacks in front of us, and I'm actually going to not go one by one, but you say pay yourself first, right? And I think it relates to this topic we talked about, the firsts and how they're challenged with being able to pay themselves first, whether that's the reality of the money being needed or guilt, right? I know, I'm sure you can relate. I've felt the guilt. I'm one of the firsts, right? And so how do you help your clients psychologically be comfortable with paying themselves first?
I think we do a lot of mindset work. I think, like I said, reminding them and that when they're solid, that helps everybody else. But I think also just putting the numbers to things is really important. So showing them longer range projections, let's say keeping in mind some family support and some of these other dynamics that I know are oftentimes inevitable. By showing them those real financial projections, I can say, okay, if you dial back the support and let's say invest that money or make sure that you have a what I like to call, I don't have to deal with this fund instead of an emergency fund. But by doing those things first, and then setting guardrails around the support and making sure that it's still built in so that you don't feel extreme guilt. I think by showing the concrete numbers, that really drives home that they'll be in a better position in the future as long as they put a little bit of a guardrail around those things.
I like that. So almost like, back to your second point of bucketing. Maybe one of my buckets is the help family bucket. So it doesn't always feel like it's depleting the core that I can keep building. Is that kind of what you mean by the bucket approach also?
Absolutely. So, I generally advise clients to do one of two things, but they need to have some kind of boundaries around it. I would say either saying that there are certain people that I'm going to help no matter what, which I think is a little bit more generous, or just saying I have a dollar amount that I'm going to do every year, and I'm going to put that aside. And when that money's gone, it's gone, and I'm not going to dip into the rest of it. I think it can be very helpful to have that mental accounting done so that there's not that uncertainty and feelings of instability that come with you have one pot and therefore everything has to come from there and you're not sure if it's enough for whatever it is that you're trying to achieve long term.
Yeah, totally makes sense. And what other ways have you found bucketing uniquely valuable to this segment of the population that you are advising?
Yeah, I think because a lot of us are newer to this traditional wealth management, financial planning field, we have a different approach to finances. So, we will just have a general savings account and everything comes from there, right?
Yeah.
Think of investing as buying a property, not necessarily building a portfolio. And so I think that having that separation can be helpful for kind of concretely tying things to specific goals. And by outlining and concretely tying things to those goals, it allows people to see the method to the madness, so to speak.
Yeah.
The reasoning behind it, and to track progress in a better way. Like I said, I was raised, you have a savings account, yes, but like you just throw the money in there and that's for everything all the time.
Yeah. Yeah. Look, I'm going to shift. By the way, guys, we can get rid of the screen so I can see her lovely face. But I'm going to shift now to the concept of sort of how, when you see your story, even in something as subtle as somebody advising you on money, when that person sees your story, how that actually can change your mental framework about thinking that you belong in that space, right? Like, I give this subtle example for people a lot where, when we were designing financial planning programs before in my, my prior work, just saying, just having the right pronouns in there, suddenly like it just lifts people's ability to be like, oh, okay, I belong here. And therefore they lean into it even more. How have you found by bringing people's stories in, whether it's the know-how they're bringing in or just feeling validated, that it has empowered them?
Well, I think having an example is helpful, right? They say that all the time in having it in your career, right? Having somebody that comes from a similar background as you can be very motivating, and it can introduce the idea that you can achieve that. And I think similarly from a financial planning and a wealth management space, seeing someone who has the knowledge that looks like you and understands your challenges on a really granular level, because I've lived them, or my husband has lived them, or friends or clients have lived them, and I see firsthand those challenges. I think that's really powerful. That representation, I think until you really see it, you as soon as you see it, you really feel the importance of that and just how that can really impact somebody. Because if they say all the time, like, I didn't know that somebody could make $500,000 a year until I knew somebody that made $500,000 a year.
Yeah.
I didn't know that a regular person like me could have $1 million portfolio until I knew that somebody else had done it. And so I think that that reflection is really, really powerful.
Yeah.
Yeah.
It's often said it's hard to be what you don't see, right? And I think that's what you're sort of articulating. Tell us a little bit more about other life hacks that you have found to be really valuable among your client base.
I mean, just generally speaking, I think automating your finances is really important. I think that, you get caught up in life and life passes you by. And if you are not in the habit of saving and investing, then setting things up automatically is a real game changer. Like you'll look up one day, years from now, and be like, how did this happen?
Yeah.
That's a lot more money than I thought before. I think that is really impactful, and it seems really like small, but
Yeah.
it has a real long-term impact.
Do you employ the sort of the set it and forget it logic in some parts of your customers' portfolios? Like studies we've done show that, folks who have really managed to build and accumulate some wealth, doesn't mean they can get to retire, but wealth to supplement them over, during their slowing down years, that you often find the root is either because family knew how to do this or somebody knew how to do this, but also that they created these small habits that were like invisible to them. Back to your bucket construct. Do you ever sort of employ the sort of set it and forget it mechanism in your advice to your customers?
Yeah, definitely. I mean, I am a big proponent of start somewhere. And I think a lot of times, in particular in our communities, because we're not as used to investing, we think we have to have a large sum of money in order to begin investing. Like I have to have saved $10,000 and then I can put that there. Well, that's a lot of money. And depending on your income and your expenses and your financial habits and your financial obligations, that can take a very long time to get there. Whereas, Lindsey was talking about earlier, the power of compounding, right? So if you are starting small, even if it's $100 a month or $50 a month, that adds up a lot over time. I think that is one thing. And training the clients that is long-term money is very important. Besides that too, I think I'm a big proponent of index investing, of passive investing. I think it is the long-term path to success for most people that don't want to actively monitor a portfolio. And so that is a bit of a set it and forget. We'll come up with your asset allocation and your goals at the front end, and then obviously we'll monitor as time passes. But we don't need to fool around too much with that, because the reality is that you're going to end up doing yourself more harm than good by touching your portfolio too much.
Yeah, no, for sure. Tell me, shifting gears a little bit on sort of just you and how you bring, one of the things that's fascinating for me is like when I go to different environments, so I'm originally from Ethiopia, but I'm a naturalized US citizen. Woohoo! But the thing that's interesting is like my story is not always common when I'm sitting around at dinner tables, right? In terms of what I talk about and who I look like and what I do. And it's always around me, the fact that I am an other with this story, right? How do you, I'm curious to know how you navigate, whether it's family gatherings or otherwise, when you talk about what you do, and do people try to get advice from you right then and there, or do they just feel like, I'm curious how you navigate your otherness, if you will.
I think it's more of I think the financial services industry has a bad rep. So I think when I tell people that I manage money, they're like, oh, I'm going to change the subject. Or like when people ask me, what do you do? And I say I'm a financial advisor, they're like, oh, did you see the weather? That was weird there. They just don't want to deal with it because it has this like icky salesy type of reputation, which is not my personality at all. But or it can feel really overwhelming, and they don't want to ask me questions because I think we're really self-conscious about our lack of knowledge, and therefore like we just don't want to ask questions for fear of sounding dumb.
Yeah. No, it's true. I've started this new thing. I don't know if you do this with my younger relatives, where I might have like a half-hour coaching session with them, where it's sort of like just trying to bring in some of those basic financial footprint things you need to do when you start out. And it's been so gratifying because I think one of the things that's really hard in this world where justice and equality feels like it's so big is like we forget that we should just, if we all individually also just make it smaller and impact one life at a time, it has such a humongous impact. I know that's what happened to me. Somebody invested in me, and so therefore I'm here, right? So, or many somebody's invested in me. Tell me about, so we've been talking about sort of seeing your narrative in whoever is providing you that service and how empowering that is, right? Now I'm going to flip the script a little because I'm going to ask you how somebody who has a completely different narrative than you, a different background, and what you've gotten out of that engagement in the context of financial planning. I have a story to share with you, but I want to hear yours.
Okay. Wow. I mean, I have to say that it was very shocking for me my first few years in the business. I don't have a specific instance, but I think my first few years were very shocking when I saw people with $50 million in a portfolio. And I was like, what? And they're not famous celebrities. They're just somebody with that nobody knows, but they happen to have $50 million. That was so shocking to me. And it really opened my eyes to the whole world that was out there. And it made me feel like that was possible for me in a way that I had never like even dreamt of long term, you know?
Yeah.
Like prior, like I just never, it's like my eyes just opened.
Yeah. Yeah. I mean, I think it's so interesting because on the one hand, many people's stories are not told in our industry. So one of the reasons I do stuff like this and shows like this is because I want to keep telling people like everybody belongs here. This is way too important. Wealth building and investing is way too important to not open the doors wide and teach people how they can do it and get a slice of what they can to accumulate their wealth. So I think it's really important to focus on narrative, but I also try very hard, it's something I struggle with to also remember to remind people that you don't have to be the other person to completely relate with them, right? Like I always tell this joke of like one of my favorite mentors was a Caucasian older man who was a country club member and loved golf. And he and I just got each other and had nothing to do with our identity. So I think one of the things I'm trying to always talk about is like there is a way to make room for people to tell their stories, but then also be able to connect to one another as people, right? So it's a cool time we're in our industry.
I think so too. I think that's very accurate.
So you had talked about earlier about how, people think that investing is so inaccessible, right? And either that's a psychological barrier or a financial barrier, right? Because there are other things that call on their pocket. But I want to talk a little bit about that because I think it's important for people to understand how much of the playing field has leveled these last 10, 15 years, right? In terms of access. So whether it's a brokerage account you can open with $0 or a robo that you can open with $100 or less, that you're being charged a de minimis amount of fees on, commission-free trading that started, there's just like this revolution of access. Now, it doesn't mean everybody can afford it in terms of what's in their pocket, but talk a little bit about how you encourage people to just come into this thing now because the barriers are so much lower.
Yeah, that is very true. I was just thinking earlier that, when I got started, trades were like $50 to $100 per security. And now most firms have zero trading or it's like next to nothing, right? I think we have to, I like to remind people that investing outside of a retirement plan at work can be more like that, right? So you can kind of take little chunks at a time every 2 weeks or every month and throw that into something very simple like a suite of mutual funds or a suite of ETFs. There are robos out there that are giving people this unprecedented access to markets and this way to kind of just check a box and you're able to you're just able to have the money invested and you don't have to think about it anymore. And I think that is really impactful. So I encourage pretty much everybody I talk to that they need to set up an investment account, however it may be. And there are all kinds of things like acorns, right? Where, not to endorse any specific products, but there are these things out there that, sweep $5 out of your account every day or once a week. And that can be a really impactful start. So I'm like with my bullhorn out here telling everybody.
Yeah. How has your practice and your approach been impacted by what we are living through now? What COVID environment has accelerated or, sort of harmed?
Yeah, I would say it's done two things that have been really powerful. One, I mean, because I operate on a virtual practice, everybody's online now. So it's allowed me, I think, to market myself a lot easier. But on a client level, I think it's really forced people, whether they've been impacted directly in terms of their employment because of COVID or not, I think it's forced people to really take a hard look at their finances. And I think that's a positive thing. I am all for people being more armed with information around their own personal finances, because I think it just is much more empowering and it relieves a lot of anxiety. But, I see a lot of clients reassessing spending and reassessing their goals, particularly, which I think is not, I mean, it can be harmful. A lot of them are looking at moving more to cash, or increasing their savings account balances because they're concerned about their long-term job security or just security in the economy in general, because this is something that came out of left field and just surprised all of us.
Yeah. And how do you, in terms of sort of your clients, best practices that you do, are you familiar with the movement FIRE?
Yes.
Do you utilize, first of all, let's just explain for the audience what FIRE is. So it is a mechanism and I would say best practices and a set of use cases, sort of best practices and community at large that helps people gain financial independence to be able to retire early if possible. But I think now that retire early has become sort of, do something early, whatever that is, right? Whether it's retiring or slowing down or following your passion and not necessarily doing the job for paycheck, right? Tell us how you think FIRE and some of its either community aspects of it or their tools is actually quite useful for folks who've not been involved in financial investing as much.
Yeah, I think I am very familiar with FIRE. When I first heard of FIRE, I was like, this is crazy. How can people save 70% of their income? Like I live outside the DC area, so that is like an impossible feat, right?
Yeah.
In major metropolitan areas. But I think going back to your point earlier about people being first, right? That is a really lonely space to be. And so FIRE has this whole incredible community around it. Now, granted, it's not a very representative community, but I think that's changing now. There are all kinds of blogs like Rich and Regular. I don't know if you've heard of that. They are, they're a Black couple. I think they live in Georgia and Atlanta, and they talk about their path to FIRE. But I think this community can be so helpful. And when you are the first person to pursue the path to building wealth or, in a meaningful way, it can feel really lonely. And there can be a lot of self-doubt and a lot of insecurity around like, am I crazy? Why am I doing this? Nobody else is doing this. And so you might not have that support from your network, your close network. But I think it's really important for people of color to pursue financial independence. I read a quote once and it said, all the problems you think are social problems are economic problems with social consequences. And that really struck me. And I was like, think about how many people would be better off if they had some money. And not to say that money is everything, but it provides a level of security and stability. And it means you're kind of protected from a lot of things that you wouldn't be if you had less of it. So I think for community of color, because we have this huge wealth gap, it can be a really meaningful tool.
Yeah. And how empowering it is to also figure out how to carve out that piece of wealth for yourself. I mean, one of the things that I find really, I used to be a financial advisor too. And one of the things that I found really amazing about getting on the path to financial independence, not necessarily it's not a destination, right? Is how incredibly empowering it is for the next step you take, and how liberating it can be. So it's a very noble profession that you're in my opinion. Tell me a little bit about, let's flip a little to sort of how in your culture or where your upbringing was, were there anything unique sort of best practices that you've brought into your practice? Like, for instance, I'll give you an example. In Ethiopia, we have this thing called, we used to have this thing called kubo. And it basically was like a mechanism where the community or a small set of family members or whatever would put money in a pot and it would come around, right? And then when it came around, you ended up paying either for your children's school stuff or their clothes, whatever it was. But it was a means of accumulating wealth periodically. And I loved Kubo, and I'm sure it still happens. And tell me a little bit about sort of what practices from your cultural background that you brought into financial planning.
That's an interesting one. I don't know that I have an answer off the top of my head, but I do know that in Gambia we have something called susu, which is like similar thing. A group of people, they put money together and it kind of circulates whenever there's a need, and everybody has their turn. And you can borrow against your turn as well if you have a need before you're up. I mean, I would say the one thing my culture is like very family oriented and very much about the community and the communal well-being. So I really encourage clients to continue that. I think a lot of the traditional financial advice is, based on the individual. And I think that's important. We talked about that at length already, but it centers on the individual and never takes into account the communal aspect. And I think that's where a lot of people of color, when they seek this traditional financial advice, they kind of run up against that barrier. So I've made it a point to make that, to really prioritize that with my clients and make sure that it is built into their plan.
Yeah. And what do you think about in terms of inclusion? There are folks, and we see some statistics in front of us here around the difference between unemployment and between race or and other factors, especially further exacerbated, obviously, during COVID because of the kind of jobs so many people of color find themselves in, right? How do you answer the question when people say, well, why not? Millennials are all going through that. They're all just getting started. They have no wealth. What's the distinction between of color and a millennial in the sense that they're both just getting started? And give us a sense of sort of why the distinction there, as in terms of focusing on millennial of color rather than millennials.
I think we have some of the same challenges, but I think that for communities of color, we are all either always in this there's a lot of talk about the sandwich generations, right? Like Gen X kind of being forced to take care of their kids and then also support parents. I think communities of color are oftentimes always sandwich generation, right? And so whether we are providing support right now or we are bracing ourselves financially or mentally to be able to provide that support in the future, I think that it's just a reality for us. And so, your average millennial, like white millennial or a more affluent millennial, might not have any money right now, but they might not be ever faced with the prospect of having parents or grandparents or siblings that they have to materially support on an ongoing basis and having that be a drag on their finances. It's just a different level of pressure, I think, that they don't have to face.
So true. So true. I mean, it is hard to talk generality because every individual story is unique, but there's no doubt about it. There's a trend here and it's not ignorable. I mean, I remember when I first graduated from undergrad, getting cash off my credit card to send home as remittance, you know? And I mean, that's just the reality of being that forever sandwich that you're talking about, which, you know, and I think, again, the more we talk about it, the more people will say, okay, you can still be this person and still pursue wealth through investing. Indeed, it is true. Tell me a little bit about your, let's go into some fun facts right now. What was your first security that you bought?
Oh gosh. So my brother-in-law is big in investing, and my sister is much older than me. So I was probably 19, going to college and living with her and my brother-in-law. And he made me set up a share builder account with my like little work study account. And I'll credit Edward for that. He's very helpful. And I think I bought Petrobras, I bought McDonald's, and there was another one. And so I bought into those three every month.
Mm-hmm. And then what was your first sort of time really applying asset allocation to your own wealth and not just simply securities?
Yeah. I
and diversification.
That was probably, I was about 4 years out of college. I was recently married at the time, and my husband and I, you know, he has his 401k, I have my 401k, and we opened up, you know, a joint brokerage account. And I think that was the first time that I had to figure out how to do all of this across these different accounts that weren't in the same place. And it was a bit of an experience, to be honest.
Are you your family's financial planner, or do you use somebody else? You are.
I am. Yeah. I am. So I do it all. My husband's always, I've floated the idea of hiring somebody, and he's like, well, isn't that what you do? We have a financial planner on call 24/7.
Yeah, you're like, that's what I do in the daytime. Can I get a break? Yeah. No, I am also. So I feel it. Do you ever do group sessions that are, you know, so when is your practice typically just one-on-one, or do you like teach families, or how do you do your sessions?
So I generally, if the client is married, I am insistent upon both spouses being involved in the conversation. It's very important to me. I haven't yet done any group, like extended family meetings, but I am actually looking at creating a space for women of color to come together and talk about finances together. So, you know, that'll be later this year, but it is something that I think is very important because it goes back to that community and that feeling alone conversation that we were having earlier.
Yeah, absolutely. I'm going to encourage our listeners here to start sending their questions, because I'm sure they have more questions than I do, and better ones for sure. So please do send your questions, and we'll be reading them out loud here and asking Anna about them. So tell me a little bit, Anna, about what was your breakthrough moment in entering financial planning and financial advice? Like when you felt like, I can't do this. And suddenly, boom, you were like, I could do this.
Yeah, I hit my stride, and I would say that really was to the credit of my boss. He was my boss for about 3.5 years, and I had already been in the business for a while, but he was very instrumental in putting me in front of clients and, you know, telling me, like, you clearly know what you're doing and you clearly have the technical knowledge. There's no reason why you can't also go in front of clients and present that and really take charge of the planning process beginning to end, obviously with some input from him, but he was very instrumental. And I think after about a year of his incessant prodding and pushing, I really felt that I got this.
Good for you.
Hey, Anna, this is Lindsey. I'm just jumping in because you guys are having such a great conversation, but we're running out of time, and I want to make sure we get to some of the questions from the chat box, because there are a ton. You kind of answered right there Mama's question about how do you find spaces to break into the finance industry, especially as a Black millennial woman of color. I'm passionate about private equity, and I usually struggle finding people who are like me. So I think both of you can probably answer that question. Anna, do you want to go first?
Yeah, and I'm so sorry, I don't see the questions on my side, so I'd be pumping them out if I could. But go ahead, Anna, take it away.
I would say it is very difficult, but there are some associations, like there's Quad A, which is this American Association of African American Financial Advisors. I don't know about the particular private equity space, but I think it's unfortunately going to be on you to find those people, because the financial services industry is not particularly diverse. I think there are some firms like Raymond James, for example, that are doing a really good job of really marketing to potential Black and brown employees, but it's an uphill battle, and we're at the beginning stages.
Yeah. And I would say, there are different, I feel like social media has totally transformed this, right? I feel like in the old days, you'd have to find out where these organizations are, but now you could just pump in, a question in Twitter and find several folks who are in financial services, and you can actually disintermediate it, because it doesn't have to be part of an institution anymore, right? Because they're just people like Anna, people like they're creating movements around them. And I actually think that that's where the future of the network is going to be, is these sort of regular people that create movements and networks around them. So, I mean, I can guarantee you, if you follow Anna or me and looked at who follows us and we follow, you'll already find like half the network you need to. And I think that's actually really true of any people that are trying to break in to something, is that if you rely just on institutional connection points, it's really hard, right? But if you try to find ways where the rules have been sort of leveled a little bit more, which social media definitely does that. Another is, obviously, there's some really interesting conferences that I love that you can go to that really break apart sort of what this industry is about. I don't have as much knowledge about the conferences on private equity area, but again, tons of organizations. If you are interested in also joining associations, like if you have an alumni association, I guarantee you that they have some alumni group that is focused on that. And I definitely think that's another really good starting point, because there's a generational commonality you'll find in your alumni network that also helps.
And just on the back of that comment, Lule, Red Door Financials asks, are you aware of any specific organizations that promote financial literacy within communities of color in an effort to reduce the wealth gap?
Yeah, none that stand out to me right now, but there are tons of them. Lindsey, you serve on one of them, obviously. But there are organizations that do this well. I do think, though, what we're talking about today is also empowering people to not only go to organizations, but to actually go to the suchandsuchcompany.com and research it. Like I'm basically calling out the call to be like, don't rely on institutions to disintermediate this for you, because this thing has been flattened. It's now up to us to go and research. So I don't know organizations offhand right now, but I'm happy to share them later. But more than anything else, I could not say this more. Research this through social media, or just going to the .com of financial institutions, whether that's Ally or any other institution that you have, and you will find that you don't need an intermediary as much as you think you do.
That's the truth for many people. And I think you're right, absolutely right. If people go out and follow you and Anna on social media, on Twitter, on LinkedIn, you're going to learn a lot just by following these two really smart ladies. Latoya asks, do you have any suggestions on how to break through the mental, emotional barriers our Black community and those in poverty have about money? You can't get them to open a bank account or save. How do we get them to think about investing if they're not going to do that basic first step?
Yeah, very good question. Anna, you want to take that one?
Yeah, I do. I mean, it is a hard one. I think there is a lot of stuff out there on money mindset and improving people's relationship with money, which I think is important. There's a book called Scarcity and Money, which I think is very important, and it was very impactful for me. But at the same time, that space is very has a lot of privilege kind of interwoven in it, and it's not so necessarily impactful. There is somebody I know who just wrote a book. Her name is Eugenie George. You can she follows me on Twitter. I follow her. She's amazing. And she just wrote a book. I think it's called Our Money Stories, and it talks about really dissecting our relationship with money to have better financial practices.
Yeah, I actually heard that podcast of yours. That was an awesome podcast. I would actually encourage people to listen to it as well.
Just a couple more questions. We're coming up on time. Anna, about your business, do you only work with millennials? Can you, if not, can you recommend someone that would work with baby boomer women of color? Do you work with men? There's a couple, I'm just combining a couple questions here. Yeah. And what is the average income bracket of your clientele? So we've got Donna, Latoya, and Melvin asking those questions.
Sure. So I do work with anybody. I mentioned before, I have lots of married couples as clients. So, obviously there's usually a man involved there. I don't have any gay couple clients, but whatever. Anyway, I do, generally speaking, work with millennials. The oldest age of my clients is somewhere around 50, mostly because I think I'm more focused on the cash flow and wealth building stages. But I certainly, there are lots of people out here. And if people want to follow me on Twitter, I can probably DM some recommendations based on the particular situation. And give them some folks that I think are doing a good job in that space too.
All right. And then Karina, to follow up on that, she says, we're thinking about hiring a financial planner, but we don't have a lot of money to start with. What are your thoughts on waiting till we're able to put more money aside? In other words, what's a good time to start working with a financial planner?
I would say, and actually I realized I neglected to answer a portion of the previous question. Average tax income of my clients is, I'd say, $75,000 to $400,000, somewhere around there. But I think I don't think that you have to have a lot of money to work with a financial planner. There are a lot of people that I think have a lot of complexity to their situation in terms of debt management, or they really want somebody to work with them in terms of their financial habits, and that can be very helpful. I think the traditional wealth management industry is going to want you to have a large portfolio before they'll even talk to you. But there are a lot of people out there like me that are working with people that are starting or kind of earlier on their journey. And they might not have amassed significant wealth already.
Great. Well, we're at time. Lule, I don't know if you have any closing remarks.
Thank you so much, Lindsey. Thanks for hopping in and showing us some of those questions. Anna, thank you so much for your time and sharing your stories and your pearls of wisdom with us. I highly encourage everybody to follow Anna on social media or other places. And as I said, it's a place where you can find a lot of thought leaders who are doing some really interesting things in investing in large and how to bring that broader family of folks into investing that have not typically benefited from it. I feel really strongly that telling story is one of the ways we welcome people into this landscape, landscape. So thank you, Anna, for sharing your story. And have a great rest of the afternoon. We have some amazing lineup of investing topics for you with Lindsey and others in the afternoon. So stick around because there's a lot to come. Thank you.
Thanks. We're going to take a 5-minute break and we will be right back.
Welcome back to the Ally Invest Digital Conference. Next up, we have Glenn Tompkins from VectorVest. He's going to talk about how to refresh and reset your portfolio. Now, Glenn has been an instructor for the past 16 years with VectorVest. He's taught thousands of investors all across the world. He was born in Brooklyn and has served our country as a U.S. Marine. He's actually used this background to apply timeless lessons learned in combat. He likes to discuss how to improvise, adapt, and overcome in the markets. These lessons are applied with the stock market with a playfulness that makes learning fun. And I'm going to agree with that. Now, that was a little bit of a canned intro on Glenn, but Glenn and I have been friends for a long time. We've swung a golf club or two. And I think if you looked in the dictionary next to fun, you might actually see a picture of Glenn there. I wouldn't be surprised. Even his title. Today, we're going to talk about diversifying and rebalancing your portfolio. But Glenn likes to title it Refresh and Reset Your Portfolio, Taking Gains and Cutting Losses. I think that's a great intro for Glenn. I know how fun and how much passion he has when he speaks. So without further ado, I'll pass you off to Glenn Tompkins. Hello, Glenn.
Hello, good afternoon. Thank you for having me here. Thank you, Brian, for that wonderful introduction. I do appreciate it. And we have swung a golf club a time or two, and it was a lot of fun. But today, once again, as Brian said, my name is Glenn Tompkins. I'm a senior instructor here at VectorVest. I've been trading with VectorVest or teaching with VectorVest for the last 16 years or so, and I love doing this. And I think that the title of today's presentation that I'm going to do is very on point with what's going on in the market. You need to know if the stocks that you're currently in are stocks that you should still be in. And if you need to reset your portfolio or get into new positions, how do you do that? So it's all about taking gains and cutting losses. So from this point, I'm going to get right into the VectorVest software. What we're looking at right now is the home page of the VectorVest software. There's a lot of things here, but right now I will concentrate on what's going on in the market today. As you can see, all of the major indices within the market are currently down. Well, what does that mean? Well, it means, first off, you don't panic sell. One day doesn't make a trend, but you are still going to be cautious in what to do and how to do it. Learning to take the emotions out of trading and start to initiate and look at some positive things to do or the right things to do at the right time. VectorVest puts all of that information in your hands. So a down day today, we have a color guard that we use like a traffic light. What's the main color you see? Yellow. What does this mean? It means to be cautious right now, but we notice that we have all three lights being represented in the color guard. I won't go over everything that's here, but just from a visual standpoint, this is a time to be cautious. All three lights are being represented here. The market's having a hard time getting a stranglehold on what it wants to do, sort of like turning the wheels in sand, not getting any traction. So we're going to keep our eyes on that, but that's what's going on in the market. Let's talk about analyzing stocks. I'm going to go to the top, click on our viewers tab. From our viewers tab, I'm going to show you right from the beginning. This is our viewers homepage. And there's a lot of viewers that we have instilled within the software that you can use to find all different types of stocks depending on how you invest in the market. The beautiful thing about us is we're not a one size fits all. Everybody invests differently, and we encourage that. So depending on how you invest in the market, we can help you analyze any stock in our database and help you to make the right decisions. In the current US database, we track over 8,000 stocks, almost 8,200 stocks. Globally, though, we track over 19,000 stocks in several different markets. So we're not a fly-by-night company. We've been around over 30 years. So the analysis that I'm going to walk you through is something that is tried and true, and we'll get into it. All right, so we're going to go to our watch list viewer because I created a watch list of stocks for us today. I put them into a group called Ally, and I put it for the Ally Summit. Now, once I click on that watch list, stocks within my watch list will pop up. As they pop up, there's a master indicator for ranking all of the stocks that are in this watch list. So they're not just thrown in there willy-nilly, they are automatically sorted. The VectorVest software automatically starts to do the work for you in regards to the stocks that you own. So I've got a lot of stocks that a lot of people out there should know about, and many of you may be trading them right now. Here's that master indicator, VST, and all of the stocks are sorted. So the stock with the highest combination of value, safety, and timing will be at the top of the list. All right, so that is the software in and of itself. Now, let's break it down. As you're looking to getting into the market, VectorVest believes that every investor should know what a stock is really worth and how safe it is. You need to know how safe, you need to know what a stock is worth because we rather have you in a stock that's undervalued. How do we continue or configure value? We look at things like earnings per share, earnings growth rate, and those kinds of things to give an intrinsic value on a stock. And from there, you can tell if your stock is under its value or over its value. But when we look at value, value increases when earnings go up, inflation goes down, and interest rates go down. Folks, there's three things that move markets globally, and you're looking at it. I don't care what anybody says or any of that kind of stuff. There's three things that move markets globally. Earnings. When earnings go up, companies are making money. If they're making money, they're able to reinvest in research and development, hire new people, give raises, a lot of different things. But inflation and interest rates are the bad guys. When inflation goes up, it costs more money to buy things. It takes out of a company's pocket. When interest rates go up, well, it costs more money to repay a loan as a company. That takes more money out of my pocket as well as a company. So the Goldilocks scenario, earnings are rising, inflation and interest rates are going down. Well, currently interest rates are still at historic low conditions, right? We're at a 0 to 0.25% as far as interest rates are concerned. Inflation, well, the Fed says inflation is right where it needs to be. We're not way over. Leave that up to you to make your decision. But these are the things that move markets globally. So this helps us in understanding or giving an intrinsic value to a stock. Now, the next indicators I'm going to talk about are VectorVest proprietary indicators, and they are all cast on a scale between 0 and 2. We make it real simple. If the indicator is above the value of 1, it's favorable. If it's below the value of 1, it's unfavorable. Real simple. What is relative value, though? Relative value is an indicator of the long-term price appreciation of a stock. Think about that. The long-term potential, sort of like a value play. A stock that, compared to a AAA corporate bond, will this stock make money compared to that AAA corporate bond? Well, you buy a bond, it matures. After it matures, you get your money back with a little interest. It doesn't blow the doors off the market. Well, relative value on a stock tells me if my stock that I'm looking at should overperform that AAA corporate bond. So it gives me a longer potential on a stock. Next indicator, relative safety. It's an indicator of risk. Well, if you're longer term, you probably don't want to be in a risky stock. But if I am more of a trader, maybe I'm willing to give up a little bit of that risk to accomplish the goals that I'm trying to get to as a trader. So it is still just an indicator of risk. It looks at the consistency and predictability of a company's financial performance. Layman's term, does the stock make money quarter over quarter, year over year? Those are the stocks that consistently and predictably meet or exceed their earnings expectations, attract investors. Keep that in mind, right? But again, if I'm looking to be a little bit more aggressive, I might be willing to give up a little bit of that risk. Next indicator, relative timing. It's an indicator of the short-term price trend. This is an important one, especially if these are stocks that you own. Relative timing tells me if a stock is going up or down in price and how fast it's going up or down in price and the dynamics behind it. So if I'm in a stock that's got an RT above 1, the stock is in an uptrend. The higher above 1 it is, the faster in an uptrend it is. Now, if RT is below 1, the stock's in a downtrend, and the further below 1 it is, the faster in a downtrend it is. So looking at that indicator for RT or of RT can definitely help and signal what stocks you may own that you might need to refresh. Again, these indicators will be at your fingertips, and you can very quickly discern which stocks are still doing well and which stocks are not. Now, we take all 3 indicators and wrap it up into our master indicator that list was sorted by, called VST Vector. It is our master indicator, and it combines RV, RS, and RT into one single indicator. Now, when I can look at the VST on a stock, I can take a $5 stock, compare it to a $50 stock, and because of that master indicator, I can put it on the same playing field. So no matter what the price of the stock is, I can see which one has the better combination of value, safety, and timing. That's cool information without having to do a lot of research to determine what stocks are good or favorable and what stocks are unfavorable or need to come out of my portfolio. Now, I've built that watch list. Let's go put this into practical application using those indicators. As I open up the software again, here's my watch list that I created. Again, stocks, many of these stocks that you should already know about. Apple, which happens to be one of my favorite stocks in the whole wide world. It just makes money. But there's also a bad time to be in a good stock. Never lose sight of that. Just because you own that stock, you love that stock, never fall in love with a stock because it won't love you back. So learn how to analyze stocks and make right decisions, not emotional decisions, because that's where we find out we get ourselves into the most trouble. So the stock that's got the best combination of VST in this list is Facebook. Let's analyze the stock. The stock is currently trading at $235. It's got a value of $303. We can clearly see, because we have an intrinsic value on the stock, that the stock is currently trading under its value. It's an undervalued stock. That's point number one. Next, Let's look at RV. Remember, that's the stock's long-term price appreciation potential as compared to a AAA corporate bond. Long-term, this is a stock that I want. It is above the value of 1, and at a value of 1.45, it tells me that Facebook should outperform that AAA corporate bond by 45% over the next 1 to 3 years. Long term, that's a stock that I want. Let's move over to relative safety, that indicator of risk, the consistency and predictability of a company's financial performance. Remember, when a company can consistently meet or exceed earnings expectation, what happens to that stock's price? Tends to go up. That makes it more attractive for investors to buy. Well, Facebook has got a relative safety of 1.4. It's a pretty darn safe stock. So good upside potential, good safety. Now, RV and RS are our fundamental indicators. When we analyze stocks, we analyze both with the insight of, or with fundamental analysis with the insight of technical analysis, because RT is now our technical indicator for analyzing stocks. It is a price-based indicator. Remember, above the level of 1 on any of these stocks is favorable. Below the value of 1 is unfavorable. Relative timing on Facebook is at 1.71 on a scale between 0 and 2. This stock is not only moving, it's moving up beautifully and fast. So the fundamentals behind the stock are there. I'd like to own it long term. It is a safe stock and it's going up in price. That's a 3-time winner. And no wonder you can tell why this stock in this list has the highest VST ranking. Now, another indicator, CI. CI is known as the Comfort Index. Comfort Index looks at a stock's ability to withstand long or lengthy price declines. Every stock goes down in price at some point in time, but that indicator CI will show me the stock's ability to withstand long or lengthy price declines and become resilient enough to rebound and start moving higher. So notice that on Facebook, the CI is below the value of 1, which tells me that altogether, Facebook looks good. It is more susceptible to a pullback in the stock's price. So you get to weigh out what's good, what fits you, what you may not like. Let's go look at another thing, earnings growth rate. Every stock can either grow or lose in their earnings. Facebook grows their earnings at a clip of 18%, and it's got positive earnings. I've got a lot of different other parameters that I can look at. But for right now, in analyzing these stocks, let's just stick to the basic stuff to help you make the right decision at the right time. All right. So let's scroll back over. Let's look at the next stock. Gold. Everybody's talking about gold. Everybody's talking about gold. EQX. Stocks trading at 1093. Value of 21. Clearly undervalued. The stock's got good long-time potential. Watch the dollar. Watch the dollar, because as it gets weaker, not if it gets weaker, it's going to be more so when it gets weaker at some point in time. There's a lot of stimulus out there, folks. When it gets weaker, gold is going to start to pop and start running. Right now, it's got good upside potential. That lends into the credibility of knowing that it will go up at some point in time. But it's not a real safe investment right now. Gold is more of a riskier investment. Remember, relative safety is an indicator of risk, and it looks at the predictability and the continuation of a stock meeting or exceeding its earnings expectation. But gold is on the rise right now. So this helps me to make a good decision. It's good upside. The safety is not there. This is more of an aggressive play. I can use these 3 or 4 indicators to help me determine whether the stock is a long-term, whether it's a swing trade, or whether it is more of a trade from a trade perspective. Apple currently under its value. Good upside potential, good safety, good timing, going up in price. You got to love it. Now you can see how we can roll through this list to make decisions. Let's do this. Let's go look at the top few stocks that are at the top of the list. Let's view their stock graph. All right, I'm going to put it on a 3-month graph, and I'm looking at a basic graph of the stock. What we're looking at is the price shown in candlesticks. I have a 40-day moving average, which is a good middle of the road moving average, especially if you're swing trading. And there's that indicator RT that tells me if a stock is in an uptrend. How about matching when a stock's price goes above the 40-day moving average and RT goes above the value of 1? Bada boom, bada bing, look at that run. Now notice this too. As the stock's price pulls way away from this 40-day moving average, how can I manage that trade? Well, let's simply move that moving average to track price. Let's move it in half. Let's move it from a 40-day moving average to a 20-day moving average. Wow, that does a much better job of helping me to maintain a stock that's in my portfolio without emotionally investing. That's the beautiful thing about looking at a graph. A graph is worth 1,000 words, and it tells a story as long as you're willing to listen to the story. Sometimes the story is not what you want to hear, but sometimes the story is telling you what you need to hear. And once that happens, you take emotion out of the equation and make better decisions. Let's go to the next stock. Next stock is the gold stock, doing a really good job tracking with that 20-day moving average. This is a simple moving average, by the way, doing a beautiful job. Even though I know that it's a little bit more risky, how about being able to manage the trade with a moving average? What else is at the top of the list? Apple. Man, you can draw a ruler line under this stock. This is what we would call a ruler stock. Now, how about Apple is still far away from the existing 20-day moving average? Let's manage it some more. Let's drop it down to a 10. And wow, you can use moving averages to draw your own trend line on each individual stock to manage the trade. It only gets better from here. All right, that's a beautiful looking equity curve. But you notice something with the down day today? What's up with all of the candles today? They're all down. These moving averages, these stocks are still moving up. That's why I tell you, one day doesn't make a trend. But if I see the stock's price starting to approach that moving average, what can I do? Tighten stops, manage the trade. Just because it's down today doesn't mean you panic sell. You need to get out of the habit of panic selling. What do? Plan the trade and trade your plan. That's it in a nutshell, folks. All right, so those were some of the best stocks in the list. Let's look at the stocks that are under the most pressure. Let's sort this list by RT or relative timing. Remember, that is the indicator that tells me if a stock is in an uptrend or not. Let's look at the stocks that have an RT below 1. These are the stocks that you pay attention to. Let's analyze them real quick. Kellogg, slightly over its value. Within 10%, we call it fairly valued. Upside potential, not there. Safety, not there. Timing, is it moving up? No. That becomes a 3-time loser. And what do they have? Negative earnings growth. They're growing their earnings in a negative manner. That may not be a stock that I should still maintain in my portfolio. Walgreens, fairly valued. Upside potential, not there. Relative safety, not there. Relative timing, not there. So these are stocks that you may own because somebody told you about them and say, oh yeah, over the long term, they're going to make money. Do I want to wait for the long term to make money, or would I rather put my money into a stock that's currently doing what I'd like for it to do, which is to go up in price? Well, you make the call on that. Preferably, I'd like to have my money where the stock price is going up. Why? Because money goes where money grows. I'd rather put my money in a position that's making money than having to wait for the long term for the stock to start making money. Just think about that. JetBlue, airlines are in the news, aren't they? Because they're rocking and rolling because the world is slowly but surely reopening because of the pandemic. Well, let's do a deeper dive into JetBlue. The stock is currently undervalued. Its upside potential is there. Okay, I'll give you that. Is it a safe stock? Not really. Is it going up in price right now? Not really. So you look at TV, you listen to your friend, you go have water cooler talk, and you say, somebody say, man, I'm making a killing on JetBlue. Well, how many days did it take for you to make that killing? Well, a couple of days. Okay. Do I really want to hold that stock long term? Do I really want to risk my money in that kind of a trade? Unless my thinking and my goal is to be a more aggressive trader, then maybe you do. But if these are stocks that you're trying to hold for the long term, maybe you need to rethink this situation. All right, last one. This is on oil. Oil is another big news in the market. This stock is way over its value. Upside potential, not there. Safety, not there. Timing, not there. And this is something that I talk about on YouTube as well every Thursday on something called Trending Thursday. We talk about the stocks that are making the news. I'd love for you to join me. I'll give you more information on that in a moment. All right, so now we can see what stocks are doing good in our portfolios that we can hold on to, but because of today's activity, we might think about tightening stops. Not panic selling, but tightening stops. That allows me to take the winners off the table a little quicker, and it also gives me the ability to limit losses on some of these stocks as well, because a lot of times, folks, we sit into a stock way too long. Why? Well, you know it's going to go up in time. All right. Again, I go back and ask that question. Do you want to wait for it in time, or would you rather take action, take profits off the table, or mitigate losses and move on to the next trade? So just think about that. Now, this is my portfolio, and these are the stocks that have RTs below 1. These stocks are now all in downtrends. Watch this. And I'm going to have you look at the watch list average down below, RV, RS, RT, VST. Once I delete these stocks, since they're all highlighted, right click, let's go see if the values down here increase, okay? We'll click on delete. RV was at 1.10, it stayed. Relative safety didn't move that much. RT didn't move that much. That's fine. But maybe I'm now only investing in the stocks that are doing what I want them to do. Now, do all of these have perfect RV, RS, RTs, VST? No. But all of these stocks are at least in an uptrend. And with today's activity in the market, I can see which ones are moving up, which ones are moving down. The majority of them are moving down. Tighten stops. Now, once we've done that, we call this weeding the garden. Once we've done that, now we need to go find new stocks to get into. I'm going to show you a wonderful way to stay on top of what's running at any point in time in any market conditions, whether the market is bullish, whether it's bearish or moving sideways. I'm going to show you how to stay on top of what's hot and stay out of what's not. So the first thing I'm going to do, we're going to talk about industries. We have an industry viewer. If I click on it, the industries, we track 221 industries in our database. And from here, they're all ranked between 1 and 221. Well, these are what we call our high-flying industries. These are the ones that are rocketing up to the top of the list, and these are the stocks that you could possibly take a look at. Well, what's the first one? The number one is building, residential, commercial. Notice, though, in the top 10, building, 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 building. What does that tell you, folks? That building is a hot industry when I've got those many industries in the top 10 or 15 or so. Things that make you go, Let's start with number one. Here's the number one, building, residential, commercial. What I'm going to do is right-click on that industry. I'm going to go up to view the stocks in that industry group. This is a good way to start to find stocks to get into at the right time. But wait a minute, let me step back a little bit. We looked at the home page. We looked at this was a time to be more cautious in the market than not, right? So keep in mind, given that information, how do I invest in these stocks? Cautiously. So what do I mean by that? Let's highlight the top few in here. I click, view the stock graph. Let's go put this on a 3-month graph. Why do I like a 3-month graph? What happens every 3 months on a stock? Earnings. Earnings is the engine that moves the stock's price higher. So if you notice, I put earnings on every time I'm in a 3-month graph, earnings is in the picture somewhere. Now, interesting about MTH, notice that the stock is nicely above the 40-day moving average. RT is above 1, stock's in an uptrend. What's the stock's price doing? From that high, pulling back. What did I tell you that the graph was? It was a story. Listen to this story. It may not be the story you want to hear, but it's the story that you need to hear to make the right decision. So right now, maybe I don't pull the trigger on that. Maybe not that one either. So the industry is rising, but what is it starting to do? It's starting to fall. So that's interesting, knowing I'm just quickly going through the graph, see if there is one that is rocking. Notice that they're not. All right, that's fine. So even though the industry is the fastest moving industry, let me get back to the software, is the fastest moving industry, let's go to the next industry. Building is in here too. Let's go to industry number 3, computer graphics. Let's right click, view the stocks in that industry group. Let's go analyze these stocks. I'm not going to analyze them. I already know that they're in a hot industry, right? Let's go highlight it, right click, view the stock graphs. This stock was moving up nicely, pulling back today, but just coming off a fresh new 3-month high. Today's a down day. Even the good stocks will be affected, right? Same thing with CDMS. Hitting a new 3-month high, today is not a good day. So I'm loving that we're finding stocks hitting a new 3-month high because we're looking at the fastest industries. But today is just a down day, and all I do now, some of these stocks I don't want, but some of these don't look so bad because they're trading real closely to their new highs and nicely above the 40-day moving average, and RT is above the value of 1. So keeping all of that in mind, I'm like, hey, these are stocks that and what you do, you put them into a watch list, keep your eyes on them. Who's to say that the market's not going to go up tomorrow? This is a little iffy market right now. There's a lot of things that are out here. There's a lot of news driving the market. This is, in my opinion, still a very Fed-induced market. So what do you have to do? This is a good time to more so be a trader than a longer-term investor. But if you are a long-term investor and some of the stocks that you're in, let the graphs help to monitor what's going on. And big time, see if any of your stocks have RTs below 1. Those are the stocks that are really hurting your portfolio. So those were the high flyers. Right? Those are the industries that are at the top of the list to pay attention to. I'm going to show you one other thing. How about finding the industries that are doing what we call moving and shaking? The industries that may not be at the top of the list, but are starting to move their way up the list. So we have a search for that. We're going to go to Unisearch. That's our searching tool. And we're going to go to a folder called Delta Searches Industries. All right. Now, what is a delta? A delta, Brian talks a lot about it, specifically from the world of options. It is a percentage change. And I'm going to use a delta on one of our indicators, which is that RT indicator. It is a smart, fast indicator, folks, that will really hone in on stocks you should own and stocks you should not own currently. Now, I can't tell you what stocks to buy or sell because I'm not a broker, but I can help you use this database of information to make better decisions. So let's go to a 10-day RT delta. Over the last 10 days, let's find what industries have been on a rise, and that will help you in the current market conditions to find stocks to get involved in. Now watch this. This is going to knock your socks off. All right, make sure your feet are clean. This is going to knock your socks off. Let's run it as of today at 11:56. All right, that's not the right time. Let's stream it. There we go, at 1:33. There we go. Let's run it. Watch this. Down day today. Market looks like it might be turning around. What's at the top of the list, folks? Holy smokes. How about using the database, using the industries that are moving up? How about out of 221 industries, ETF shorts is number 2 20, but over the last 10 days is up by RT Delta 38%. Who wants to find the industries that are on the run before they get to be the top industries and they're talked about in the news? Well, if that's what you want, this is a great opportunity to find out what industries are moving and shaking, and ETF shorts are at the top of the list. Get ahead of the curve. Now, if I right click, let's go view the stocks in that industry group. Move this over. Whew, I get excited over this stuff. Now, as I'm looking at this group, first thing I want to do is make sure that I've got average volume. I don't need to make sure I've got liquidity. So I'm going to sort by average volume. All right, so now I'm looking at contra ETFs that are the most popular, and look at them. Look at them today. Well, that makes sense on a down day, right? But the industry's trying to find out what's moving and shaking. We had the opportunity to let the program tell us what to do and when to do it. How much work did I have to do to make that happen? Just think about that. Let that sink in for a second. The software did everything that you needed to have happen to bring to your fingertips what to do. The SQQQ up 6% today. On the large cap bit, I just go down the list. Look at them. They're rocking and rolling, and the database brought to your attention the industries which are moving the fastest by way of that RT indicator, finding the stocks by the short-term price trend over the last 10 days. I like 10 days. It's 2 trading weeks. All right. So that's in a nutshell. I got through a lot of information in a short amount of time, but hopefully it was impactful enough to help you to make a decision on, wow, I can make my life a little easier with a software like VectorVest. Now, don't get me wrong. Don't let me sit here and tell you that investing in the market is easy, because it ain't. But what it will do, what the software will do for you, it will give you a better perspective. It will give you more information. And with that perspective and information, you're going to make a better, well-informed decision on the stocks that you own or don't own. And there's a lot of different ways to find the right stocks for you. Those were just 2 ways. Folks, that was just the tip of the iceberg to help you to find some stocks to get into to refresh your portfolio. Now, I have a last slide, but I'm going to wait until I hear from Brian in regards to any questions before I go jump on board with how to get in contact with me or learn more about VectorVest. So, Brian, I am done, and I think that I may be able to answer any questions that you may have. Just don't make them really hard. Don't make me think too hard. Man, no. That was a lot. That expels a lot of energy to do this. So I just don't want super hard questions.
All right, Glenn. I love it. I love it. Okay, so one of the things, one of the first questions that have been addressed is VectorVest a part of the Ally platform? And so that would be the first one that we would need to address straight up. What is VectorVest, and who is VectorVest, and how are you associated with Ally? And I guess I'll let you run with that, Glenn.
All right, so VectorVest is a stock analysis and portfolio management system where there's a lot of emphasis on market timing, on analyzing stocks, on being able to build portfolios. It's a lot of different things incorporated inside of the VectorVest software. But the main thing is market timing, analyzing stocks, okay? Now, Ally is one of our partner brokers. We have 3 of them. And what we can do is by way of this tool at the top that I'm not going to click on, but it's called RoboTrader. It will allow us to trade directly from the VectorVest software into one of our partner brokers, one of which is being Ally. So if I like a stock, well, let's do this real quick. If I like a stock, view the stocks in the industry group, and I've done my work, I look, and I right click on the stock. Notice that right here, I have trade now, and I can trade with any of our partner brokers. So let's do that. Right here at the top 2, I have trade now, and I can connect to a brokerage. And from here, I can link up to Ally, and that will allow me to trade directly from the VectorVest software into my Ally account. So we work together. And that's what it's all about. You can do your analyzing of the stocks on our side and then actually trade directly from the platform into Ally.
All right, Glenn. Excellent. Thank you for letting us know exactly who VectorVest is relative to Ally. And then I have Cal. Cal is asking a question. Is relative value same as modeling? And if so, what metrics do you have with regards to WRT, with regards to accuracy of the model? So that's a loaded question for you, Glenn.
All right. So one thing that you'll learn about me, I talk about what I do know. I don't know what modeling is, and whether that makes me a novice in any way, shape, form, or fashion. I'm not sure what modeling is, but I will go into a deeper understanding of what relative value is. Relative value looks at a stock's long-term appreciation potential. So that was the dictionary version. Let me talk to you one-on-one. Relative value tells me that over the next 1 to 3 years, do I want to own this stock or not? Compared to a AAA corporate bond. So when you say modeling, Brian, you may need to help me with the modeling part, but the RV, the relative value, tells me that long-term over the next 1 to 3 years, is this a stock that I want to hold in my portfolio?
Well, when you're talking a little bit about modeling, what modeling is referring to is more so back testing, like looking at what a model account may be. And I know you can talk a little bit about that inside the software. So is relative value same as modeling? It's a little bit kind of mixing metaphors a little bit by asking the question that way. But overall, I think it would be more so to back testing a specific type of portfolio overall.
I agree with that.
Modeling.
If you're going to look for a model, yes, I have a back tester capability. And from there, I can say, wow, here's a trading plan that I like. It knows when to buy, what to buy, when to sell. That's, if you're going to call it a model, that's what I want, a trading plan. And I can look at a trading plan. Now, RV, a little different than that. RV looks at an individual stock's ability to make money over the next 1 to 3 years. A modeling has a full packet of knowing when to buy, what to buy, when to sell.
All right.
All right. So now, any other questions or?
No, we got a couple more.
Okay.
Actually, we have unlimited questions, but we're just going to address as many as we can.
Okay.
All right, Glenn?
Yes, sir.
All right, here we go. Next one. This one's a fairly simple one. Since we've had a couple of tough ones, I'll give you an easy one per your request.
Thank you.
Does VectorVest track ETFs? Does the software track ETFs?
Sure it does. Remember what was the fastest moving industry that we just looked at right now? It was country ETF, right? But yes, I have an ETF viewer here where I can, we track over 1,625 ETFs. These are both bullish and bearish, but yes, we do. And I can also, from the watch list viewer, go into my ETFs, and I've got watch lists built on non-leverage, double leverage, triple leverage, contras, regular. You look through here, folks. Anything you want to know about ETFs, I got it for you. I got it. Whether you like ProShares, you like Spiders, you like Vanguard, all of it is right here. We have it segmented out for you. So yes, we do.
All right. Okay, next one. GF that's all the handle that we have here. How do account types and different rules around account types, example Roth or individual non-retirement, affect refresh and reset? So in other words, would you have a different approach to investing based off of the type of account that you are in?
Yes. Let's go back to the viewers tab. Let's go back to the watch list I created. All right. So depending on, remember I got rid of the stocks that had RTs below 1. Well, maybe from a longer term retirement portfolio, maybe I use that indicator that shows me the stock's ability to meet or exceed its earnings expectations quarter over quarter, year over year. Now I've got a different set of stocks in here that I pay attention to. All of the stocks that have a relative safety above 1, These are the stocks that I would want to have in my retirement portfolio. Whereas if I'm looking to be a value player, I sort the list by relative value. These are the stocks that long term I want to hold in my portfolio because I know that long term they will make money. If I'm more of an aggressive trader, again, then I sort it by RT and find the stocks that have the RTs below the value of 1. So if I'm wanting to be retirement minded, relative safety, I can sort my watch list by. If I'm looking for good value plays, relative value is a good indicator to sort by. And if I'm looking to be more of a trader, RT is a good thing to manage stocks or look for stocks. So yeah, I can use that same watch list and accommodate any type of investor. Absolutely.
All right. Okay, Glenn. So here we go. Another fairly simple one back at you. And we got time for just a few more here, but here's the next one. What about dividends? Does that play a role in making decisions on stocks and specifically using the VectorVest software?
Sure. So let's go. Let me move this over a little bit. Remember, I talked to you about my retirement-minded stocks. So let's sort by relative safety. I show which stocks pay a dividend and which ones don't. Not only that, let's say here's a stock that pays a dividend, Old Dominion. All right, pays a dividend. How about I've got an indicator in here that talks about dividend safety? How likely is the company going to be able to raise or maintain that dividend? So dividend safety plays a role. Apple pays a dividend, high safety. And this is an indicator that's cast on a scale between 0 and 99. The higher it is, if I'm a more longer-term investor, more of a dividend playing investor, man, using that indicator dividend safety, as long as it's over 50, I have the high probability that the stock is going to pay a dividend. The people who are going to use dividend, though, are the people who are looking to make money in more than one way on the stock. If I'm going to be long-term on the stock, capital appreciation. When the stock goes down, I play options, sells covered calls. I can make money even though the stock is going down. And dividend, because you get that dividend over and over again, it just pads your portfolio. But dividends are a great way, primarily for the longer term investors. The shorter term investor, I'm really not worried about getting the dividend because I'm probably going to be in and out even before the dividend execution.
Oh, all right. Okay, Glenn. I got another one, but I got to go to my other computer to ask you this. Okay. So all right. let me read you this one.
By the way, these are all great questions.
Yeah. Overall, can the VectorVest software automate sales and purchases? That's one of the questions. And then just a lot of questions about individual stocks. A lot of people would like to see the VST for this stock or that stock. I don't think we're going to be able to address those questions today. That's going to be more of a different platform. Sometimes we actually will do that inside some of the other events that VectorVest will guest speak for us. But I'll let you go with those two questions about automating the trades overall, and then give them a little bit more on your background too, Glenn, and how they can get a hold of you.
Okay, so we have portfolio capabilities where I can run a paper trading portfolio of any kind and go to see what's going on with those portfolios. All right. Will they be automated? The answer to that question is yes. Now, let me address that from a different perspective. If you're saying automated with one of our partner brokers, not fully yet. All right. We can trade through that robo-trader. Okay? We can trade through that robo-trader. And from here, we can then turn around. We still have a human element to be able to complete the trade. So it'll tell me, hey, I'm giving you an alert. Go buy this stock with your broker. You have to look at it and go, okay, I approve it. And then it goes out and it makes a trade. So it's not fully automatic. It's what we call semi-automatic, where it does take the human element into place. Now, what was the second question? I apologize.
Well, just a little bit more. Just tell them a little bit how they can find out a little bit more about VectorVest. And then I got a couple more for you too. Questions are just lining up left and right in that chat box. And don't forget, on all these events, this is one of the benefits of doing this live. You can put those questions in the chat box at any segment, and we'll address them at the end of the segment. So Excellent. A little bit about VectorVest, where you come from, and then I got another question from Angelica up next. Okay.
So I work here in North Carolina, Any questions that I can answer for you, you can send an email. Let me tell you something about sending me an email. If you send me an email, I will answer in about 1 to 2 years. So just be patient. It'll take me a little bit of time to answer them. But if you want questions answered about the software, you can always go, here's our phone number to contact our product support. If you want to learn more about the software platform, here's our website. As I mentioned, I do have a live stream every Thursday on YouTube called Trending Thursday. What you need to do is go out to YouTube, search for VectorVest, and subscribe to the channel. It is a live stream along with a podcast. And also there, I will do a quick fire of stocks to be analyzed for you as well. Again, everything that I've learned about the market, I've learned from the VectorVest software. I am not an expert or a guru by any shape of the imagination, but I love the software. I'm a salesman by trade. And I've always felt that I could not get behind anything that I wasn't passionate about. I am passionate about teaching people how to make money in the market with this software.
All right, Glenn.
All right.
I got to cut you off there because I got one last question. I need a short answer for it. We got about 30 seconds to answer this question.
Understood.
Angelica, what would you say to long-term investors who aren't day trading? How do we effectively read what is being displayed in your software?
All right.
It's more long term.
For the long term, my suggestion would be we have market timing. I remember I told you that was one of the things that we do is that we time the market, but we time the market. We give indications on when it's okay to buy stocks and not okay to buy stocks. Folks, this is the movement of 8,200 stocks. So Angelica, when I'm looking at a market timing graph, and we can time the market, we don't predict where it's going to go. We can time it. We can get our subscribers in and out at the right time, no matter how you invest in the market. And that's to answer your question. If you're a longer-term investor, we have a longer-term market timing signal for you.
All right, Glenn. Well, that's going to be it for this wonderful segment about how to refresh and repurpose your portfolio. Next up, we have David Peltier. He's a portfolio manager. He's going to talk a little bit more about diversification. So we'll be back in about 5 minutes. Make sure you set your alert. Make sure you know about that. And as we go along, make sure you ask all your questions in the chat box. Thanks for coming by today, and we'll see you shortly. Thank you. I'm Brian Overby with Ally Invest. I'll be your host and your option trading analyst for the remainder of the show. I'll be doing my event at the end of the show here. But before I introduce our next guest, I want to remind you to ask questions in the chat box along the way. We will also check in with our YouTube page tomorrow. All of these segments will be available for your viewing. We will address those questions at the end of this segment today and at the end of all of your segments. All right. So next up, we have David Peltier. David Peltier is a portfolio manager that has worked with Jim Cramer's Charitable Trust. His goal today is to give you a primer on the many different asset classes available for investing and how to determine if adding them to your portfolio is right for you. He'll also chat about holding cash in your account and discuss on how much cash you should think about keeping on the sidelines. So without further ado, I pass the reins over to David Peltier. Hello, David.
Hi, Brian. Thanks for having me. It's my pleasure, and want to thank everyone for having me, especially Lindsey Bell, former colleague of mine. I want to thank her for inviting me to talk about diversification. It could have been yesterday. It could have been yesterday when the NASDAQ was up for the 8th straight day, but I think it's more important now than ever when you're talking about a day when you look at the Dow down 700 points, you're looking at just about everything, almost every asset class down across the board. So we're going to talk about today how you can kind of manage your portfolio to ride some of these waves. So we invest to make money, but we diversify to survive. So I put up these couple of quotes, and one's really old and one's kind of old. And I took a look at the Thomas Edison quote, because what it really comes to say is that we need to have a plan. It's one thing, we're investing to make money here. And there's plenty of money to be made when you're investing, whether it's in stocks, bonds, or all the different assets out there. But without a plan, it makes it difficult to survive. Now, I've only been at this for about 25 years or so, but I've seen enough cycles to honestly last me a lifetime. Which brings us to our second quote, Mr. Peter Lynch, who's retired, but unlike Mr. Edison, is still with us. This is really important, especially if you're newer to investing. Look, you're only going to be right about 6 times out of 10. You talk about some of the most successful investors in the world, billionaires, and they make billions each year. They're still wrong 40% of the time. So that's something as an investor you have to learn. And you also have to learn that sometimes being wrong means you're going to lose money. But accepting that and knowing that is part of the learning process. And every time we lose money, every time we're a little bit wrong, you keep that memory somewhere in your head. And the reason you do that is because markets don't always repeat themselves. There'll be people out there and say, oh, this chart reminds me of 1980 something, and this. It's not always going to be exactly the same, but there are repeatable good things we can do, and also repeatable mistakes that we can make if we're not careful. So a very good lesson to learn is you're going to be wrong. But if you're right more than you're wrong, you're going to make money consistently at doing this. So that's why we diversify. And that's why we're here today. So here's going to be the one chart. Here's going to be the one time for the next 40 minutes or so, 35 minutes or so, that I'm going to be a little dry and boring. But before we get into the fun stuff, we kind of have to understand why we're here today. So I teach statistics classes. I could talk about correlation for a whole week. If you want to hit me after this, find me on social media. We'll talk about correlation. But when we look at this chart, we have some important things to realize. When we're talking about diversification, you ultimately want to find correlations that are negative. Now, just so you know, everything negative on this chart, as you can see up top in the key, is going to have a parentheses around it. So when you take a look at the very bottom line, you're looking at the S&P 500. So most people consider when they talk about the stock market, it's essentially 500 of the largest, most common, most popular stocks out there. So when you look at the bottom row, some of these interesting things, when you look at, say, international stocks or long-short equity, almost what you would think of with a traditional hedge fund, some of those correlations are very high. For every $1 that the S&P 500 moves up, owning an international stock does buy you some diversification, but it's still going to move 85 cents for every dollar in the same direction. That's what the positive number means. Why you want this negative correlation is because you want to have a built-in hedge. And I don't want to oversimplify the idea of hedge funds, but the most simple hedge funds, when they were first invented, was buy your favorite stocks in concentrated positions and kind of short the market against it as a hedge. So when we take a look at some of the things that are negatively correlated with the S&P 500, which is your traditional stock basket, we look at things like currencies, foreign currencies. We look at things like investment grade bonds. Obviously, cash has little to no correlation. If you're invested in a stock that goes up 20%, great. If you weren't invested, it basically didn't make any money. So that's kind of what that zero means, short of any interest you might make. So this is something I'm not gonna go back to the screen per se, but we're gonna refer back to some of these correlations. It really is the basis of everything we're talking about today. So the first thing I'm going to talk about is investing in US stocks. Why? Because most of the investors that I know of, probably most of the investors on this call, are US based. So invest in what you know. But when you actually talk about buying individual stocks, if that's something you're ready to do, and I think a lot of people here are, it really is important, I believe, to buy what you know. There's been a lot of speculation in the market since the March, April lows. And a lot of speculation has been in stocks that, frankly, I don't know if people really understand what's going on. But remember, anytime you invest, you're investing with some sort of financial goal in mind, and it's generally a long-term goal. It's okay to have short-term goals. There's nothing wrong with making money in the near term. I'm not allergic to that. But usually we have a longer-term goal in mind. And to pull the trigger, to really make an investment, especially with a stock, you really want to understand what the business is. What do they do? Because you're buying a piece of paper, and even if you don't really receive the piece of paper anymore, just a digital click, you're still buying a fraction of that company. So the health of that company, the profits they make, the ups and downs that company faces on every day, that, while not reflected in the stock market every day, that's ultimately what's going to drive that investment higher or lower. So we really want to understand what we're buying. And I think you'll see this is a theme that kind of sticks through as we talk about the other assets as well. So once you've bought a couple stocks, maybe it's 5, maybe it's 10, maybe it's a little bit more, maybe it's a little bit less. You want to make sure they diversify. Now, in this case, I want you to think, maybe you're a card player, maybe you're at the poker table. It's the one time where an unsuited straight is going to get you a better hand than having 4 of a kind. Now, when you talk about diversification, one of the most simple ways to diversify your stock holdings is across different sectors. You take a look at what's in the S&P 500. If financials are a big component, I don't need to own 100% financial stocks. I want to own some financials. I want to own some technology. I want to own some consumer. I want to own some industrial. That's one of the simplest ways you can diversify. Again, you want that straight. You want the 5, 6, 7, 8, and you want to be able to fill in that hole with your 5th stock. You don't want the 4 of a kind here. So it's almost kind of like the anti-card playing, the anti-poker when you're diversifying. Now, it's also key, I think, and this is something that a lot of beginning investors miss the mark on, and it can be to either side. They either invest in small stocks, and if you go through my bio, I've specialized in small cap and low dollar stocks for decades now, but they either only buy those stocks, and you're seeing that with some of the more speculative names that we don't have to mention outright today, or they only buy large cap stocks. They only buy the largest companies in the world. And I'll just go, Apple, Microsoft, whatever. They only buy the large ones. They only buy the small ones. Again, you're not getting the diversification. There are times, and you don't need to look at the historical numbers, which we just showed you a decade of. There are times, just pull up the market screen, however you look at it, TV, online. There are times when small cap stocks lag the market horribly. But there are also times historically, there are parts of the year, and there are also times when small cap stocks are going to do better because people are in a more speculative mood right now. Or there are times when large cap companies are going to do well because they're considered to be higher quality stocks. So those stocks will rally. And maybe small cap stocks will lag. And your portfolio may lag as a result if you're only invested in a certain class of company. So when you look to buy a new stock to fit into your portfolio, make sure it fits. That's definitely something you want to do. It could be a good investment overall, but it may not fit in your portfolio right now. So it's something we need to start thinking about as we're building our investment portfolios. And also, I think this is a key one. Sizing really matters when you're making investments. Make that investment count. Generally, you don't want to own so few stocks or have such a concentrated investment that any one company is going to make up more than 10% of your portfolio, but you also want it to count. Usually when I do research on a stock, I'm going to spend at least an hour on it, if not more. I'm not just throwing darts against the board on the newspaper or just picking things randomly. I want to make it count. I want to make some money off of it. But remember, we're managing risk here with our diversification. So anything more than 10%, I don't care if you think it's the best stock in the world. There are days when it's not going to be the best stock in the world, and we want to survive to see tomorrow. So we don't need to own more than 10% in any one investment, stock or otherwise. So we talked about a little bit before about international stocks. If you choose to go international, it can be a decent hedge, although we've seen the historical correlation numbers say maybe not as much as it used to be. And I think that has to do with the globalization of the economy. So maybe it's not quite what it used to be. But remember, we'll go down to the second bullet. One of the reasons you buy international stocks is you get that currency risk. And if we go back to our correlation screen, we saw that currency was one of those negative correlations. So with international stocks, you get kind of twice the bang for the buck. You get double the risk, but you also get double the reward. You get that currency aspect, which can work for you or against you. But there's just more regulatory risk, which is what I mean by government risk. That's especially true as you're moving overseas into more emerging markets. But anything with investing and everything we're going to talk about today, the more risk potential, you want to make sure you're getting the more reward potential. That's why we take on risk, is to get more reward. Focus on the leaders. And this is true for international stocks, especially if you don't understand the local market that you're investing in. You'll see whether it's telecom companies or whether it's manufacturing companies or banks. And this is true of some of the larger industrial countries in Europe, in Asia and elsewhere. If you focus on the leaders, especially if you're not as in tune with the local market, oftentimes there'll be a monopoly. Let's call it an oligopoly. Monopolies are illegal. Generally, the leaders are the leaders for a reason. You don't necessarily want to speculate as much overseas if you don't know the local market. And that's another thing we're going to be talking about a lot today. Know what you buy, know what you own. That's the best way you can diversify your risk, is really understanding what you're buying. Now, look, you can come to this and say, international stocks is not for me. You said before, or the numbers say before, the correlation's pretty high. I don't feel like I need that international exposure. So I'm going to tell you that in some ways that's okay. You can totally skip this part. I'm going to talk about a sample asset mix later. And this part can be totally swapped out. All investment choices you make are ultimately up to the individual. Figure out which you want to own and make the investments you want to make. We're just trying to educate you on how each investment works. And one of the reasons why you can get away with skipping this as a US investor especially is that when you look at the S&P 500, approximately a little bit more than 40% of the profits are generated overseas anyways. You look at those top companies in the S&P 500, just throw out Apple, it's basically the largest company in the world. A lot of the money, and in fact, a lot of their cash is actually generated overseas. So you kind of already get that hedge built in. So I want to talk for a second, not necessarily about individual investments, but just kind of investment themes. And this kind of gets into the idea of having a plan going into it. So again, my background was initially in stocks. And so some of the key investment themes that I've found have worked over time that could certainly be worth a look in the future are a few of the following. Finding companies that are about to turn profitable. And the reason for that is Wall Street is reactionary. There's a lot of smart money investing in a lot of things. And there's a lot of people always looking for investments in different ways. But the simple fact of the matter is the biggest daily moves in stocks are made because Wall Street's reactionary. People that trade some of the largest accounts in the world, they trade based on the news. They trade based on the order flow. If a company reports earnings once every 3 months, there could be several days in between of the 60 or so trading days in between where there's not really much going on, but the stock's still going to move, but it's probably not going to move much. It's only going to move based on the overall market. But when there's news, that's when you're going to get your big moves up and down. That's why I look for companies that are about to turn profitable. For whatever reason, I don't find a lot of investors doing the research in this area. However, both the research shows, there's empirical research, something is when the statistics class we're very keyed in on, but also something just has seen in my own experience that buying before you get profitable can be a good time to buy a company. So it's something I look for. Now, again, none of these are foolproof ideas. In fact, funny story, I once had a screen on my Bloomberg terminal, the greatest screen on earth. I love running stock screens based on different characteristics I look for. And you know what? The greatest screen on earth that had stocks that had everything I ever wanted to invest into a company never generated one good investment. So these are ideas to look at, but there's never going to be that magic stock out there. Don't forget dividends. You don't want to forget dividends, again, because looking over the past 100 years or so, the good folks at Standard & Poor's have told us that more than 40% of the historical returns of investing in the S&P 500 has been through dividend investment. Now, dividends are also really key, I think, right now, because interest rates are very low. not only have they been low for the last 12 years, but if you listen to what we're hearing from the Federal Reserve, they're probably going to be low for at least the next 2 or 3 years. So if rates are at 0%, 0.1, 0.5, whatever, and you can find a good solid dividend that pays you 3%, you're ahead of the game right now. Even if the stock is flat, the stock does nothing. You're basically making more in that stock by taking on the extra risk of the stock than you would be by just not investing the cash and earning a very small interest payment on it. Again, I think it's the single best sign of confidence from management. You've seen a lot of companies cut their guidance because who knows what's going on with the coronavirus. And it's the biggest, best companies in the world have had to cut their guidance. But you look for the ones that are raising their dividend right now between March and today. Those are the companies that I think are giving you a real sign of confidence, especially when they have the cash flow to back it up. And along the same lines, following the management team, look at who's buying their own stock. There are several reasons why people might sell stock in their own company. It doesn't mean they don't like it. Maybe they're diversifying their own portfolios, and 90-something% of their wealth is in the company. We don't know. There's no box when you read the Form 4. Oh, I want to add a room addition to my house and build a pool and put my kid. There's no box for that. So we don't know why they're selling. But generally, when you're buying, it's their own money, and they're buying because they know the company better than anybody else, and they think their money is best invested in their own company. Now, again, this is not something we blindly follow. Anybody should blindly follow, but it's one of the things that I look for. One of the things over 20 plus years that I've found has led to good ideas to research further and consider investing in. So we've talked about stocks a little bit. Now let's go over to bonds. And for most people, that's probably going to be through some sort of bond fund, because other than the shoebox of Series EE savings bonds that my grandparents used to give me for my birthday, most people probably don't buy individual bonds. So the easiest way to access bond investments is through bond funds. Now, bonds are a very simple investment, both in a textbook or otherwise. Just make sure you're getting what you pay for. So when you think about Treasury, it's generally considered the risk-free rate. The federal government's almost always had a AAA bond rating. In the worst stress test ever, it'd be one of the last things probably to go bankrupt. So you kind of base everything off of what the Treasury notes and the Treasury yields are paying right now. So everything that's a little bit more risky than that, you should get a little bit more yield than that. So when you're thinking about a bond fund, am I buying high yield? High yield generally means higher risk. Make sure you're getting compensated for that. If you're not, then again, bonds are a pretty simple investment. If you just want to buy bonds, maybe consider a fund. It spreads it out more for you, kind of does the work for you. And again, I think it's okay and safe to enlist help. Again, by the way, those savings bonds upstairs are getting 0.1%. If you're a little rusty on your percentages, that means it's $1 a year in return for every $1,000 invested. So I keep them for sentimental value, but honestly, there are better investments out there right now. And don't forget about the taxes. I think that's really important to think about when you think about bond funds. When you're talking about a fixed income investment, it's already going to be generally lower. But again, we're taking on less risk than we are with most stock, with most equity investments. But if you really need to live off that income, you're really expecting a certain income to come in, don't forget about the taxes, because if bonds are really only paying 2-3% right now, even though it's more steady than you could expect from some of the other investments we'll talk about today, those taxes can really eat into that 2 or 3%, especially if you're paying 30-40% taxes or whatever you're paying. It could dramatically reduce that number if you don't plan for it. That's that key word. If you don't budget for it, if you don't plan for it. So now we're talking about the more fun side of investing. I've already said, okay, you want to buy some stocks, you want to buy some bonds, but there's all kinds of great things you can invest in there. And this is really where it comes. This is really where your personality, your choices. I think are more important at this point. And different alternative investments out there, whether it's gold or other types of commodities, or whether you're investing in some of the newer assets like cryptocurrencies. Maybe you're into fine art. I mean, hey, that's been a great investment. Maybe you can. That's not really an investable piece of art, but whatever your pleasure is, whether it's baseball cards. I saw a baseball card that sold for $1 million the other day. There are, follow your passion. This is the kind of part where it's kind of your fun money. You can have a little fun with it. You should also believe in what you're buying. I don't find any type of investing personally as gambling. Everything that I buy and I believe in for a reason. And if I don't believe in it, there's no real harm. There may be an opportunity cost, to use a fancy economic term, but there's no real harm in me not buying something. There are certain things that are on this page right now that I might not believe in, so I just don't buy them. Buy in what you think you know, buy in what's fun. It's in some way, I don't want to say it's a hobby, because this is an investment and we're trying to make money. But the reason why we're doing this is at the bottom of this slide. We're trying to, stocks and bonds are going to move, not necessarily together, but the stocks are going to move in one direction. Bonds, we've seen through the correlation, tend to move in the opposite direction. You start to build a portfolio, that's great. The fun thing about this is we're storing value in something that we like and we enjoy looking at, but it's also something that's probably not going to be correlated to either one of those more traditional investments. So not only is it kind of fun, but we also have the ability to kind of build in some natural diversification. That's why we look at something like this. Now, I think it's important when we talk about any sort of investing, when we talk about any type of assets, is something you've heard me say a couple times already today, but we just really can't stress this enough. Educate yourself on what you're going to buy. There are a lot of structured investments out there, and structure doesn't mean they're bad, but sometimes what you think you're buying, if you don't read that prospectus, isn't necessarily what you're actually getting at the end of the day. And there have been so many cases in recent history in the last 10 years or so, whether there are different levered funds out there, where people don't really read the fine print. And when something gets really stress tested, whether it's a volatility fund, there have been inverse commodity funds. If you really need to go 3 times bullish or bearish on the price of natural gas, then there's easier ways to do it. I'll just say that. Just know what you're buying. Again, investment is personal choice. Make your personal choices the way you want to make them. But most times people aren't going to read the 100 or 200 page prospectus for every investment they buy. If I sign up for something online, if I download an app to my phone or a program on my computer, I don't always read the terms and conditions. And you know what? Sometimes when I start up my computer, there's a little extra thing on the start menu. That's not a big deal. That's not costing me money. But if you don't do your research and you're putting your money on the line, I think it's important to really understand what you're buying. And sometimes there are different products out there. I'm not going to single any out, but when you read, there are a lot of products out there that try to mimic the return of what you think you're buying. They're not actually buying what's underneath. So there's just a cautionary tale that sometimes those don't always work out the way you'd expect them to. So again, it's one of the reasons why I say that when feasible, consider buying that tangible asset, the underlying asset. Commercial real estate. I'm sitting in a house right now that we happen to own. I don't need to buy a security, a piece of this house. I'm fortunate enough to be able to own it. You talk about if you're talking about gold or silver or something like that. In general, if you really want to own gold or silver, that's up to you. But you're probably better off owning a coin or a bar or something you can hold on to than a piece of paper that's a fraction of a piece of paper that may or may not actually have a vault of. Keep it simple when you're investing. And the more structure you get into, just know what you're owning. That's all. There's nothing wrong with trading. There's nothing wrong with being a little bit more nimble. But know what you're owning, because I don't want, the worst thing that could happen is that people get stuck because they could have done the research, but they didn't know they needed to, or they felt like they didn't have the time. That's just kind of why we talk about this stuff. And the same thing goes for REITs and different real estate investments. If you can own the underlying asset, that's great. If you can't, at least have a pretty good idea of what they do. And that, again, just gets to the idea. Just because it exists, there have been so many different funds, some of these structured funds over time, that have been subject to fail. And it's one of those things that I think that's one of those risks that you're not getting compensated for. So you just need to be a little extra cautious on that. So now, one of the assets that nobody likes to talk about is cash, because cash is kind of boring. But I love being able to hold on to cash, whether I'm managing a stock portfolio, whether I'm managing just kind of my own personal portfolio, because cash is flexibility. And flexibility is freedom. The worst thing you could have to do as an investor is have to sell, whether it's a margin for selling or just because, hey, I really want to buy this stock, but I'm fully invested and I gotta sell something else. If I always keep some cash on the sideline, and we'll mention maybe a sample number out there a little bit later, then I can buy what I want to when I want to. So always having that freedom and that flexibility, I think, is something that's priceless as you're looking to diversify your risk. And again, don't forget, when you're talking about correlation, it's 0% correlated to stocks, very close to zero when you're talking about a lot of the other things we've talked about before. But also keep it simple. Again, if cash isn't paying much right now based on your account or at your local bank or wherever you have your cash stored, that's okay. Generally, the higher yield someone offers you, make sure you understand why you're getting that higher yield. We don't necessarily own cash to get rich. We have cash for the flexibility. We have it for the freedom. If I happen to make some money off of it, that's great. But if someone's offering you something that seems like a cash investment and the yield seems a lot higher than it's everywhere else, it may not be just cash as you and I know it. But again, also remember why you're here. It's to be patient. Look, I had a lot of discretionary investments going into this year, and for whatever reason, back in February, I kind of had a feeling that I wanted to sell some of these discretionary investments, and so I raised cash across the portfolio, had 25% cash, and you know what? March came. And you would think, oh, that's great, you sold some stuff. But yeah, 25% cash is only so much of a buffer when everything in the world goes down 30%. It was better than having been fully invested. But it was nice to have that buffer. But all that time, if you're not using that cash again to buy when you have the opportunity, when things that you think are worth more are going down by globs and globs every day, that's why you have the cash. Be patient. Use the opportunities that are provided to you. And again, that's part of having a plan ahead of time rather than just blindly throwing money. I have money burning a hole in my pocket. I have to invest it in something. I'd much rather have that flexibility for when these opportunities present themselves, which they do for various reasons. I didn't sell in February because I thought I was going to be working out of my dining room for the next 4 months. That's not why I sold. But because I did sell, I had a little bit extra flexibility and freedom to do this. So done enough talking. Let's show you some numbers. Let's show you some pictures about what I'm talking about. Now, this is a sample asset mix. This is something that generally resembles kind of a baseline, a sample is something that I would look at, but this is by no means a recommendation. But it's a decent start of maybe how you may want to start looking at your own investments. Now, again, there's a note at the bottom. This is separate of your primary home. If you're fortunate enough to own your primary residence, whether it's a home or apartment, for a lot of people, that's their largest single asset. So I've excluded that from this. Just talking about like stocks and bonds and stuff, you can put real estate in there. Say, hey, I don't need international stocks. If you want to invest 10% in extra real estate because you want to be a landlord, I am. It's not worth it sometimes. But if that's what you want to do, if that's what you know, then go for it. So generally, for most American investors, having about half of their money in stocks, is a good starting point. Now, generally, most people will tell you if you're a registered investment advisor, which I'm not, if you're a financial planner, which I'm not, they'll generally tell you if you're younger, you can take on more risk. But it's not about age. It's can you take on more risk? If you can take on more risk, generally you can afford to own more stocks because you don't mind making more money and you're okay if you lose some now. Bonds are generally seen as a safer investment. And I think somewhere around the 20% range, that's a good start. If you want to own less, that's fine. You want to own more, that's fine. That's up to the individual. Now that 5%, which just happens to be color coded with gold, not a recommendation, it was just the first word out there, and I found a color that was kind of goldish. The $5 for every dollar, or 5 cents for every dollar you invest in, to kind of throw in those alternative assets, I think that's reasonable. Again, if you want to put 10%, that's great. The big thing here with the sample asset mix is the more you put into some of these riskier things, I think you'll generally see the higher the investment number are the things that are probably easier to understand. There's less variance and volatility in them. And the things that the lower number things, the lower number investments in this, you'll probably find that there's more volatility and variance in the returns. So that's kind of that built-in diversification. Nothing wrong with if you think gold or crypto or that fun money is swinging for the fences, that's great. But if you do that with 50% of your asset mix, now you're kind of moving into more gambling territory, which is fine if that's what you want to do. But you just need to make sure we're aligned to our goals. If our goal is making money over the long term, whether it's retirement, whether it's saving for college, whether it's whatever we're doing, let's make sure that our assets are aligned to those goals. And again, I throw out 15% cash. I think that's a good baseline. I wish I had 100% cash in March, but I'm not that good. No one's good enough to move money fast enough and be right every single time. That's why we diversify. We diversify to get rid of some of that risk and to make sure we're aligned to our goals every time. No investor is going to be right 95, 100% of the time. It's just not possible. And the history books and Wall Street is littered with people that tried to write algorithms and develop things that were going to be right 100%. Don't be a statistic. Let's find our goal. Let's understand what we invest in. And here's a sample idea of maybe how we can build some natural diversification into building things while also making some money along the way. I mean, that's why we do it. So I'm just taking a look at the clock. I think we got about 5 more minutes or so before we get to questions. Here's a quick reminder, if you have some questions, however you get them to, whether I believe there's a chat box or something, make sure you save up those questions. We'll definitely have some time after I'm done speaking to address any of your individual questions. So now that we've built our portfolio, and again, whether it looks like mine, whether it's kind of like mine, or whether it's flipped upside down, how do you maintain it going forward? That's the key. So you have to kind of build your own sample portfolio. And from that, it's really kind of based on your individual risk profile. If you're just like, you know what, don't need to own individual stocks, I'd rather own funds of stocks, or I'd rather own ETFs of stocks, that's great. Understand the stocks that go in it. You probably shouldn't be buying the spiders, the S&P 500 index, the Qs, the NASDAQ 100 index, and then be individually owning Apple or Microsoft, because that means you haven't done your research. That now means you own Apple and Microsoft 3 different times. Don't need to do that. That's not how diversification works. However that is, make sure you do your research. Now, we have to be nimble and flexible. You have to be willing to change your mix up. That can be for different reasons. Maybe there's change in your life, and your goals have changed, or maybe just the environment's changed. Look, the stock market environment from, say, late 2018 to today has literally flip-flopped 3 different times based on where interest rates are going, based on what we expect, what's going on in the world, based on what's going on in foreign relations, foreign trade, literally been flipped on its head several times. You don't have to change everything every day unless you want to, but you have to be willing to change with the times. Probably heard don't fight the Fed, and maybe it is different this time, but this falls in the category of not being allergic to make money. If you're bearish right now, it doesn't necessarily mean sell everything, short everything, bet against everything. There are ways to move your mixes into more defensive investments while not being allergic to making money if you're wrong. We're going to be wrong 40% of the time. By keeping that diversification, by keeping that hedge, we'll make sure that we live to fight another day, even if we're not perfectly right with predicting the future and how our investments are going to play. And that's what gets into my final point I want to make before we open the floor up to questions. It really can't stress how important having a plan is. Your plan can be very basic at first. Just write down what I want to happen, what I don't want to happen. From that, you can start to build that into actual individual investments. But by having that a plan, it doesn't matter if you've been doing this for 40 years, you've been doing this for 4 weeks. Emotion is a killer when you're talking about investments. If you're the kind of person that wakes up and you look over, I'm sorry, I'm looking at my TV right now. You're the kind of person that wakes up and you see, everything's down stock-wise 2 and 3%, and you're like, oh my Lord, get me out of here. It's going to be tough investing. So having that plan ahead of time helps remove some of those emotions you're going to have these days. I could talk about statistically the percentage of having these days. Just know they're going to happen. I don't know if it's going to be today or yesterday or tomorrow, but by diversifying, we have those natural hedges built in. We're owning assets across various universes. You'll be able to reach those goals, whatever those individual goals are. So with that, that's about all I have for my prepared remarks. I want to thank everybody for the time. And if you have any questions, I'd love to open up the floor at this point.
Oh, David, we have questions, that's for sure. They're lining up here. So make sure if you have any more, put them in the chat box. We'll try to address them. We got about 7 minutes or so here that we can answer some questions. So I'm going to start off with a short one, David. Okay. How do you feel about penny stocks? That comes from Kelsey.
So penny stocks. So again, like I said, I have quite a bit of experience in low dollar stocks and small cap stocks. Penny stocks are by definition one of the riskier stocks out there. Just know what you own. Look, if you're buying a penny stock to gamble, I'm just going to say this nicely. The stock market, they're in penny stocks, are generally people who have a better edge, and by edge, I mean they know more than you do or I do. I would say that if you see it as gambling, then I'd probably stay away from it entirely. But there are plenty of really good companies that I can understand their business, and they're just a smaller version of a company that is more of a familiar of a household name. Those are the penny stocks that I would focus on.
All right. Next one we have here is from Linda. What are your thoughts on preferred REITs or hedging or balancing a portfolio full of stocks? For hedging, I'm sorry, REITs for hedging or balancing. So when you talk about REITs specifically, this gets into more of where I personally believe investments are going right now. My knowledge of the commercial market, and it's pretty much the consensus view. I'm not going out on a limb here right now. My knowledge of the commercial real estate market is not that positive right now. And so if I'm looking at a preferred stock, normally I'm owning a preferred stock for the dividend. But what's generating the dividend? It's the rents from those commercial assets. A lot of companies are probably cutting back on the space they need, whether it's office, whether it's retail. Just look at, there's REITs out there that invest only in dorms or hotels that are next to colleges. I know they exist. Just be careful. Know what the underlying assets are that's generating the cash flow to pay those dividends. Right now for commercial, I think that's a tough ask in general.
And on the residential side, that's really just market by market. Rates are low, which is good in general for most real estate investments. However, I don't have the most positive, broader economic outlook right now, which would not be positive for housing prices, which are generally at all-time highs.
All right, excellent. David, this is from David. I would like to hear Dave's comments on precious metals, which have been in an uptrend for the past month or two. Nice question.
Fantastic question. Great name, David. Precious metals are something that I personally understand. They're something that I enjoy owning on a personal basis, but it doesn't matter why I do it or if I do it. The reason why they're going up right now is because they're seen as a general hedge against a weaker US dollar. And quite simply, you don't have to have a finance degree or an international finance degree to know that the more currency you print, which if you read the headlines in this country is happening a lot, it generally tends to devalue the currency, in this case, the US dollar. And it's been happening against most of the major currencies in the world. And I don't think we're done printing money. And by that, a lot of the stimulus plans that have been going on, it's literally creating new money. And what that does is generally more supply brings down the price and could ultimately lead to inflation. Now, there are cases in time when it's ultimately led to deflation, so we have to be careful. But that's one of the reasons. Now, if you're going to buy any precious metals, know this: gold is pretty much the one that's seen as the best global inflation hedge. But just be careful, because you'll see this if you look back at what happened in March and April. Silver, platinum are more industrial metals, so they actually went down quite a bit in the futures market because they're seen as going into car batteries and stuff like that, that they don't necessarily all move together. So just keep that in mind.
All right. So this one is from Connie. How do we identify companies that are about to be profitable? That's a loaded question.
No, fantastic. Look, the biggest Wall Street firms in the world, the brokerages houses out there, publish their estimates. There are simple screening tools. Can't speak for every investment platform out there, but there are a lot of good free websites out there. And almost all of them, whether it's proprietary or a third-party site, have a screening tool where you can screen for how much is this company going to earn next year. If you look for a company that's not earning any money now, that's supposed to earn some money next year, these estimates are more or less public knowledge. You can look for companies that are kind of on that cusp. And historically speaking, that's been a great time to invest in a company. Because Wall Street's reactionary, they're like, oh my God, this company's profitable all of a sudden. I have a stock that I sold this week. I bought it in April for 56%. Part of that's because the market was up a lot, but it outperformed the market, I believe. And I think it was a good investment then because they were on that cusp of profitability. That's why you saw that outsized gain.
All right. Well, we got a few more. We're getting to the end here, though, and there are many more questions. There's no way we're going to address them all. But this one is from handle CD. How is owning a dividend stock different than selling part of a position, since the dividend payout reduces the value of the underlying stock? How are they different? How are they similar, I guess?
That's a technical question. That's a good one. So depending on how you buy a dividend stock, if it's something you're really buying for the long term, I would look into a dividend reinvestment plan. Again, it takes that dividend and kind of takes the guesswork out of it for you. Me personally, I've always been someone that, look, I think I can invest my money better than other people, but that's just me. That's my ego talking. So I'll take that cash and I'll put it where I want to. But if it's really a longer term thing, look into a dividend reinvestment plan. Like I said, the data doesn't lie. 43% of the money, or 43-something% of the gains over the last 100 years, longer than any of us have been doing this, from the S&P 500 have been through dividends reinvested.
All right. Well, I think that's going to be it. Thank you so much, David, for all your remarks and thoughts on diversification all the way across the board. I guess you can't talk more about diversification than all the asset classes that we touched today. And we're going to be taking a short break here shortly, and we'll be back with Climbing the Market with an Option Ladder. I'll be speaking with Shelley Seagler from Snider Advisors. Thanks, David.
Thank you.
Welcome back to the Ally Invest Digital Conference. My name is Brian Overby. I am the Senior Options Analyst with Ally Invest. And our next guest speaker is Shelley Seagler. She's the Director of Education for Snider Advisors. I'm going to talk to Shelley about how they attempt to climb the market using an options ladder. I've known Shelley for quite a while. Shelley and Snider Advisors I've been friends with for, I think over 15 years now. And we're going to have a very strong and deep discussion about Snider Advisors and what their investing method is, and also how they use options inside their investing portfolio. So with that said, I'd like to bring on Shelley Seagler from Snider Advisors. Hey, Shelley.
Hey, Brian, how are you?
I'm doing well. We're rocking and rolling here on this digital conference. So, Shelley, I'd like to start by asking you, first of all, who is Snider Advisors and how did the company get started?
That's good. So Snider Advisors is a registered investment advisor. We're based in Dallas, Texas. We have been around since September of 2002. So I think especially after the past several months, we can say that we've weathered through just about every kind of market condition you can imagine. If you think about the history of our company, it is impossible to separate that from our founder, Kim Snider. So I'll give you a little bit of Kim's story. And Brian, you may be familiar with it, but for those of you who aren't, right out of college, Kim went to work for a small company that was rapidly growing, and they paid her in options. That was her bonuses, were stock options. And when that company went public, she was part of that IPO, and she actually very quickly came into the type of money that most of us dream about having. So she wasn't exactly sure what to do with that money. So she did what she believed was the responsible thing, right? She went to somebody that she had worked with in the past that she knew, she trusted. And this was somebody from, a big reputable firm. And so she trusted him to manage her money. But what happened is within 2 years, he had actually lost all of it. And keep in mind, this was in the period of time that's known as one of the most powerful bull markets in our country's history. So to lose that much money that quickly, especially in that period of time, took a special skill. But That's what happened. And so that experience really left her devastated, obviously financially devastated, but it also put her in this position where she was not sure who to trust. And she wanted to make sure that she never had to abdicate the responsibility of her portfolio to somebody else again. So she really set forth to get an education. She learned all about, finance and investing. She became a trader, the Chicago Board of Options Exchange. And in that period of time, she began to develop what is now known as the Snider investment method. So the Snider investment method is what Snider Advisors is known for. It's the cornerstone of our business. Now, from now until when Kim developed it, it's certainly evolved and it's changed. But what has not changed is that belief that we want investors to know exactly how their portfolios are being managed. So, for example, we offer full asset management services. We currently manage and advise on over $100 million using the Snider investment method. But what makes us unique is that we will teach people the exact strategy we use, so that they don't have to pay us to manage their own portfolio, so that they can totally do it on their own. Now, one last thing about our history. Kim Snider, who is our founder and my personal mentor, she has since retired. Now, as you know, Brian, Jesse Anderson and Tyler Curtis own Snider Advisors. They've done a fantastic job. And, we do our very best to stay true to the legacy that Kim created.
Oh, yeah, definitely. And I wonder, I hope that Kim's out there watching us today. But
Me too.
Kim, yeah, that would be awesome. That's how I got introduced. Was my first introduction to Snider Advisors was running into Kim and actually talking a little options with her. And I had attended one of her events way back in the day. So that brings up another question. When you're thinking about your registered investment advisory clients and all your other clients, it seems like you put a big emphasis on education. Why is that so important to Snider Advisors and your business model, to make sure that your clients are educated on what you're actually doing?
It actually gets back to Kim, right? So if you think about the way it's traditionally worked in our industry, there has been this reliance on the wealth manager. And so they had all the information, right? And they took the investments and they kind of did that behind a closed door. And it really didn't matter if the individual investor knew what was going on with their money. So we really try to just break that model down. What we do is we take the information that traditionally has just been in a book or just been in the head of that wealth manager, and we break it down in a way so that it's easy to understand and so that we can give it to the individual investor. And then once they have that knowledge, they're able to actually use it, right? And that's really powerful because that gives them control. It gives them control over their investments and their portfolio and their financial future and their retirement. I mean, that's everything. And I think there has been this belief for a long time that it needs to be the professional who's taking care of everything. And to that, I would say, nobody's ever going to care about your money more than you do. And because of that, you're uniquely qualified to be in control of your investments and your finances. You just have to have, information, and you have to develop a skill set, and you certainly need the confidence to make appropriate decisions. But all of that is very doable if you couple that with a solid financial education.
All right. So, Shelley, that's a great intro on Snider Advisors and some of the thoughts and behind how the company got started and some of the methodology. But today we've actually been talking a lot about just diversity in clients, in the world, in your portfolio. So you, as a director of education for Snider Advisors, what is your background and what actually drew you to the financial industry? I'm very curious to hear your backstory.
Well, my guess is that it's a little different probably than the typical person in our industry. I actually went to college on a performing arts scholarship. Right after I graduated, I became a high school theater teacher, which is a lot different than investing, but I will tell you it was super fun. I absolutely loved it. I still think about it and miss it all the time. But I reached this point really in my life where I realized I was probably in my early 30s. From the time I was 5 years old, I had been inside of a school that entire time. And I just wanted to know, what else was there for me to do in the world? And so I began to take classes. I took classes on investing and business. I went back to graduate school. And at the same time, Snider Advisors was looking for somebody who could do a couple of things. So they wanted somebody who could give Kim a break. Up until then, she had been doing all of the teaching and speaking. So they were kind of looking for somebody who could step in for her. But they also wanted somebody who could take these educational initiatives that they already had in place and really develop those and expand them. And lucky enough, they were not looking for somebody who just had an investment background. They really wanted somebody who could teach, who knew instructional design and learning theories and have platform skills. And that was obviously very fortuitous for me. It definitely changed my career and it changed my life. But when I think about it, I think it was really smart of Snider Advisors to look for somebody like that, because that educational background, it really has allowed us to create resources and programs and courses that most small firms they're just not able to offer.
All right. So we have a lot of similarities, actually. And I don't know if I've ever mentioned this to you before, but my father was a small town high school teacher. He coached baseball and basketball. My brother was, my uncle was. I was thinking my degree's in math. I was going to come and was thinking about being a math teacher to start with. And I kind of went down the same kind of path where I really got into investing, and I thought I would dip my toe in the water. And with the math background, I really started talking a little bit about options. So I really appreciate your story, and especially the fact that I agree with you that a lot of people, the ability to teach just seems to be a much harder skill than the ability to invest, if you will. So in all of my years of teaching, I've always seen that real good traders a lot of times don't make real good teachers. So they can trade a lot, and especially more active traders overall, but they're not really good at conveying that thought. So I love the fact that you come from the theater background, that you were a teacher, and obviously it kind of makes us a little bit, I understand why I enjoy your presentation so much over the years and all the time. So,
well, I enjoy yours too. I don't know if you remember, but I took a class from you many, many, many years ago, and it was an option class. It was fantastic.
Yeah, that's when I was with the Chicago Board Option Exchange. I was working there as a senior staff instructor. Yep, I recall that. Yeah, those are good times. It's been a while. All right, so now let's get into the methodology. Let's talk a little bit about your philosophy and methodology that is behind the Snider method that you've already mentioned. So how does options play a role? What's your philosophy overall in picking stocks? In general, what are you doing inside your registered investment advisory platform?
There's a lot to that. To be fair, it would probably take me about 8 hours to teach all of it. So I'll kind of give you a condensed version. But one of the primary focuses of the Snider investment method is that we believe the number one job of your portfolio is to produce a paycheck. So we have a real focus on using our portfolios for cash flow or for income investing. We also believe that market timing is a lie. So we're never trying to, get in and out of the market. We are definitely long-term investors. The way that we approach it is we will buy a stock from a financially sound, well-run company, and then we will use that stock to generate income through selling options each month. Now, we definitely, sell covered calls. We sell cash secured puts. As you mentioned, we use covered calls month in, month out. They're really our bread and butter. We do sell cash secured puts, but we use them more sparingly. However, it's not as simple as saying the Snider investment method is a covered call strategy, right? There's so much more to it, how we use our cash and how we structure our purchases. What we do instead of using covered calls is this standalone technique, we incorporate it as part of a more comprehensive approach to investing.
Right. And I think that's why I like the title of your event that we came up with today, Climbing Your Market with an Options Ladder, because that's really what you're trying to do by using the options and connected to an actual stock portfolio to try to generate some income above and beyond even dividends that the stock might pay. So who's your typical client for Snider Advisors? Where do they usually come from? What are they looking to achieve? Just in general, who seeks out Snider Advisors?
That's a good question. If I think about, I've met and taught most of our clients throughout the years. And the first thing that kind of comes into my head is we really do attract a certain personality type. And I think it is because we have that focus on do-it-yourself investing. So we like people, or I should say people who like us are people who like to be in control, right? They want to be the ones pulling the trigger. They want to have the knowledge. I think we attract a very analytical group of people. I feel like I've taught so many engineers and pilots, and I don't think I've ever taught a live event where I didn't have an engineer and a pilot. In fact, and if you think about the broader sense, who we really appeal to are people who are nearing or entering retirement. Because if you're in that situation where you're trying to figure out retirement, the single biggest issue you're going to face is how do you take your retirement portfolio, so this pool of money that you worked your whole lifetime to create, and convert that into spendable income that you can use to pay your bills and put food on your table and sustain a reasonable standard of living. So I do think a lot of people who come to us are in that situation where they're really thinking about retirement. Now, having said that, I want to be fair. Just because you generate income, there's no rule that you have to spend it, right? I mean, you can reinvest the income that you're making and get compounding benefit over time. And then when you are ready to retire, you don't have to find another approach to investing. You just have to start, we call it collecting your paycheck, or turn on the distributions or withdrawals from your portfolio.
All right. So with that said, and I know you've done a lot of education with your clients in general, and just education across the entire country on option trading and your investing method. What are some of the most common mistakes you see from investors in general? And then I'm going to tie in another question with that. What are some of the traits that help make someone a good investor?
Okay. Those definitely correlate together. I think some of the most common mistakes that we see relate to kind of investing 101, that people do not understand their objectives, their time horizon, and their risk tolerance. And I actually think it's that risk tolerance piece that they get wrong. It's like they either go too conservative, and in that situation, if you think even about like the recent market volatility, that's been scary for a lot of people. And they have this, natural inclination where they want to just take their toys and go home, right? They want to take their money, move to all cash, hide it under the proverbial mattress, because that feels safe to them. That feels safer than dealing with volatility. But if you think about cash over the past almost 100 years, after you factor in taxes and inflation, it's had a negative real return. So, I mean, that's basically saying, I'm not investing at that point. I'm not an investor. I'm just saving. And I think that's actually one of the mistakes people make is they treat money that they should be investing like it's a savings account. I also think there's this diversification problem sometimes where in an effort to be safe, people move all of their money to something like bonds or CDs, which are perfectly appropriate. Unless they're the entirety, in my opinion, of your retirement portfolio. In that situation, unless you have an obscene amount of money, just gobs and gobs of cash, you're not going to be able to live off of the yields that bonds typically give you. So that's kind of this conservative, I'm not going to do anything. And then on the flip side of that, I was talking to somebody a while ago, and I was asking them what they wanted to achieve. They said, "Well, I'd like to double my money in the next 2 years." And hopefully, I had an appropriate response. I was a little taken back. That's not an investment objective, not a reasonable one, right? And what happens when people have these kind of more outlandish expectations, then they start looking for techniques that, I'm sure you know this, they're highly speculative and highly leveraged and based on trying to get in and out of the market at the right time. And I mentioned earlier, we believe that market timing is a lie. I mean, there's a literal battleship of academic evidence that says it is impossible to consistently time the market over the long run. So I will, for the sake of being fair, it is possible to get an occasional market call right. Absolutely. But to do that consistently in a way that is going to allow you to meet your long-term goals, I mean, there's just so much academic evidence that says that's impossible to achieve. And I do think it boils down to those things, not knowing your true objectives and your true risk tolerance, and then not tying those things to your timeline. And as an educator, I also have to say, I think people don't have plans. They get little pieces of information and they will do trades. I'll do this trade or that trade, but they're not really thinking about how does that all fit together. Now, did you also ask me characteristic or traits?
Traits. Yeah, overall some traits. And actually, I'd like to throw a couple things in on the investors in general, what makes a good investor. One of the biggest things is just being able to take a loss. And we're going to talk a little bit about the option trading that you do and how you guys approach and build your ladder. But overall, one of my best, I like to consider some of my best trades are trades where I was actually down on, and I really wanted to hold. I wanted to play the hope game, but I actually sold and got out. And I think that's the hardest thing for beginning investors to do, is actually to sell a loser. And a lot of times you're missing out on other opportunities when you don't move on from that trade. Right, the stock might come back eventually, but when that happens, when we're doing these type of strategies, sometimes there was a better opportunity that you missed while you were waiting for that underlying stock to bounce back. And I love the way that you guys approach your investing overall, because you're not necessarily just speculating on exactly where that stock is going to next. You're using that stock as a vehicle to actually generate some income on. All right, so now let's get into some of the traits. So that's one of the big things that I see beginning investors and do. Mm-hmm. What are some of the good traits that make someone a good investor, Shelley?
There's so many. I mean, I think being naturally curious, which I'm going to assume most of the people watching us today are, that, they want more information and they love to learn. I think that's certainly a key thing. I think it's actually slightly different and similar in some ways to what you were just saying, that they don't, they're not always rational. Right? They don't always stick to their plan. So you can learn from the most brilliant guru there is, and you can have the best plan that's ever been created, but if you don't stick to it, you're never going to reap the benefits of it. Now, the Snider investment method is a long-term strategy, and as you said, we do own the stocks, and we will hold stocks if they go down in price, and sometimes that can be really hard, right? If you think about the past couple of months, how hard it has been to hold on to some of those positions when there is, a 24/7 barrage of bad news. We're in the middle of a global pandemic, and every time you look on the news or through social media, it's just, bad stuff coming at you. And that's really hard for investors. If I think back, though, to say 2008 and the great financial crisis there, I was receiving phone calls all the time from clients. I did not feel like an investment advisor in that period of time. I felt more like a therapist, right? These people were calling, they were panicked about what was happening to their money. And I will say those investors who did sell in that period of time, right, who bailed on their positions, I think they regret it, right? I mean, it's very sad. They had these paper losses that they locked into an actual loss, and they missed the recovery. But if I look at our client base, these people who actually continued to hold their positions through that period of time, they are, by and large, our happiest clients, our most satisfied Snider method users, right? Because not only did they not experience a loss, they got to reap the benefits of, the decade-long recovery that happened after that. But that that takes a lot of discipline. Maybe that's one of the best characteristics when we're talking about investors. It's really sticking to that plan, learning how to tune out not just the noise, but yourself. Because as humans, we are hardwired to, flee from things that cause us stress and pursue things that, feel good to us, that bring us pleasure. And that's fantastic for our survival. That's why, like, you and I are here today, because our ancestors had that instinct. But it is terrible for your investing, because once you start letting your fear or your greed kick in, then you're letting your emotions dictate your investment outcomes.
All right. Yeah, without a doubt, Shelley. And like, I actually have another instructor, and I'm going to steal this phrase from him. But he says, sometimes I'd rather teach a 6-year-old how to trade options as opposed to an adult, because the 6-year-old will usually do what you tell them to do. In other words, you see a lot of adults say, well, okay, the stock has done this, it's done that, it bounced off the Fibonacci, hit the Bollinger Band. It's definitely going to do, it's going to bounce back, and they play the hope game and don't adjust, don't do anything with their trades overall. And that is, you might say to yourself, oh, I would never do that. But it's real interesting how many people I've heard say that. And then when it comes right down to it and they have money invested, they can't follow their plan.
Yeah, you're right. I mean, you're absolutely right. It's different when you're teaching it in theory versus when it's actually your money that's in play. You reminded me earlier, you asked me where our clients come from. And I don't know if I ever answered that, but you reminded me, we actually do have a lot of novice clients. And like you were saying with a 6-year-old, sometimes they are easier to teach. Sometimes I think, the more information, the more experience somebody might have as a day trader, the harder it is for them to kind of stick to that system. So, I definitely have an affinity for those novice investors.
All right. Yeah, without a doubt. All right, Shelley. So thanks for the background. And now let's talk a little bit of options. We're getting to the end of our segment here. So let's dive into some market related questions. I would love you to teach us how to climb the market with an options ladder. So tell me how you generate income through options and how you use that to build your ladder portfolio overall, I guess.
Okay. So I mentioned earlier, I think I might have, that the Snider investment method is really systematic. So we follow, the same steps, the same guidelines, the same rules month after month. We have very specific rules about how and when we buy shares and how and when we sell options. So I'll kind of start at the beginning. If we were to open a new stock position, what we would do is we would buy a limited number of shares to begin with. We always buy in increments of 100, of course, so that we can efficiently trade covered calls. But let's say, just for our example, we buy 100 shares of a stock. At the same time, we're going to sell a call, one strike out of the money, and then one put at a lower strike price. What that allows us to do is to generate both premium from both the call and the put in that first month. Now, we sell monthly options. So if we jump ahead to expiration, let's say that on that expiration, the stock price has gone up above our call strike price. That position, that call is exercised, that position is closed. We sell our shares. Well, the great news about that is we made those 2 option premiums, and then we also made some capital appreciation on that profit from sale of stock. Now, in that situation, what we would do is we would do it all over again, either on that stock or another stock. We'd buy shares, sell calls, sell puts. Now, on the other hand, if that price declines, and let's say it declines below the strike price of that put, in that situation, that put would be exercised. We'd be assigned another 100 shares. That's fantastic, because even if that put was not exercised, we'd actually go out and buy another 100 shares. So in other words, our goal in the second month, if that position is not called away, is to own 200 shares so that we can sell 2 calls. And then in subsequent months, we're going to do the same thing. We're going to buy shares and sell calls. Now, here's where the laddering piece comes in. So if you think of laddering from the fixed income world, you have laddered CDs or laddered bonds. You would use a bond ladder, for example, in an effort to smooth out fluctuations in interest rates. So what we do in the Snider method is we take that concept and apply it to covered calls in an effort to smooth out the variation in that stock's price. Specifically, to continue to generate income from a stock that's had a decline in price. So in the Snider method, we have guidelines about when we can buy shares. As I mentioned, those guidelines actually put us in a position where we can only accumulate shares if they go down in price. We limit how many shares we can buy at any particular price range. Now that accomplishes two goals. First of all, we do a modified form of dollar cost averaging. So instead of spending the same amount of money each month, we buy the same number of shares each month. By buying them at cheaper prices, we're lowering our average cost. We're able to get out of that position at a profit at a lower price. Additionally, if you think of each purchase that's made as the stock is declining as being a rung of your ladder, as those prices go down, we're able to sell calls over a wide range of purchase prices and stock moves, right? And so what that allows us to do is to take a stock that has had a precipitous decline in price and still be profitable. That's really important, right? It's not just important if you think about the past several months. We know that stock prices go down, but if you think about a lot of our clients are using the strategy for retirement. And we know that the average couple is looking at, say, to spend 30 years in retirement. In that 30-year window, they are going to experience both bull and bear markets. And outside of an official bear market, there are going to be regular declines. They cannot use a strategy that only works when stock prices are rising. And that is really why this laddering concept is so crucial in our strategy.
All right. So with that said, if you think about, and that's where the term calls and puts comes from, right? Because you're selling that call saying, please, please call that stock away from me. And then if the stock goes down, you're saying, please, please put that stock to me.
Right.
And that's what you're doing when you're selling option contracts. You're saying, go ahead and call it away. I'll get cash now for saying I'll sell my stock later. And then you're also with the puts. You're saying, gosh, but if the market goes down more, I feel confident in this company, and go ahead and put stock to me. I have the cash. I'm willing to buy more. And if anything, I can sell more calls against it. So I did pick up something from what you said. You said you usually trade monthly options. That's the expiration period that you like to sell. And my question then is, why? Why do you like monthly options? Why not use the weeklies that expire week in and week out?
It is a really good question. It's one we get a lot. There are a couple of reasons for it. So one is our primary objective is consistent monthly income. And so, those monthly options certainly give us the opportunity for that. It also gets back to, what would you rather spend your time doing, trading or living your life? So we have the opportunity to trade 12 times a year instead of 52 times a year. There's also research that says the more frequently you trade, the more likely you are to actually lose money. So we want to find that balance there where we're trading enough to generate, that consistent monthly income, but not so much that we could ever be doing something detrimental to our portfolio.
Oh, yeah. Excellent. Without a doubt. Okay. So now please be putting your questions in, and we're seeing a lot of them come into the chat box. We're going to save some time for that to try to answer as many of those as we can. But before we get too far along, I got a couple that I'm going to start with right away here on the questions. We got about 10 minutes or so that we can answer some questions. How can they learn more about Snider Advisors? Tell us a little bit more about your website and everything else that's involved.
Well, I love that question. I'd love for you all to learn more about us. We have a website. It is snideradvisors.com. You can go there. You can learn about, the Snider investment method. You can learn all about Snider Advisors. Our website is really focused on education. So we have a great blog. Every blog post we write, we attach like a handout to. So, a checklist or some sort of guide or resource that you can use. If you look at the bottom of the page, you're going to find a link to our events. Next month, I'm teaching a 4-part free webinar series about cash flow investing and using options and all about the Snider investment method. So love to have y'all join that. So that's all at snideradvisors.com. We also created kind of a special page today for people who are watching, and that's snidermethod.com. If you're watching and you go there, you can download a free ebook. It's called The Ultimate Guide to Selling Covered Calls. We'd love for you to have that. And you can also call us. So, we have a toll-free number. It's 8886-SNIDER. I should mention, hopefully it's been on the screen a few times, but it is Snider with an I. So it's 8886-SNIDER. But, we would love to be able to interact with all the people out there and see how we can help you.
All right. Well, excellent. Thank you for taking the time for letting us know all that information. And we've had a relationship with Snider Advisors for many years now. And I know that we've been basically your broker of choice for that time period. So that's
right.
Much appreciated also.
Well, yeah, we're certainly happy to recommend you to our clients. You'll do such a great job with them and make it very easy for them to trade the Snider investment method.
All right. Let's get to some of these questions. They are piling up. Okay, so I'm going to start with the first question, a very simple, short question. CD Andrews says, where do options fit into portfolio allocation? I guess we kind of covered that a little bit, but maybe a little bit more fodder around how you use it to diversify your portfolio, or I guess to build your ladder.
Yeah, so it's a good question, actually. If you think about options themselves, they don't really offer much, and at least in our strategy, they don't offer much diversification. The way that it works for us is we have a very specific stock selection set of criteria. So, and I'll give you kind of the Reader's Digest overview of that, and then I'll get to your specific question. But we of course look for well-run solvent companies. We use rapid ratings, which is a bankruptcy indicator, to make sure we're getting into healthy companies. We want stocks whose options are actively traded so that we can generate more option premium. But really the last bucket of information that we use when we select stocks, we have screens to make, I shouldn't say screens, we have things in place to make sure that all our accounts are appropriately allocated, meaning that we don't ever want too much of your portfolio to ever be in one particular stock. We don't want one stock to dominate your portfolio. We also use sector and industry diversification to make sure that there's balance there. What's interesting is a lot of our clients don't have one account. They have multiple accounts. They'll have his and her IRAs, and then they'll have a trust or a taxable account. We actually use that sector and industry diversification across the big picture, not just in an individual account. For us, the options don't actually offer that type of diversification. It's the stocks that do, and then we just use those options to generate income from the stocks that we hold in our portfolio.
All right. And then I have Mohammed that has a very similar question. I think I'll let you just give a little bit of fodder, maybe around the software that you use. But what criteria do you use for selecting the stocks that you're going to trade options on?
Okay, so I touched on that a little bit, but I'm happy to give you more information. We do have a proprietary tool that we use for stock selection. It also offers record keeping, and it offers automated trading specifically with Ally, it's a fantastic tool. It makes it super easy to trade, but we really do look at 3 buckets of information. So again, we want to buy stocks from financially solvent, well-run, healthy companies because we're holding them. So we want to make sure we're buying companies that we are comfortable holding for the long term, even if they have a decline in price. So they have to be, there has to be a really rigorous screening process there for the stocks that we choose. The second bucket is options. Our goal is income, right? So we have to make sure that in the big picture, if a stock doesn't have options traded against it, it doesn't serve a purpose to us. So it's not just, though, that there's options available. We measure open interest and volume to make sure there's liquidity there. We choose options that have richer option premiums, specifically on that covered call. So options are a key component of our stock selection. And then the last thing is what we were just talking about. It is not a one size fits all. We are not going to make the same stock recommendation for all of our clients because they're all unique and individual, and they have different account types and different amounts of money that they're working with. So we make sure that we are looking at, it's tailored to their account, their diversification, and their specific allocation.
All right, Shelley. Well, this next question here from B. Berg is actually for both of us. So first of all, the person asks, I'm not quite sure if a he or a she or what B. Berg is, but overall, does Ally have a video on using the Ally Invest platform to trade options? That's to start with. Well, I'm going to tell you that I'm actually going to be doing a webinar on spread option trading here right after we get done with Shelley and Snider Advisors, and I'll be showing off the platform a little bit in that webinar. And then also you can check out our stock play of the day. It's Mondays at 12 p.m. We do a live trade on that show. We actually show a trade. It's just meant to be not meant to be a recommendation, but we do that every Monday at noon on the Ally Invest platform, noon Eastern time. And then the second part of this, Shelley, is you've mentioned that most of your people are retired. Can you trade options in an IRA account?
Yeah, you absolutely can. Now, I do get that question a lot. I think it comes from the old days where options were not, specifically puts were not allowed in all account types. But now you really, for example, the Snider investment method, you can use it in a taxable account, certainly, but you can use it in a traditional, a Roth, a rollover, SEP, a simple, a trust. I mean, most account types now at most brokerage firms are going to allow you to trade both calls and puts within your within any portfolio type. You do have to have the right trade level set up. That's something, if you're one of our clients, we can help you with, or Ally can help you with, to make sure that you have the appropriate trade level set for your account.
Mm-hmm. And then this next one, you've kind of addressed it, Shelley, but I do think that it's worth addressing again. Eric is the person that posted this, and he says, do you use the call options to execute them and purchase the underlying asset, or do you buy and sell the options themselves? You kind of implied a little bit about how you're using the options, but could you go in a little bit more detail about exercise and assignment versus buying to close and selling to close your option contracts?
Yeah, I'd love to clear that up a little bit. So this is how it works. We buy stock, we sell or write a covered call against the shares that we own. That call obligates us to sell our shares, to sell that underlying asset. So if the stock closes above the strike price of that call, we're going to automatically sell those shares. Those shares are going to be, as Brian said earlier, they're going to be called away from us. Now, the way that the puts work for us is we sell puts. We typically sell them slightly below the current share price, what that stock is currently trading at. When we sell puts, we're obligating ourselves to buy shares. So if that put is exercised, we're assigned, or as Brian said earlier, it's absolutely right, we're put another lot of shares. We actually never buy options. And the reason for that is, to us, it falls in that realm of trying to time the market. We're not betting that stock is going to go up in price or down in price. We just want to use the shares that we own to sell options to generate income. So hopefully that clears it up a little bit.
All right. Yeah, without a doubt. And right, the overall concept here of the way I think Snider likes to approach their option trading is that you're neutral to bullish on the marketplace. You do okay if the stock just stays where it's at. You do better if it goes up, but if it goes down, you got a plan. And that's everything that we've talked about here so far on the digital conference, is having a plan, trying to stick to your plan.
Right.
You're not always going to be right on the stock, but you got to have a plan in case you're not. All right.
That's right.
So where do I get a database to check the stocks? I'll let you talk a little bit about that, but that comes from Allison. Just in general, go ahead, I guess, talk a little bit about the software that you like to use.
Yeah, so we have created a software. It's called Latco. That's just what we named it. But there was a question earlier about this, and I can give a little bit more detail about that stock selection. I kind of give a high-level overview. We actually we offer an online course to teach the Snider investment method. Part of that online course is that you can get the exact criteria that we use. I mean, we want to make sure our clients totally understand it. That online course also includes access to that stock selection tool. So, we certainly don't want there to be like smoke and mirrors there. We want to make it very upfront to our clients exactly what we're using. We also, I wish I could remember right now, we do have that data available on our website somewhere too, for free for anybody to review. We also offer a free covered call screener that has great information. You can, it's a little harder to find, but we're happy to give it to you. You can give us a call and we'll give it that 2 years. You can also email us at support@snideradvisors.com. We have a lot of resources in place to help people find these stocks to trade so that they can sell option.
All right. Well, we have a time for just a few more questions here. I have a little bit tougher one. David G. Right now, it seems like option trading on companies affected by the pandemics, such as travel companies, airlines, cruise lines, may be good choices for this approach to trading. Any comments?
Did you
I'm glad
say
you're answering this one, Shelley.
Maybe or may not be good choices?
May be good choices. Do you agree? They may be.
The truth is maybe. I mean, you're right. They may be or they may not be. I think there's a lot more to it than just thinking, oh, now's an appropriate time to buy this industry or that industry. It really does get to what does the data say? What are the financials of that company, both in the past and, what are they predicted to be in the future? And that's why we have very specific screens. I mentioned earlier, we use rapid ratings. I mean, it's a bankruptcy indicator. It's looking to see, what is that company's propensity for bankruptcy over the next, say, 1 to 3 years. I would rather rely on those screens and that data than some sort of more broader feeling about a particular industry.
All right. Next, Troy. This sounds like an expensive option, an expensive strategy. How would someone begin with an order to be successful with covered calls and cash secured puts? An expensive strategy? A little bit. Did you grasp that overall? This sounds like an expensive strategy. How would someone begin with an order to be successful with covered calls and cash secured puts?
That actually, I think I know where he's coming from. First of all, just real quickly, we offer an online course. You can find about that on our website. It's not super expensive to take, especially if you compare it to other people. So just to learn the Snider investment method, not particularly expensive. To use the strategy, to be clear, you can, as long as you can buy 100 shares of a stock, you can sell a covered call. We do have a minimum investment, and it's $25,000. So that's the minimum amount that we use in the Snider investment method. The reason for that relates to that ladder. It's how we structure our purchases. It's, we want to buy quality stock. So we don't start our strategy with a stock that's trading at less than $25. We'll buy it if it drops below that, but there is kind of that floor there where we'll make that initial purchase. So, if you think about us being geared towards retirement more, $25,000 is not a retirement size portfolio. So I think expensive is all relative. But to create that ladder, it does involve making more purchases of a stock. So you would have to have enough capital set aside to accomplish that. I think that's what the question was.
I think that sounds good overall. Okay, so David G had a question about the expiration. That might have came in after we addressed it, but we did talk a little bit about why you're doing monthly options. Mm-hmm. And then the last one, I think this was a great one to end with, Shelley. Allison asks, do you suggest investing in options for a beginning investor?
I do. Yeah, I do. I think what's more important than your experience level are your objectives. So, you need to figure out if something like covered calls or the Snider investment method, if they fit your objectives, then, you can learn how to use the strategy. In fact, I mentioned earlier, I love to teach novice investors. They're, a blank slate. And I will also add, our courses first of all, covered calls are not that complex. I mean, they're relatively easy strategy to learn, but the way that I teach is I give you pictures so that you know what an option order form looks like. So there's never a question about what you're doing, right? We want you to have that education and that confidence. And, we offer ongoing support. So anytime one of our clients needs help or has a question, we actually offer remote trading assistance. So at no additional cost there. So, I mean, it's a fantastic service. And I also know that Ally has great customer service as well. So you'll have plenty of support if you do decide to move forward.
All right. Well, that was a great event. I really enjoyed catching up with you, Shelley. It was great that we had some time together. We got to schedule more digital conferences just so that we can chat.
I agree.
Forward. Yeah, all right. Okay, everyone. Well, I'll let you sign off here, Shelley. But next up is myself, Brian Overby, Senior Options Analyst at Ally Invest. I'll be talking about sharpening your options game. So come back at 3:45 Eastern time, and we'll be kicking off that event. And I want to say thank you to Shelley, and I know Jesse's probably out there too. Thank you, Jesse and Snider Advisors, for hanging out and allowing us to have this nice little chat about investing and option trading.
Yeah, thank you so much, Brian. Thank you.
All right, everyone. See you in a bit. Welcome back to the Ally Invest Digital Conference. This next speaker doesn't need any introduction because it's me. I'm Brian Overby, the Senior Options Analyst at Ally Invest here. And I'm going to take the options game to the next level. We just had a great conversation with Shelley Seagler, the Director of Education at Snider Advisors, and talked a lot about covered call writing. I'm going to take options to the next level. We're going to talk about long call spreads. And I think if you are trading options overall, especially if you like to buy option contracts, we talked a lot about how to use options to enhance a stock portfolio in the last segment. Now, if you're thinking about buying options, I think it is pretty important that you understand and are not afraid to expand your option knowledge and learn a little bit about spreads. So, who's the perfect person to attend this event right now? Well, maybe you've done a little bit of option trading. You actually know what an option contract is. You maybe bought a put or you bought a call. And now it's time to go to the next level and learn about the next type of trading, actually the next level that you can be approved for inside your Ally Invest trading account is spread trading. So let's jump into it right now. Okay, so now options, when we talk about options in general, it's always important that you get a copy of the characteristics and risks of standardized options. Now, you can get that by going to ally.com/invest/disclosures. So I just like to highlight that whenever I'm going to get into more advanced option trades. Okay, so what is an option? I'm going to spend 2 minutes, maybe even 1 minute on the basics. So an option is a contract. Now, that contract will give the owner the right to buy or sell an asset at a fixed price for a specific period of time. And it obligates the seller to take the opposite side if and when the right embedded in the contract is exercised by the owner. Now, what does this really mean? What is this all about? Whenever you're trading an option, you're trading an actual contract. And there's a lot of terms that are similar to the insurance world, if you will, in that an underwriter writes a contract and then you would buy that contract. So what does that mean? That means that if you buy that contract, you get a right. The person that sells that contract takes on an obligation. So the bottom of our slide here, we see buyers pay cash and they receive that benefit or that right. Buyers pay cash and receive that benefit or that right. Sellers receive cash and they take on an obligation for doing so. And this is where the term calls and puts come from. If I sell a call, that means that you have the right to call stock away from me. If I sell a put, that means that you have the right to put stock to me. And here's the 4 basic trades that we can do with options in general. And we're going to highlight the 2 that we're going to focus on in this PowerPoint today. If you are the buyer of a call, that means you're going to have the right to buy the underlying asset, right? So in our instance, we're only going to talk about stock options today. We're going to make it simple. Options can be traded on a lot of different things, indexes in general, futures contracts, but we're going to focus on stock options. So if I buy a call, I'm considered long that call after I bought it. I will now have a right to buy 100 shares of that underlying stock at that predetermined price. We call that the strike price. The other side of the coin is, well, if I sell an option contract, I take on an obligation. I would be considered short that contract after I sold it. And I'd also be referred to often as the writer of the contract. And I'm going all the way back to those insurance things that we were talking about. Now, what I have highlighted, I have circled here is the right to buy for the call and the obligation to sell on the call option. That's the trade we're going to look at today. That's called a long call spread. Now, obviously, if we went over to the right-hand side under the put, if we did both of those, that would be a long put spread. Now, this is all dependent on what strike prices you're buying and the different expiration date. So let's get into that. I have a fictitious example of a long call spread, just using XYZ stock. We're going to look at a real trade, and I did promise a question earlier in the event. Somebody asked, well, I will, if we have time at the end of the show, talk a little bit about the Ally Invest option trading platform, and I'll highlight a trade or two for you, a couple of long call spreads overall. But nothing here is meant to be a recommendation. We're just going to learn here, and that's what this digital conference is all about. All right, so our long call spread, we're bullish, first of all, realize that. If I buy a long call spread, I'm saying I want the market to go up. And to determine that, I need to look at the strike prices that I'm buying. So in this instance, XYZ is a fictitious stock. We have it trading at $63.90. We're going to buy one 45-day. So we're just going to go up 45 days. We're just picking a generic example here. We're going to buy the 60 strike call. So that call is in the money relative to where the stock is at. We are then going to go out of the money and we're going to sell one 45-day 70 strike call. We're paying more for the in the money call and we're receiving less for the out of the money call. So this is done for a net debit of $4.50 to the account. So this is how I've set this entire trade up. We'll look at the profit and loss graph overall, but I can execute this inside the Ally Invest platform all as one trade. And that's what we're going to focus on to start with, just doing a long call spread as a long call spread. We're not going to buy the option first and then sell it later. We're doing this all as a call, as one spread. We'd say we are going to put this in at a limit price of $4.50. And you'll see that we actually have it in parentheses, meaning that this is a debit to the account. So this would be $450 plus commission. Now, just like if I bought the option outright, the cost would be $6.10 overall. Now, that would be my maximum risk. If I just bought that call option, it would be $610 plus commission for one option contract. We've lowered our risk now. We brought it down to $450. But in the options world, it's always a give and take, right? We have lowered our risk by selling that option, but from 70 on up, our upside is capped. In theory, on a long call, we have unlimited upside. The stock could, in theory, go to infinity, right, over that time period. Most likely it wouldn't, but in theory, that's our upside with a long call. When we're looking at a long call spread, we are reducing our risk now, but we're capping our upside later. Okay, so let's just talk about the max risk and the max loss and the break even, just in short, and then we'll look at a profit and loss graph. Okay, the max risk is going to be the net debit paid, just like if we bought that option contract, we bought an option contract outright, that would be our maximum risk. And in the option trading world and the spread trading, if you pay a debit, usually that's going to be your maximum risk too, and it is in this case. So it's $4.50, or for every one-by-one spread that we did, $450 plus commissions. Break even, or a max profit on this. We look at the width of the spread to determine that. 670 minus 60, if we look at the strike prices, is $10. So the width of the spreads here is $10, 10, I guess I got to use both hands to get to 10, minus the net debit paid, which is $4.50, or our maximum profit potential is $5.50. So our downside risk is $4.50, our upside risk is $5.50. But the most important number that I want to start with, if we do this, stock started at $63.90. We need the stock to get to at least $64.50, which is that strike, the 60 strike call, plus the $4.50 that we paid for it, or $64.50 overall. All right, that's the long call spread. Now, if I'm doing this trade, I need to realize that, yeah, there's a difference between where the stock is at and where the break even is at expiration for this trade. This would mean 45 days from now, this is where our break even would be at. We'd need it to move about 70 cents. Now, if it happens before expiration, that break even will move because there's a time component in the option contract. So let's talk a little bit about that time component, because to me, this is the main reason why you'd want to do a long call spread overall versus buying an option contract outright. All right. So here's the long call spread, and we have a profit and loss table. I'm going to go through this fairly quickly, but we're just going to fast forward to expiration. We're going to look at different prices and what the intrinsic value or the real value of the option contract would be at that expiration date. So we have a 45-day option. We're going to fast forward and notice stock now is at expiration. If the stock goes down to 55, here's the good news and the bad news, right? We lose, if it's at 55, our 60 call, the right to buy stock at 60 does us no good. But also that obligation that we to sell our stock or our option contract via the assignment at 70, well, that's worthless also. So our net loss is that 450. And that's true from 60 on down to 55, on down to 50, down to 30. It doesn't matter. This option would expire worthless, and this one would also. We lose the 450. Now, our break even, like I said, we need it to get to 64.50, which is the debit that we paid, plus that strike price of 60 to get to a net. We'd have a net loss on our long option of $1.60, a net gain of our short option of $1.60, and our break even would be 0. All right. Now, on the upside, from 70 on up, we get capped, right? So at 70 is where our obligation kicks in. Our call option should be worth intrinsic, real value, because we're at expiration. It should be worth at least $3.90. That would be our profit and loss. Well, I'm sure to say our profit on that position would be $3.90. Our loss would be, our gain would also be $1.60 because that option contract would still expire worthless in theory, right, at 70. So $5.50 is our upside, and that's where it's capped. From there on up, that's the way the cookie crumbles. We cannot gain any more than $5.50 on this position on a $4.50 investment overall. Okay, now here's where here's the graph that I'd like to talk about more so. This, I think, explains it. A picture's worth 1,000 words, right? This is a profit and loss graph, and we're fast forwarding to expiration. So if we fast forward to expiration here, we see the x-axis going across here. The x-axis is the stock price at expiration. The y-axis, the up and down axis, is the profit and loss of the entire position of both option contracts. Now, I've taken the time to put in the long stock position here. Long stock, if you just bought 100 shares of stock, now remember, our option contracts each represent 100 shares of stock. You have the right to buy 100 at 60 and the right to sell, or the obligation to sell 100 at 70. So long stock at 63.90, well, this is what our profit and loss graph would look like, right? We'd have substantial upside, basically infinite in theory. On the downside, we have all the downside all the way down to 0. Break even right at 63.90. Okay, now we're going to fast forward to expiration on the options contract, and basically from 70 on up, we have limited and known upside. From 60 on down, notice our strike price, we have limited and known downside. So basically, if it's not between the strike prices, we're just going to take our ball and go home. We're not going to play anymore. But between 60 and 70, we do play. Now, one thing to highlight here, and that I've done on the graph, is that at right here at 63.90 and 64.50, right? These are our break evens. Our break even on the option strategy is just a smidge above the break even on the long stock. And why is that? It's because there's a time component in this. In other words, we are buying more time premium than we are selling. And that's what creates that difference in the break even at expiration on our spread strategy here. Okay, so how can we adjust that? How can we control that? And that's the next slide here. We're going to talk about spread time premium analysis. I know it's a mouthful, and I know don't get too excited out there in the YouTube space, but in general, spread time premium analysis means we're going to look at how much intrinsic value we're buying on our option contract and how much time value we're paying for on the option contract also that we're buying. And then obviously we'll look at the out of the money option contract, and that's all going to be time value, and we're selling that option. So to start with, we know that the stock was at 63.90. The 60 strike call option, pretend this is an option chain, right? The Ally Invest option chain, if you will, is trading for $6.10. We paid $3.90 for it. The total time value, that means, we paid $6.10 for it. The intrinsic value, if you take the strike price, and you subtract the stock from that, you get $3.90. So that's real value. If we exercised our option today, we would have $3.90 worth of value in that option contract. The time here then is $2. The total time premium then is whatever's left, and that's $2.20. We sell this option contract for $160, and we see that in that instance, we have no intrinsic value, right? It's out of the money. The stock is the call price is at 70, and the stock is at 63.90. There's no benefit to exercise that. If you exercise that option contract, you just get the stupid award for doing it, right? You'd be buying stock at 70 when you could buy it on the real market at 63.90, not via the option. So in short, we see that the time premium of this entire spread, we're paying $220, we're receiving $160. Our net time premium is 60 cents to the account. So we're paying that time premium of 60 cents. What was the difference between the break even? Well, we look back at the chart, 63.90, 64.50. It was that 60 cents overall. So that was that spread helped us, as opposed to buying the option outright, helped us manage our risk, helped us lower our break-even point, and gave us less susceptibility to time premium. Okay, so if I'm going to trade spreads, this is a benefit that you get. You can play games with the time premium in your option contract. So let's look at another spread. We're going to look at doing the same underlying stock here, but we're going to buy the 60 call, and we're going to sell the 65 call. Remember, before we sold the 70, we made it 10 points wide. This is now only 5 points wide in general. So we're paying that same 610, but the 65 call was trading for 290. The net debit is 320 now. That's why it's in parentheses. That's our max risk, 320. Our max profit is going to be the width of the spread, 5 points, 65 to 60, minus 320 or 180. And our break even will be 63.20 on this. The strike price plus the 320, 63.20 overall. All right. So if we look at the time premium analysis, this is the new spread. That's how I highlighted it on our slides. The time premium analysis here, now it's not a negative number anymore. It's a positive number. Why? Instead of selling 160 worth of time premium, we're selling 290. So now we're actually paying a debit for this trade, but one of the biggest downside of long option traders is their susceptibility to time premium erosion as expiration approaches. Or to say it very layman-like, is time decay. The time decay in the price of that option contract always accelerates as expiration approaches. So now we've actually set up our strategy where we're net positive time. We've sold more time, 290, than we bought, 220. So guess what's going to happen to our break-even line on our x-axis relative to the underlying stock? We're going to actually have a lower break-even of 63.20. I apologize for jumping back on the slides. Versus 63.90 if we bought the stock outright. Why? Because we sold 70 cents more time premium than we bought. Okay, so why am I bringing all this stuff up? Why are we talking about this? If you've been buying options and you've been buying calls, you've been buying puts, in this marketplace, actually, the buyers of options in general have done better than sellers of options. Now, this is an unprecedented time. And why do I say that? I say that because if you're buying options and you've gotten your forecast correct, the markets have been more volatile than what the marketplace has been implying overall. Now, this is just looking at the implied volatility of the option contracts relative to what the actual stock has done. And the stocks, and I think you might agree, have actually been more volatile than less volatile. On the way down, they went down harder and faster. And on the way up, they went up harder and faster than anticipated by the marketplace. So overall, it's been good to be a buyer of option contracts. So if I'm doing this and I'm buying options, what's the next step? Well, it's learning how to manage the hardest component of an option contract, the time premium component. So if we do this and we decide that we want to do this 65 strike, we don't have as much upside. We don't have 10 points in width between the strikes. We only have 5. But we know that if the stock just stays where it's at, we're actually going to make 70 cents on this trade if the stock stays, if the stock stays where it's at, or even drifts lower. If we go all the way down to 63.20, where our break even is at, if the stock goes down to 63.30, guess what? I'm profitable on this trade at that expiration date overall. All right. So what does this mean, first of all, in spread trading? So I'm assuming this is our first foray in long spreads. If I'm looking at a long spread trade, here's what I have. We have this trade that we're highlighting is the one where we paid a net debit of $320 to the account. If we look at our profit and loss graph, we're at expiration, which is the Ally Invest plum color that we have here. From 60 on down, the max loss is that $320. From 65 on up, our max gain then on this position is not going to be quite as much as it was on the other side, right? We have a little bit more risk than the reward on the upside, but there's a lot of benefit that comes with it. So $5, the width of the spread, minus the $320 that we paid for it, that is going to be $2.80 overall. So that is our max upside. $1.80, and that'll be our max upside on the trade. And you can see that right here on our graph, $1.80. That's where our max upside is at. Okay. So once again, between the strikes, we play. If the stock goes down below 60, above 65, we'll take our ball and go home. We don't play anymore. Now, I've highlighted on this graph, I've actually taken the time to go on it and look in theory what happens with 20 days remaining, what happens as of today, and what happens at expiration. Remember, we started with a 45-day option contract. So today would be the blue line, day 45. Here's the one downside of doing spreads is that if it reaches your strike and it does it right away and you get no time premium decay, you have one option contract that is saying, I would like the market to go down. And that's the option that we're selling. You have one option contract that says the market wants to go up, and they kind of fight with each other as long as there's time value in that option contract. So it's better if I do this trade if the stock takes a while to get to my high strike, to get to the 65 strike. At day with 20 days remaining, which means 25 days have gone away, I'm a little bit closer. And then in that last 20 days, it's like, wham, I hit my max profit. So this is just something that you should highlight and you should know and be aware of. If I'm trading long spreads, I got to be very particular about the expiration that I'm trading. It means a lot more on my forecasting and when I think the underlying stock might move. Now, if the stock skyrockets from 65 and just skyrockets all the way up to 70 or 80, yeah, all the time premium is going to go away anyways because both option contracts will be really deep in the money overall. All right. So with that said, things to think about when we're looking at options. And then I need to ask you to have some questions now. Go on in and answer, start asking your questions in the chat box. I'll try to address them if I can. I'm on my own here. So if you can start typing them up, we'll get them up and running and I'll be able to look at them and I'll see if I can address some of your questions. But I think I'm going to cover a lot of them right here. This is my favorite slide, things to think about. Now, I'm going to highlight here, the moral to the story is long spreads to outright buying. We're comparing that. These are things to think about. If you're thinking about outright buying an option, and an alternative could be a long spread. So here's some of the things. Long spreads usually have longer overall time have lower overall time decay, lower overall exposure to time decay. And we showed you that you can even set it up as a positive time decay strategy. If you choose your strikes right, you can set this up so that time is your friend when you're doing an option strategy. That also means there's less susceptibility to implied volatility. Now, we haven't talked in detail about implied volatility, but that's also a component of an options price. And if we know earnings are coming, there's a known noon event that can increase implied volatility and can affect any of your option strategies, especially if you're just buying them outright. So since we can control the amount of time value, implied volatility can only mess with time value. All right. More commissions with long spreads. There are still commissions in the option trading world, but they are coming down precipitously, without a doubt. But you do have two bid-ask spreads, two bid and ask spreads to deal with on entry. And if you were to close it, you would also have it on exit. So commissions are always something you should think about inside your strategy. Obviously, you have limited and known upside versus unlimited if you buy it outright. We touched on that a lot. What would like the move to happen closer to expiration versus right away? Now, I'd get an F in English for writing it that way, but I guess I did that anyways. Good thing I have a degree in math, right? Would like the move to happen closer to expiration date than right away. That is true. And we highlighted that on our last graphic. If I'm doing the option, if I'm doing a long spread, I can always, let's put it this way. If I'm buying a long option contract, it's not going to really hurt me to go too far out in time. So I want to err on the side of buying too much time in general. The only downside is it adds the cost. Time is money. But that gives me more time to be right on my forecast. All right. On spreads, that's not really the case because I want to be right on my forecast closer to that expiration date. So choosing your expiration is very important in the spread trading world. And it really depends on the underlying stock. If it's a more volatile stock, I'll be shorter. First of all, you'll get more time premium. In other words, I maybe look at a couple of weeks out. As opposed to a less volatile stock, I might be more willing to go out 4 weeks in time or maybe 5 weeks. But it depends a lot on the volatility of the underlying stock overall. Okay, now 2 last ones that are fairly important, then I'll get to your questions. Early assignment of the short strike. Can you be assigned early on one call out on one of the options and not on the other? Well, if you're going to be assigned, that implies that you sold it. And that is possible, but in the options trading world on the call side, it doesn't happen as often. But you got to realize that if somebody exercises a call option, that means they're paying cash now as opposed to paying cash at the expiration date. Most people would rather pay it later at the expiration date, but they're humans. They can exercise early and they have that right to do it. What if the stock ends up between the strikes at expiration? Now, this is a situation that you got to be aware of. If I buy a long spread, and in our instance, the stock was between 60 and 65. That was the last spread that we looked at. We bought a 60, we sold a 65. If it's at 63, you're going to want to do something with that trade. You don't want to fall asleep on expiration. You probably want to close out that trade. That means you're selling to close your long option, you're buying to close your short option contract, or if you plan on owning the stock, right? The stock's not going to get called. You're not going to buy it and sell it via the option contracts because it's between the strikes. So what can I do if that's that situation? I can go on out and if I want to, I can let the long option be exercised, but I got to make sure I got the capital to pay for it, right? I got to be able to buy that underlying stock. So just be aware that if the stock finishes between the strikes, you have to do something. All right. Well, I'm getting a little bit long here. We're about to the end of our digital conference overall, but I want to answer some of your questions. So 1 second here, I'm riding solo. Let me log into my computer and look at the questions that are up. And I want to say, what a great event today. This has just been a lot of fun participating in. And if I look at this, we have quite a few that are out here. All right, overall. Scroll down, okay. Thanks for being patient with me. Now, this is all my information. Like I said, I'm known as the options guy at Ally Invest. you can email me any of these questions that I can't get to today. You can email them to me at theoptionsguy@invest.ally.com. Follow me on Twitter. My handle is Brian Overby. And here's a little book that I wrote called The Options Playbook. You can go to optionsplaybook.com and check it out. We also sell it on Amazon overall. So please do check out The Options Playbook, okay, at optionsplaybook.com. All right, Mike Morrow. Mike is saying, I'm always a little confused by these spreads. Do you need to exercise the call at some point if it goes above the strike? And how do you do that? I'm referencing the long call spread you're talking about. Well, you can. I mean, you would have to call the desk to exercise and say, I want to exercise and I want to buy the stock. But what's most common? The most common thing to do when you're doing spread trading is to buy to open the option contracts. And then when it reaches a price that you're comfortable with or uncomfortable with on the downside, if you will, then you sell to close those positions. So what does the order look like after you have the position on? You bought to open the call, so you want to sell to close the call, and you've sold to open the second call. That means you're buying to close the second call. So it's buy to close and sell to close when you're closing out that option contract strategy. So that is the more common thing to do. And if you have a position on like this, you need to be aware of the markets, and especially on that expiration date where that underlying stock is at relative to the strike prices. All right. If you sell, okay, so this is B. Berg. If you sell a covered call on an option at 63.90, you need to have 6,390 in cash in your account, right? Okay. If you sell a call on an option at 63.90, now I'm going to use our example, B. Berg, in that we bought the 60 strike call and we sold the 65 strike call. We are considered covered on that position because we have the right to buy the stock at 60 and we have the obligation to sell the stock at 65. So because we have the right to buy at a lower price than we're selling at, we do not have to have the capital in the account to buy that underlying stock at that strike price, right? So we're buying, we have a right to buy at a lower price and we have the right to sell at a higher price. Okay, now, if we get to expiration, I guess I'll go in more detail, but if we get to that expiration date, and at that expiration, let's say that the last scenario that I painted is happening. The stock is at 63 and I have the 60 strike call and I've sold the 65. So the stock is in limbo. It's between the two strike prices. If you do not have the capital in your account to buy the 100 shares of stock, well, in that situation, your brokerage firm may close out your position for you. They may close you out because if you were to exercise, you would end up with 100 shares of stock. You got to pay for that 100 shares. Okay. So I'm going to emphasize this, things to think about. If you're doing option trading and you're doing spreads, you want to be awake one day of the month, and that's that expiration day. And you want to adjust your position or trade out of it or do something with it overall. All right. Here's another one. In the last presentation, you were using monthly expirations. Is that still the case here, or can you use this strategy with weekly options? I'm going to look at another one. What happens if you allow the option to expire? I just addressed that. When do you want to take a profit, or do you sell both options or wait until expiration? Okay, when do you want to take a profit? Well, we did talk about this in the last show and expirations came up. I kind of emphasized if I'm doing long spreads, picking my expiration is more important than the expiration I'm choosing when I'm buying options outright, in that we max out closer to that expiration date. So you got to choose the expiration wisely, and there's no golden book of answers. It really depends more upon the volatility of the underlying and your forecast for that underlying. So I don't have a great answer for that because we'd have to look at a specific example overall. And then here, they're using monthly. Can you use the strategy with weekly options? Yeah, you can. And in some instances, because of the way that the pricing of the option contract as expiration approaches, that can be done. So weekly options are a viable expiration in a long call spread. All right, so now I'm getting more. I think I got a few more. I got 10 more minutes here. I might come back to a few more questions. Let me see what else we have on these questions. But I'm going to look at the platform because I'm getting a lot of questions just about the platform in general and about entering a trade. So I'm going to pull at this point in time, I'm going to pull over the Ally Invest option trading platform. And I have a little known stock up here. It's actually called Walmart. Walmart looks like it's down today. This was a live quote. The markets are closed at this time. It's 4:20 Eastern time right now. And we see that the market is 120.30, down 77 cents. We have Walmart stock. Here's how I would approach just looking at it. Now, this is not meant to be a recommendation by any means, but I'm going to look at more than one trade, and I'm going to show you how you would enter that trade on the Ally Invest trading platform, okay? Specifically with spreads. I personally think that we are one of the easiest platforms to actually enter a spread trade on. First of all, if we look across the top, we're showing you the real-time stock price. We're showing you if they are going to announce earnings, and we're also showing you the dividend, the next dividend date and when it's going to be paid. We have all the different expirations you can choose from. You can just check a box. Right now, we're going to look at the July 17th expiration. It's 23 days away. Why am I picking that? Well, it's the monthly expiration. It's the third Friday of the month. You could look at the 16-day, the 8-day. It all depends on your forecast, everything that I talked about on this event. Now, if I go and I look at this overall, here's what we have. Stocks at 120. I am going to, and part of the reason why I picked Walmart, I didn't pick Walmart because I like Walmart. I picked Walmart because it's trading very close to the actual strike prices, and it has 1 point strike. Because now I can show you how we can adjust these strikes to try to think about how it affects our time premium. Okay, so let's go 2 points in the money down to the 118 strike, and let's go 2 points out of the money to the 122 strike. Now, the quote is down below on the screen. I'm going to have to scroll down to look at that quote. But I've traded options enough to know that if I pick these strikes and I'm 4 points wide, I'm 2 points in and 2 points out, this should be trading for about $2. Might not be exactly $2, but it should be trading for about $2. Why? Because if I go equidistant in and out of the money, I should be buying about the same amount of time premium as I'm selling overall. So if we scroll down and we look at it, we're $2.26. Now, we're a little bit in the money, right? Because we're trading at 120.30. But this is the concept. This is the thought. If this was right at 120, right? We got 30 cents, a little bit in the money here. If this was right at 120, this would be a trading for exactly $2 or approximately. I mean, you're still in the real world. This is the theory that I'm talking about. And that's how you can kind of look at how can I center and manage my risk and manage my time premium exposure. So now we have a 4 point wide trade. The maximum is 4 points. The net debit is $2.26 in this instance. That means $226 if we filled at the midpoint, right? If we filled at the midpoint, which is right between the bid and ask, and that's the net midpoint. We would click this button over here, and my screen's blowing up a little bit, but this is where the trade would populate. We click it like this, say we want to pay a net debit. If we want to try to fill it at the midpoint fills are never guaranteed. We can just click on that, and that would enter the order. And if we wanted to place it, we just hit preview order. So a very simple process to look at entering that trade. Now, let's talk a little bit more about these spreads. Okay. We looked at it. We got $2, 4 points wide. We got $2. If I wanted to make it cheaper, if I want to lower that cost, okay, we're going to keep the theme of the 4 point wide spread. But if I want to lower that cost, what I'm going to have to do is I'm going to have to sell a more out of the money option contract. So I go up one strike and I buy the 119. Now I'm going to sell the 123. And that will lower the cost of my spread. Now that is trading for exactly $2 in this instance. And I've lowered that cost by doing it. but now I need the stock to go up higher to reach that strike. And now I am definitely paying more time premium than I'm selling. So at this point in time, if I do this, my break even now goes to 119 plus $2, which is the midpoint here, or 121, right? So I need the stock to move up 70 cents to get to the break even point. Now, if I want that break even point to be below where the stock is, I go the opposite direction, right? I would have to go down. We did the 118. Let's go down to the 117 and we make it 4 points and we sell the 121. All right. So now in this instance, 117 plus 243, right, where the midpoint is at, is 119.43. 117 plus 243 is 119.43. The market is at 120.30. Okay, so now by going down 1 point from our original strike, still keeping the 4-point wide spread, now we don't mind if the stock just stays where it's at or if it goes up in price, because we are selling more time premium than we're buying. All right, how fun was that? Now, I'm also going to highlight this over here. We can see this at expiration. We don't have the stock graph on it, but this is the profit and loss calculator, much the same as the calculator that, or much the same as the graphs that I made inside the PowerPoint. We're showing this at expiration. This is our profit and loss graph. And this is our profit and loss graph as of today. The colored line is as of today. Now, we have 22 days remaining. I'm going to take this all the way down and make it basically 1 day remaining to expiration. And I'm going to regraph it. Notice the color line looks very close to the expiration graph. Let's go out even a little further in time. Let's do it like 5 days remaining, and we'll graph it. And now you just see as expiration approaches, our colored line, which is showing our theoretical profit and loss graph as expiration approaches, is slowly being drawn in like gravity towards that expiration profit and loss graph. And at expiration, it will come in together and it'll basically start trading just like that expiration graph, the dotted line overall. All right, now, can I do this with puts? Yeah, you definitely can. On the options world, if we go over to the other side, we'll just start with the 4-point wide. This would be a long put spread. I'm going to go 2 points in the money. You'll note that that's highlighted. The colors on the platform here's highlighted. We're going to be buying at 122, and we're going to be selling at 118. That would be the 4-point wide spread. We're going 2 points in the money, 2 points out of the money approximately, and that's trading for 182 overall. If I wanted to be bearish, I wanted to use that same expiration, I would just hit trade. And over here, we'd see the preview. Try to fill it at the mid price, click on that, and we're all ready. We're buying to open, notice the 122 strike put with the July 17th expiration, and we're selling to open, highlight that we're selling it to open, we're not closing, the 118 strike July 17 put. Now, somebody asked about expiration, what might happen? Well, if we were going to close out our position, we'd actually just change this from a sell to open to a buy to close, and from a buy to open to a sell to close. And that means that you'll see that it's quoting for the same quote, basically 182. Markets are closed right now, so that quote won't be moving. But that would be, if we put that position on, we would open it. And now if we wanted to take it off, we would close it. And we can do both of these trades inside the Ally Invest option trading platform at a all as one trade, but we would have to pay a commission for each option contract that we're trading. All right, I got a couple more questions. We're about ready to sign off here from the digital conference. I know my colleague, Lindsey Bell, who did a great job at the beginning half, such a great presentation from her and Callie, and also was a wonderful hostess today. But let me address a couple more questions. I still see a couple of them that came in, but a lot of the questions were basically around the Ally Invest option trading platform. But let me see what else we have here, okay? All right, Eric, when you take a profit, do you sell both options or do you have to wait till expiration? That was basically the same thing. Can you demo the trade? What happens if you allow the option? Okay, so what happens if you allow both option contracts to expire? That comes from Scott. Scott asking, what happens if you let both option contracts expire? Okay, if the market goes down and that expires, that's a bad thing. That means that you've lost what you invested. And in this instance, that with the one on the screen, if we filled at $1.82, it would be $182 plus commission for every 1-by-1 spread that we did. Now, if you went to expiration and both options got assigned, right, it didn't land in between the strikes, it was up at, well, in this instance, we're bearish now. Let's switch it up and do the call. Let's do the other side. And then I'll look at the profit and loss graph and I'll talk about it, okay? So I'm going to clear this up. And I'm going to buy the 118, sell the 122. All right. If we do this now at expiration and the stock, this line is actually where the stock is at, and the stock ends up all the way up around 124, and we fall asleep. We don't trade out of this. Nothing happens. Now we're at 124 at expiration. We got our maximum upside that we can make. If that is the case, they will exercise and buy your call, buy your stock, and then they'll turn around and sell it. It'll be one transaction. And here's the good thing. In the options world, if this is the case, you do not have to have that capital in your account to do that trade. All right. They will buy the option via exercise on the lower strike call, and then you'll be obligated to sell that stock at the higher price call. So that's a great question. Thanks, Scott. All right. Well, looking at it, a lot of the questions, once again, are about the Ally platform. So I think now is the time that I would love to bring in Lindsey Bell, our chief financial strategist with Ally Invest. Did I say that right, Lindsey?
It's chief investment strategist.
Investment strategist. It's been a long day. It's been a long day. So my first question to you, Lindsey, what a great event. What was one of the most exciting things or one of the things that you picked up from today's event?
Yeah, it certainly was a great event. Before I answer your question, though, because I know people are probably going to start dropping off, your options presentation was really great, but we did see in the comments that if some of the viewers feel like they're stretching themselves a little bit, your presentation was geared more towards intermediate to advanced types of investors. So if you felt like you're stretching yourself a little bit, it's okay, because Brian also is able to very easily explain a lot of the basics of options that can help you get started. And one way that he does that is you can find his direction in the optionsplaybook.com, either online or the book that we sell on Amazon. There's just a couple different ways. Also, Options Radio podcast. And then I'll probably plug it again later today, but he and I do a stock play of the day show where Brian covers a trading strategy every Monday at noon. So little plug there. But did I cover it all, Brian? Is that all the places they can find your information on options trading from a very basic level?
Yes, without a doubt. And we do have, if you just want to know like the definitions, our community hub, Allies Community Hub, the general hub, overall, we have an invest tab, which basically goes with Ally Invest. And then under that, there's actually another one that you can click on that says options. And I have about 4 or 5 very basic 3 to 4 minute videos that just talk about the definitions of options overall.
Yeah, that's definitely a really great place to start if you're just getting into options trading. Mm-hmm. But back to the day, you asked me what my key takeaway was, and I'll say I really think we drilled into our viewers' heads that diversification is important, and I hope they feel confident enough now to execute their portfolio in a way that it is diversified and fits their needs. But I also really loved about today is there were so many personal stories from our presenters, whether it be, how Shelley Seagler got started in the industry from teaching theater to now in finance, to David Peltier talking about how he builds his own personal portfolio and his risk tolerances, to Lule and Anna talking about the wealth gap and how they are working to combat that. I just thought there was just such great stories for our viewers to really help them understand investing in general. But what about you? What struck out that as key points throughout the day for you, Brian?
Well, I guess the biggest key point that came through, you talked about the diversity. Not only do we have a great discussion about just diversity in general in the world, we talked about diversity in a lot of the portfolios. And that theme just kept coming back up. Diversify, rebalance, diversify, rebalance. How can we look at these markets on unprecedented time and try to deal with the fluctuations and implied volatility? And I love that we had such a great turnout. And I think that has a lot to do with the uncertainty in the marketplace. We see the volatility index, the fear index, the VIX index, if you will. The VIX is another way that we can say it, at all-time highs. We saw it actually reach an all-time high during the big downturn after the pandemic was realized, and we still have that high volatility in the VIX index right now. It's still up above the 30 level, which is very high overall. So keeping to your plan, coming up with a plan, sticking with the plan, not reacting, just knee-jerk reaction, is so important in investing. And I think that was the main overall theme today in the Ally Invest Digital Conference.
Yeah, it really is. I think that's a very good point that you make there, for sure.
All right. Well, I guess that's going to sum it up for the closing remarks on our Ally Invest Digital Conference. All of these videos will be available tomorrow. We're hoping at some point during the day, hopefully in the afternoon. So you'll be able to watch them all for free on the Ally Invest YouTube channel. Thanks for coming, everyone, and we'll talk to you soon.
Well, before we go, Brian, didn't mean to cut you off there, but I wanted to also thank everyone for attending our Ally Invest Digital Conference, and we hope you took away some really great learnings, whether you're new to investing or you've been doing it for a while. Hopefully we gave you new ways to think about investing, but we do hope to host many more conferences like this, but just to make sure we are we make the best use of your time in any future conference, please take the time to answer a survey that we're going to be sending to you. It'll be very short following this program. You'll get it via email. And don't hesitate to give us candid feedback to help us identify the kind of topics and content that you'd like to cover with us in the future. We welcome any thoughts that you have on the format and flow as well. Please don't hold back. As usual at Ally, our goal is to be the best financial ally that we can be for your own well-being. We are here for you. Please don't hesitate to contact us in any way you need. Follow Brian, myself, Callie, Lule. We're all on Twitter and LinkedIn, putting real-time information out there, in addition to on the community hub and on YouTube with Stock Play of the Day and other things too. So we are at your disposal. Again, thank you all for your attendance today.
Thanks, everyone.